Good morning and thanks so much for tuning in to India Market Open with me, Neeraj Shah and Alex Matthew. And it's the tariff day. Terms like Trump session are very, very widely being used. And the notable part, Alex, to my mind, is when Donald Trump came in, everybody expected the US economy and the markets to have a great run after 2 years of US exceptionalism. This year has shown anything but that. And the clearest sign of the divergence thus far is what Europe is doing versus what US is doing.
Oh, 100%. And we're talking about a situation where, and I think our first guest today has a view on this, on the fact that the chorus of the diminishing of US exceptionalism is growing louder, because he has a different view. But I think it is an important point to talk about. Of course, earnings growth has been strong there. And in certain other pockets as well. As looking at Japan today, Japanese profits have grown quite considerably.
Yeah, but also it's a thing born out of what Donald Trump has done, right? Because if defense spending in US grows forcibly, because Donald Trump has decided
Europe,
that I'm taking military Europe, I'm taking. Sorry, did I say something else?
You said US.
Okay, my bad. But if Donald Trump is taking all aid off Ukraine, and if Europe is forced to spend on defense for Ukraine and for itself, that kind of spurs. Now, whether it's temporary, permanent, how long-lived remains to be seen. But for now, we are seeing that. The only question is if US, the mother market, continues to get riled, what happens to other EMs? And the positives being ignored, right? Crude is lower, yields are lower. Did you know that the US 10-year yield, I'm sure you know, but I'm just saying, 4.13%. So there's lots happening there.
Under the 4.13%. I think to a certain extent, some of that haven demand is also playing through, right? Because of the uncertainty you have, of course, dollar, you have gold, which is at 2,900 at the spot level, $2,900. And you have traditionally the US bonds, which have been bought into, I guess, to a certain extent. But let's talk about some of those aspects, right? Why are we talking about this at the start today? As Neeraj pointed out, today is in fact tariff day, you can call it that, because tariffs that got pushed last month by Donald Trump when he came into office just a couple of days after he said he's going to give it a month. And those tariffs are set to proceed. 25% tariffs on Canada and Mexico will proceed and will kick in later today. In fact, Donald Trump has said very clearly that there's no room left for Mexico or Canada. The tariffs, you know, they're all set. They go into effect tomorrow, unquote. Now, Wall Street, of course, ended sharply lower after Trump announced the onset of tariffs. An additional 10% tariffs on Chinese imports have also, by the way, been signed in. There has been a response to that already. Canadian Foreign Minister Melanie Joly said that retaliatory tariffs were ready. In fact, she said that Canada did not want a trade war but would hit back if the US started. And China, on the other hand, the Commerce Ministry has weighed in and said that it strongly opposes US tariff measures. It hopes that the US will handle the issue objectively and rationally, and it has urged the US to respect the rights and interests of other countries. The US moves, it says, cannot solve its own problems, and it calls on the US to withdraw the unilateral, as it calls it, tariff measures, and it reiterates that countermeasures against the US tariffs are ready. It vows that necessary measures will be taken to defend interests. So the biggest fear at this juncture, of course, is that this is going to blow up into a full-blown tariff war. At this juncture right now, it's the announcement and the implementation of tariffs on one end. But let's talk once more about what happened in the US overnight. You had US indices see their worst fall in 2025. The Dow dropped 1.5%, the S&P 500 by more than that, 1.8%, and the tech-heavy NASDAQ composite has fallen as much as 2.6% in trade. Equities in the Asia-Pacific region have also started mixed, with Japan and Australia trading lower at the start. Treasury yields fell, and Neeraj just pointed that out, possibly on safe haven demand. The dollar index is currently at 106.5, and crude oil prices are also down in trade, likely reacting to the possible hit on global trade, but also because there is an expectation that the OPEC Plus will go ahead with its supply increase. Brent crude, by the way, at $71.5 to the barrel last I checked. Manufacturing PMI, and this is another data point that came through in the US, has fallen to 50.3 last month from 50.9 in January. And the new orders index contracted to 48.6 in February from 55.1 in January. The drop in PMI is being attributed to fears about the impact in tariffs. Meanwhile, in geopolitics, this is again what we were alluding to at the start. The US is pausing military aid to Ukraine, and the freeze follows the clash between Donald Trump and Volodymyr Zelensky in the Oval Office. White House officials have said that the US is reviewing aid to ensure that it is contributing to a solution. And this, of course, leads to an expectation that Europe will have to pick up the slack. It will have to aid its ally, Ukraine, and also spend more on defense. Neeraj.
Yep. Okay, now before we get to our guests, very quickly, Donald Trump says that 25% tariffs on Mexican and Canadian imports will start today with no room for delay. Listen in.
On the tariffs, is there any room left for Canada and Mexico to make a deal before midnight? And should we expect those Chinese tariffs, the extra 10%, to take
no room left for Mexico or for Canada? No, the tariffs, they're all set. They go into effect tomorrow. And just so you understand, vast amounts of fentanyl have poured into our country from Mexico. And as you know, also from China, where it goes to Mexico and goes to Canada. And China also had an additional 10, so it's 10 plus 10. And it comes in from Canada and it comes in from Mexico, and that's very important.
Okay, let's get an expert opinion on what could this entail for risk assets. Matt Orton, Head of Advisory Solutions and Market Strategy, Chief Market Strategist at Raymond James Investment Management. Jonathan Barat, Chief Investment Officer, ETO Markets. Both of them join in. Gentlemen, thank you so much for joining in. Good evening, I presume, to both of you, or good morning, as the case may be. Matt, now we know that this has led to a lot of ramifications mentally. Now that it's finally happening, what kind of impact on risk assets, or are risk assets discounting some piece of the tariff effect already?
Hey, good morning, Neeraj. Always great to join. And obviously, markets hate uncertainty, and I think that's where we are right now. There's uncertainty with respect to how long these tariffs might actually be implemented for. I don't think markets, whether the equity markets, currency markets, bond markets, I don't think anything has fully priced in what tariffs might look like if they are left to be implemented in the current state for a longer period of time. That being said, sentiment is nearly washed out, particularly in the U.S. equity markets. I think in Indian markets too, sentiment is incredibly low on the retail side. In particular, earnings, the actual fundamental backdrop for the market, remain very strong, particularly in the U.S. And a lot of management teams that I speak with, they're thinking about tariffs and they're factoring some of that into their expectations going forward. So while we might be seeing a little bit of economic weakening with the intersection of tariffs coming in, I still think as we let all of this play out and digest what this means for the market, there will be an opportunity on the other side of this to perhaps buy the dip that we see, but we're definitely not there yet because there's still a lot more that I think has to play out in the near term with respect to where we eventually go on the tariff front.
Jonathan, come in here. Everybody anticipated tariffs would be a bargaining tool. As things stand, it doesn't quite seem to be the case. They go into effect today. You reckon, you concur with Matt, that at the end of the tunnel, there will be a buy the dip possibility?
Oh, I tend to agree with Matt, but I guess the question is how long is that dip and how long is this going to last for? I think as Donald Trump always does, he comes out punching, and then I've been a little bit surprised here that I haven't seen more rhetoric come from Mexico and Canada, and also China in terms of, okay, once they go into play, these tariffs, what retaliations are we actually going to see? And is the market actually looking at these? Because it seems to me that the market is just purely focused on a tariff, which eventually is inflationary down the track. That's why we're seeing the Fed hold off a little bit, because they're unsure of what's happening. Investors are unsure what's happening. But at the end of the day, if they're not coming, people aren't coming to the table to discuss these tariffs. Remember, Trump has done what he has said he will do, and he will make America great. And if that means protectionist policies, that's what he's going to put in place. The flip side of that are the problems that we're going to see once you put those tariffs in place. because the economy might slow, and you'll get to that scenario where you get inflation again and the economy slowing. And I think that's where investors now are starting to turn towards and say, well, hey, hang on, this is what's happening. This is what could happen, and we could get that sort of, stagflation style of economy, which China has been trying to get away from so many years, and is just finally starting to do it.
Point well made, Jonathan. Matt, coming to you on that, because the latest high-frequency data from the US seems to suggest that all is not well in terms of growth. Inflation, there are worries that all of the measures that are currently being taken will have an inflationary effect. And so therefore, that stagflation bugbear is certainly something that everybody is talking about. In that context, the earnings growth that you saw in the third quarter, is that something that will be challenged, maybe not in the fourth quarter calendar year, maybe not in the first quarter this year, but maybe later on in this year, the earnings growth that you've gotten so comfortable with in the US, that doesn't pan out, and therefore you see a decline in the US?
Yeah, it's a really good point. And I think we have pulled forward a little bit of the earnings growth that's expected. And what's interesting is we've seen earnings growth expectations for the rest of 2025 actually decline more than what you would expect. You always see the analysts take down their estimates so that you can beat them again. But it's happened more than what we would have expected to see. So I certainly think there's an element of analysts and investors starting to take down perhaps some of their earnings expectations, as you might see margin or pricing power erode, given that you only have so much ability to pass through tariffs. But I think what the silver lining in the market behavior right now is the fact that you're seeing this broadening out that we've lacked for such a long time across the equity market. You're seeing that start to happen. So when you look at the earnings and break it down, it's not tech that's in the leadership position anymore. It's actually financials, which are a cyclical part of the economy, and banks in particular. And banks haven't just done well in the US. They've done incredibly well in Europe. They've done well in Japan. Earnings for banks in India have been strong too. So I look to that cyclicality of financials, as well as certain pockets of industrials where you've seen strength. You've seen energy be able to beat numbers really because they're beating very, very low comps, but the consumer as well has held up, and we've seen economic deterioration a little bit, but it's really too early to say any of that is sustainable or not noise. That's why the non-farm payrolls on Friday in the US are going to be so important, because perhaps it's going to provide us a read-through as to whether we're starting to see any weakening in the US jobs market, which we really haven't seen before. There's been head fakes, but we haven't seen any sustainable movement down with respect to the ability to hire or get a new job. So when you put all of that together, the consumer still remains in a good place. And I think investors are buying parts of the market, but they're buying the intersection of growth along with favorable valuations.
And I would add to that to say that maybe we've not seen the full effect of the US government layoffs either. Jonathan, coming to you on this one, right? So do you think that, are you part of the chorus that says that maybe the call on US exceptionalism is growing a little weaker? And from that perspective, do you now start shifting into markets that have seen a major correction, a case in point, the Indian equity market?
Yeah, I think just going back a little bit on your point of the US government. Now, I think everyone sort of looks at the deficit, they phase over it. Now, I think the interesting thing here is there is an economic reality that has to come to pay. There are things that need to be done. And I think if anyone can actually do it, it's Trump. And if he's going to make America great, he's got to rein in that deficit. He's got to rein in that the government, the GDP. And you can't operate an economy at 100% of GDP where your debt is. So I do get a sense that Trump will do something to address that when we're right on sort of the non-farm payrolls. When we see results like Nvidia in terms of their revisions, you're seeing this whole market changing. Now, the question which I like to ask is, in this environment, are we going to see equities go to a record high? And the answer is no, they won't. And I think there'll be more investors looking to say, I've had a terrific run, I'm going to capture, I'm going to move. And so whilst there's mud in the waters, there's no clarity about what's happened, I think we're going to see more of a correction in the equity markets over the next quarter or two.
Matt, very, very quickly, because I understand that you have a few stocks that you're very closely watching in India. What are they right now, and when would you start buying?
Yeah, so I think in India, I've been really looking at high quality investments. And so some of the stocks at the top of my list that I bought towards the end of the fall, early holiday season last year, Bharti Airtel tops the list. I mean, second largest telecom provider, really good ability to increase free cash flow because CapEx is going to come down. You've seen good earnings and an acceleration of earnings. So I think that's a name to keep in mind, especially because it's held up well. I think on the bank side, HDFC and ICICI, which are two of my favorites, really one of my largest favorites is ICICI. Again, really good earnings. And on the private bank side within India, you've seen a lot of resiliency, the ability to help greenfield projects once they get in place, and also looking at the asset management, private banking, wealth management side of the business, which provides diversification. And finally, 197 Paytm. Financial services are doing well globally. This is a stock that has come off of its all-time highs fairly meaningfully, but hasn't totally technically broken down. So that's another name that I think if we start to see some bottoming behavior, I'd be looking to start to add positioning.
Okay. Jamin, thank you so much for taking the time out and being with us today. Really appreciate your time, and good to get this set of views and really appreciate your time. We didn't get a chance to ask Jonathan about the crude fall as well, right? Because beyond what the tariff tantrums are doing, OPEC Plus has come out and said that there are some comments made as well, right? So therefore, lots happening out there. But the clear focus is tariffs. And let's kind of get that piece out of the way before we talk about the trade setup and specific stocks. So we do a slight deviation today, viewers, wherein we try and talk about what the tariff impact effectively could be, if you will, on multiple things. Now, I'll just quickly tell you, what is this, or what is largely happening, right? So the Tuesday deadline today for levies on Canada, Mexico, or China, potentially impacting $1.5 trillion of annual imports. Now, what are these tariffs? US will put a 25% tariff on all imports from Canada and Mexico. Exception is to Canadian energy, which would face a 10% rate. Maybe even doubling tariffs to China to 20%. From March 12th, 25% tariff on steel and aluminum due to take effect as well. And possibly sectoral tariffs on autos, semiconductor chips, pharmaceutical drugs, etc., etc., etc. And as a result, what could also happen is that there could be reciprocal tariffs that could come into play. Even if tariffs are delayed, it will be a temporary reprieve, so keep that in mind. But Canada plans to immediately impose retaliatory tariffs on 30 billion Canadian dollars worth of US goods. Levies on another $86 billion worth of goods from Canada to follow 3 weeks later. Mexico hasn't spelled out any retaliation plan, but China in no unequivocal terms has said that US should rethink its strategy, otherwise China is ready to impose reciprocal tariffs as well. So lots out there. So this is essentially, viewers, for all of you who are wondering what could the tariff war be, this is the tariff war. Now, one is, of course, the headline and what the main pieces are globally. Second is, what could it mean, or what will be announced and what impact it could have on India Inc. more importantly. Somit has done a detailed analysis and he joins in with that piece. Somit, good morning. Let's break it down for our viewers.
So first, let's see what has been announced or what could be announced in the next couple of weeks. Firstly, it's the 25% tariff on all imports coming in from Mexico and China. Then there is a 10% additional tariff on China, which will take the cumulative tariffs on China in the last 1.5 months to 20%. Then there's a possibility of 25% tariff on steel and aluminum imports from all T8 partners from March 12th. And then in April, there's a possibility of the reciprocal tariff coming in. Firstly, let's try and understand the impact of the tariffs that could come in the next couple of weeks and which Indian companies stand to either benefit or lose out of it. Firstly, coming on to the chemical companies like PI Industries, UPL and Jubilant Ingrevia. Now, these three companies stand to benefit because these three companies are manufacturers of the top 5 chemicals that are imported by US. So if there is any tariffs on China, then these three companies could stand to benefit. Now, when it comes to the auto ancillary space, it is a bit complicated. Companies like Samvardhana Motherson, Bharat Forge, Sona BLW, JK Tyre, Balkrishna Industries, Sundaram Fasteners and Timken India. All these companies have direct exposure to US, but the impact could be limited because most of them also have plants in US. But given the complex auto supply scenario that is there, an auto supply chain there could be an indirect impact on all these auto ancillary companies because auto ancillary companies customers, that is the OEMs, have a high dependent on Mexico and China for manufacturing to serve the US market. All these companies, that is Ford, GM, Volkswagen Group, BMW, Mercedes, have manufacturing units in Mexico and Canada which serve the US market. So any tariff could lead to pricing pressure for this auto ancillaries as well. Now, when it comes to metal companies like Vedanta, Hindalco, Nalco, SAIL, JSW Steel and Tata Steel, no direct impact because we hardly import metals to the US market, so no direct impact. But again, this tariff imposition may have an impact on the steel and aluminum prices because of the changing demand-supply scenario, so that could impact these companies. Also, the indirect impact could be on steel dumping coming in from China, South Korea and Vietnam in the Indian market, so that could impact the steel players as well. Now, apart from that, two companies that stand to benefit directly, JSW Steel, they have a 1.5 million ton capacity in Ohio, which contributes only 4.5% to the total revenue, and this stands to benefit if prices move higher. Then there is Hindalco. Now, for the Novelis unit, the impact is still not sure, given the fact that the company could benefit from higher aluminum prices, but on the flip side, the raw material prices could also move higher for the company. However, the company believes that they can be exempted, like something similar that happened last time as well. So currently, we do not have a clear view about what happens to Hindalco as a subsidiary, that is Novelis. Then there is one company, Cummins, that could stand to benefit because higher tariffs on Mexico may open up higher prospects of exports for Cummins India. Currently, exports is a very small portion for the company, but Cummins Mexico unit exports nearly $1.5 billion of components and diesel engines to the US market. And if there are tariffs, this part of this exports could move to the Indian unit going forward. And lastly, it comes to the IT sector. Now, the direct impact is very limited via nearshoring from Mexico and Canada, less than 5% of the supply, so not much of an impact, but still a list of companies that have direct exposure to the US market are Infosys, LTIMindtree and HCL, which have a highest exposure, and companies that have the least exposure are KPIT Tech, Tata Tech and Tata Elxsi. So keep an eye out for these companies, given the fact that tariffs could come in the next couple of weeks.
Yeah, a very comprehensive list there, and a lot of stocks that have already reacted, so watch out for that, of course, in trade today. Let's talk about yesterday's action in the stock markets, and you had foreign institutions once again that sold to the extent of about 4,788 crore rupees. Very strong buy number by domestic institutions to the extent of 8,800 odd crore rupees. Now, it's an interesting picture because you had the Nifty 50 ending largely unchanged, and in fact at the midpoint of a 208 point range. On the lower end of it, it tested that 22,000 mark and it ended above that. Of course, it bounced from that point. There were more gainers than losers on the Nifty 50, but HDFC Bank and Reliance Industries declined 2.4% and 1.8% respectively, and those heavyweights were the drag on the benchmark, which caused it to end more or less flat. The broader markets ended mixed, the Nifty mid-cap index gaining about 0.2% and the small-cap index dropping about 0.6%. The market breadth for both the Nifty 50 as well as the mid-cap index was actually positive. For the small-cap index, it was pretty negative. And the Nifty Next 50, which has fallen the most from 52-week highs among all of those indices, actually gained over 1% in trade yesterday. Realty, metal gained over 1% each, and IT was a pocket of strength as well. Selling continues to remain concentrated, as I said, in the broader end of the market. The market breadth, of course, favored the declines on account of the small cap action that you saw. Capital market plays, and this was a talking point yesterday, Neeraj. Angel One, BSC, Nuvama, a few of the stocks that I saw that got beaten down quite heavily on the change that is in the offing on the derivative side.
Yeah, so I mean, lots of moving parts really, but it's difficult to call the levels every single day. So today, Alex, for a change, my entire trade setup is on the back of a brokerage note and a global guest saying what they are saying. So Jefferies has put out an India strategy note, right? And they are saying that meetings with senior ministers, bureaucrats, industry experts, etc., make us believe that the government is taking steps to improve India's long-term growth outlook. They are focusing on issues like bilateral trade agreements, investments in semiconductors and electronics, and deregulation. The recent move to cut income tax, not just aimed at boosting consumption, but also to drive savings, which may help lenders. And signals from financial markets are also being analyzed. So in these times wherein it's just very, very difficult because of the number of moving parts involved, so difficult to call out levels. So I decided today, let's make a change and not call out levels, really. It's difficult. We don't do that per se out here, but even otherwise. And there's so much of chatter around what FIs are doing, right? So I happened to see an interview that came in on CNBC Singapore or CNBC Asia, wherein Florian Weidinger, who is the CIO of Santa Lucia Asset Management, they do fair degree of India investing. They said that while they're still very overweight China, and 50% of their Pan-Asia portfolio is in China, in that interview, Florian mentions that they've started buying India of late.
Okay.
And interestingly, they say that some of the mid-cap stocks in India are looking attractive. And they also made a point that InvITs, for example, become great investment opportunities when the rates do come down, as they eventually will in India.
Because the yields will be good.
Yes. So at 12%, if you're getting that product, and if rates are going to come down, then they become really great products. So from a global investor's perspective, that's great returns, right? 12% plus, plus, plus. Right. So very interesting that selectively we are seeing some global voices say that the valuations are now okay. Brokerages who cater to these global voices are going out, meeting the government officials and saying things are being done in an active fashion. We've seen some of the, and we'll do a piece later on valuations as well. So lots of things happening. Maybe we are around the end of the pain, but who knows?
I have a question for you, Neeraj, and of course you look at this very closely, which is why it's been occurring to me. If you talk about earnings growth and you talk about profitability in the third quarter, disappointment of course, right? 5% growth for India. In a scenario where you're talking about 18+% growth for the US in that same quarter, you're talking about double-digit growth for Japan and a couple of other major economies. At what point does that turn? And is there a possibility of that taking place in the fourth quarter, even if it's an outside chance, or do we wait for the base effect to kick in next year, for certain other tailwinds to come together, for earnings growth to really start kicking in?
Yeah, I mean, so I think quarter four would be a key litmus test as well. But remember, the problem for Indian markets, as also a lot of other markets, might be that China is doing really well. And for the global money manager, it's only at the margins some money coming into India right now, whereas the larger portion of the money might be going to China because China is doing all the right things. So let's wait and watch.
Okay. So I'm told that we have to take a very quick break, but we've got stocks to discuss, of course. Neeraj's stocks, and I've got stocks on my list as well. We have to take a very quick break. We'll be back on the other side to talk about those and the other trading ideas that you should keep in mind before the start of trade. Do stay tuned.
Very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breathing also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
Welcome back. You're watching India Market Open, and we're all set to tell you about the stocks that are on our radar. We've talked about a lot of aspects, of course, the Trump tariff war, a possible tariff war kickstarts today. But from the domestic perspective, we also spoke about the trade setup, Neeraj, rather than speaking about levels, talking about the context. But let's talk about stocks. Time Technoplast. It's likely to get a thumbs up today, and this is because it is introduced an additional product in the existing polyethylene pipe business. The pipes are to be designed for the gas distribution industry, and this is in line with the company's forecast of 30% growth in polyethylene pipe segment. The overall capex requirement is about 8 crore, and the expected benefits are expected to be materializing from the second quarter of the next financial year. Indian Energy Exchange is something that I was looking at because of the February data that came through. The volumes are up as much as 9% from a year earlier to about 9,622 million units. Renewable energy certificates have surged 167% to 16.37 lakh. Now, generally you would say that March is when you have the seasonal demand for power kick in. So volume, of course, in the month of March is going to be watched very closely. Havells is a thumbs down. You have Bank of America on Havells, which is maintain and underperform and cut its target price to 1,400 from 1,585. And by the way, the stock price is actually at 1,429 right now. It says that Ultratech's wires and cables entry, there's no immediate disruption, but that wires and cables business is set to grow at 12% CAGR over the course of FY24 to 27, led by cables. The near-term expectation is that the harsh summer should bode well for ECD and Lloyd. In the tail end of the correction, according to the brokerage, but it's waiting for the visibility. Valuations are a bit of a question mark at this juncture for Havells.
I wonder if Suraksha Diagnostic will have some issues today because the anchor book opens today. So therefore, that could be one name that you would want to keep at the back of your mind. So keep an eye out for that one. If there is some selling, it's could be presumably because of that. So that is one. Did you take Azad Engineering? Because otherwise it's an interesting one, simply because, one, it's got on a key orders and they've successfully managed the QIP. I thought the alities were interesting because amongst others, White Oak India Opportunities Fund also comes in, as does ICICI Prudential Flexi Cap Fund. So therefore, that's the other interesting one. And from a slew of brokerages that we have today on the channel, because the street is veering towards some bit of larger cap names in safety, and we've seen what the Bajaj twins have done. I've chosen the note that Macquarie is written on Titan as the third stock. They have maintained an outperform, even though they've cut the target price, because they say that while there is some near-term hit that is possible, but the medium term, things look okay. They believe the pace of lab-grown diamond adoption will be gradual, and they see Titan's willingness to enter the space post-stronger adoption as comforting. The Titan is not averse to that idea. So keep an eye out for some of these. But of course, there's not as many newsmakers today. Some chemical price upticks might impact Thirumalai Chemicals, so on and so forth, but not enough in terms of news flow today.
No, 100%. And I guess the broader conversations around what happens around the globe are what has been affecting the Indian equity market and will continue likely in the near term to have a bearing on the Indian equity market. But speaking of global factors, we've been watching the fund flow data very closely on a daily basis, and we've been pointing out that foreign institutions have largely been sellers over the course of the last 5 months or thereabouts, right? What are the factors that have contributed to this, and where exactly are they selling? Who is selling? And who is buying at this juncture? Somit has done some work on this to find out which pockets of foreign institutional investors have been buying and selling. Somit?
Well, yes, FII selling has been one of the major reasons when it comes to the fall in the Indian equity markets. In fact, to be precise, in the last 5 months, Indian benchmark, that is Nifty 50, has fallen nearly 20% on dollar terms, while the broader market, that is the Nifty mid cap and the Nifty small cap indices, have declined anywhere between 25 to 30%. And the major reason behind this is the sell-off coming in from the FIIs. Nearly $37 billion of Indian equities has been sold in the last 5 months by FIIs. Now, there are two reasons which could have led led to this sell-off? Firstly, the non-India factors. Firstly, it could be the fact that the global investors might be shifting to debt from equity, given the fact that US yields had risen to 4.5%. The second reason is the shift from India to other emerging markets and developed markets, given the fact that there has been a lot of global uncertainties on the back of the tariffs that are expected to come in. Now, when it comes to India-specific factors, the first reason is high valuation coupled with lower earnings growth. Now, we started the financial year, that is FY25, with earnings growth expectation of around 13 to 15%, but right now we are seeing an earnings growth that could be just 5% for FY25. So that is one of the major reasons. Apart from that is the lower capital expenditure or the slowdown in capital expenditure owing to general elections and various state elections, and then there is tight liquidity and lower credit growth, which also constrain the overall economic growth in the country. So what or who are these FIs that have been selling this data? Now, to come to that data, we have used the NSDL published category-wise foreign portfolio investors asset under management data. Now, we have compared the September month data with the January month data to see which of the FPI categories have seen the biggest drop in their asset under management. Now, why the asset under management would have reduced? It could have been because of the fall in the stock price and or because of the selling that we have been seen by the funds. Now, based on these factors, it is very safe to assume that if a certain categories certain FPI categories AUM has fallen much more than the overall FPI AUM, then it could be safe to assume that that FPI category must have been a seller in the Indian equity markets in the last 5 months. So in the last 5 months, if you look at the overall FPI AUM, that has come down by 13%, but the FPIs of these categories have fallen much more than that. So who are these categories? Firstly, if you look at it, it's the investment managers and investment advisors, which have seen a decline of nearly 37% and 32% in their AUM, which is way higher than the overall FPI AUM fall and the market fall. So these guys must be definitely the sellers in the Indian equity markets in the last 5 months. Then there is University Fund and AMC, which have seen a decline of nearly 25 to 28% in their AUM, followed by regulated entities, central banks and pension fund, which have seen a decline in their AUM of anywhere between 13 to 20%, and this is higher compared to the overall FPI AUM fall and the market fall. Now, if you look at which categories would be the buyers in this market, now these categories like insurance and reinsurance entity have seen a decline in their AUM of just 10%, which is way below than the market fall and the overall FPI AUM fall. So definitely they must be buyer in the Indian equity markets in the last 5 months. Then there is sovereign wealth fund, government-owned entities, endowments, which have seen a decline of just 8 to 9%, followed by LLPs, that is limited liability partnership, trust, banks and family offices, which have seen a decline in their AUM of just 4 to 7%. So these categories would be definitely a buyer in the Indian equity markets in the last 5 months.
A very interesting data points there. Soumit, thanks so much for getting us those details. Let's draw your attention to the watch list today. We've spoken about a few of these stocks, but let's round up everything for you. Canfin Homes, Morgan Stanley is seeing 52% upside from the current market price and certainly should be on your radar today. Time Technoplast was something that I spoke about. It has launched a new product, polyethylene pipe, and it targets a 30% growth. IEX was also on my list. The Feb trade volumes were up as much as 9%. Azad Engineering, Neeraj spoke about this. It raised as much as 700 crore rupees via QIP. Titan Macquarie is currently seeing a 32% upside. Though it has cut its target price, it is still positive on this company. Godrej Properties, the promoter is buying 1.3 lakh shares, and OMCs are going to be in focus. There are a few people that are talking about this. Crude has hit its lowest level in 2025. Thumbs down, of course, for a couple of counters. OMCs actually you should watch out for on the upside, maybe a tagging error there. But thumbs down. Suraksha Diagnostics down 6%, or rather 6% shares to exit the lock-in, and Havells was something that I spoke about. An underperform rating by BofA, and it has cut its target price. The target price currently below the market price, Neeraj. But let's talk about the derivative space, and Agam standing by, of course, to tell you about the latest news on the F&O front. Agam, we ended flat yesterday and we tested that 22,000 mark. What are the key levels to watch today?
Well, that's exactly the key level to keep an eye on today is 22,000, because now from there on, we actually start looking at levels around lower. And even as we see the Nifty come off substantially, it does seem like we're going to see a little bit more weakness playing out in today's day of trade. It's been a tough market and we're moving into yet another month of further declines where we haven't seen as much increase in open interest for the Nifty futures towards shorts. And do remember, yesterday was a day while many technical parameters did indicate markets which are already oversold. The question really is that at what point in time do you start seeing about a short covering? That's going to be a wait and watch. Even in terms of the bank nifty, let's pull that up as well and see how things are faring. We have about 0.5% up move there, but very little change in open interest. So do remember that traders at this point in time are not placing any bets when it comes to the respective futures. What about the options market? Let's talk about that as well. And as I was mentioning that yesterday as well, that 22,500 calls and thereabout, about 100 points on either side of the levels will be where we will see a little bit of resistance in the near term, while 22,000 remains the one with the most amount of open interest. We also have a lot of build up around 21,900. This is on the back of the fact that a lot of traders, which are relatively longer term, and do remember, this is on relative basis, if they have sold the 22,000 put, well, they would have probably sold it for about 50, 60, 70 odd points in premium. And that gives them that much comfort all the way until 21,900 so as to stay in the trade. So that's something that you need to bear in mind. If we do in fact see that level being taken out, then well, things are going to be a lot tougher in general. And it does seem like, at least in terms of open, that could be a possibility. At least as far as the stocks are concerned, again, shorts in Titagar, IRA, Patanjali Food, IFL Finance, all of them looking at shorts, and among stocks which are saw unwinding. About a short covering for Delivery, Trent and Polycab, but this short covering may not be here to stay. There may be a little bit more consolidation, so it's going to be wait and watch on that one.
Thanks so much, Agam, for getting us to Let's pull up the indicative open just to reinforce what Agam was talking about the levels to watch at the start. And of course, 22,000 becomes very important at this juncture, right? Because you're seeing an implied open that is considerably lower than yesterday's close. Let's bring on Kunal Rambia, who's the founder of The Street, who's joining us right now to talk about some of those key levels to watch. Kunal, very good morning to you, and thanks so much for joining us. Tough to talk about levels at this juncture, of course, but I'm still going to ask you, what if we break the 22,000 mark? How low can you go is the question.
Morning, Agam. Morning, Alex, and morning to all our viewers. Yes, you correctly mentioned, actually, this is the level where, anything can happen. But again, I just go back and check out the last 4 years trend. If you look at the massive rally which we saw post the elections, that started from 21,800, 22,000 levels. And then we saw the uptick to 26,000. Now there was a vertical rally, right? And now what we are seeing is the price as well as the time correction, and indices have again come back to the same levels. So immediate level, what Agam was mentioning, I heard that's 21,800 level is something to watch out for. That zone is something to watch out for. Whether we should be buying immediately, I will say no. Let's not catch the falling knife. Let the market settle down near 21,800 zone. If after consolidation it starts the uptick, we'll think of initiating buy. Otherwise, I think this is the level from where individual stock-specific stories might just emerge, and where we get very good risk-reward ratio. I think we should be focusing on that now.
Okay. I'm just wondering whether, Kunal, you want to highlight some of these individual stories at the start, because and Sunny Agarwal also joining us this morning. Sunny, of course, good morning to you. I'll come to you in just a bit. I want to talk about some of these individual names with Kunal, though, because while we're talking about the index level drops, and particularly for the broader markets, the drops for individual counters have been far sharper. And so, are you seeing any opportunities based on bottoms having been hit in a few counters?
Absolutely. So again, Alex, now I'm just picking up first counter, which is Adani Green. Historically, from October 2020 so far, if you look at the historical data, this counter has made bottom near 840-50 mark almost 6 to 7 times. Yeah, there was a massive correction during Feb 23, but again, it just reclaimed the same level. Presently, it's trading at 804, and yesterday, I saw very good volume activity happening, and even the stock was up by 3.5-4%. So I think this can be a good counter offering, good risk reward ratio. So with the stop loss of 775, I would say, one can go long, and the targets can be 875. The second is REC. After sharp correction in the counter by almost around 35-40% from the peak, 45% from the peak, I think this counter is now again showing good consolidation near the previous bottoms of 2024. Considering that, one can go long on REC also. Stop loss can be 360 for now, and the targets can be 410 in both the counters. Again, trailing the stop loss and holding the position would make a lot of sense if the counter turns favorable for us.
Okay, Sunny Agarwal with us as well from SBI Cap Securities. Sunny, how would you look at the turbulence right now? And let's take off from where Kunal left off, right? Some NBFCs, because we've seen select NBFCs do really well. Bajaj Finance, Finserv, in a market like this are shining like gold, or maybe better than that.
Yeah, good morning, Neeraj, and good morning, everyone. I think, yes, definitely, the way Bajaj Finance has clearly outperformed the market. Again, this is on the back of basically two important data points. One is the Bajaj Finance itself reporting a decent set of number, kind of 20-25%, 23% kind of growth during the last quarter. And at the same time, they have unveiled a plan of next 5-year growth plan, where they have went on record to say that the AUM is likely to grow at 23-25% CAGR, and that will be driven by diversification in the other asset classes, wherein they will diversify the basket from which is predominantly focused on a consumer durable part of the financing and housing finance part. And on the top of that, obviously, we all know that there has been a lot of booster from RBI side, especially for NBFCs, wherein risk weight has been reduced by 25 percentage point, and that will be applicable from 1st of April. So that ensures that at least the AAA rated NBFCs like Bajaj Finance get credit readily available, and that will help them to lend on further to their consumer or clients, basically. So I think, again, entire NBFC is in sweet spot, wherein on the one hand, easy availability of credit, or that can lead to a slightly lower cost of fund. On the other hand, since there has been a consumption booster by the government of India in the form of tax cut, that can again add a kind of booster to the consumption, and that can drive the demand for consumer finance also. So I think Bajaj Finance, or for that matter, any consumer-facing NBFCs are likely to do well over the period of next 2 to 4 quarters.
Okay. I want Kunal to just weigh in on some of these names. Kunal, I know you talked about REC, but you saw a similar move in PFC, and also would you be able to talk about the Bajaj twins? How much steam is left in this rally upwards?
So Alex, again, in this entire rally, if you check our past discussion, we have always been suggesting Bajaj Finserv, and the only reason being the counter was in positive trend. Now my concern on the Bajaj Finserv is that, again, if you look at historical data from October 2021 so far, this counter has consistently faced a resistance near 1935 to 1950 kind of levels. And what we saw, again, just 3 days back, it exactly hit the high of 1938 itself, and now it's down. I will be cautious on Bajaj Finserv. The trend is absolutely positive. There is no trouble. But if the counter reverses from 1800 mark or say 1775 mark, then I'll participate. But otherwise, I think this is the time to book the profits on this. When it comes to Bajaj Finance, again, that's extremely strong counter. There are no previous highs. It's trading in the all-time high territory. People might be fearful in buying such counters, but unless this counter breaks 83.50, I think one can stay long on this counter comfortably, and the targets can be as high as 8,850 to 8,900.
Understandably, because of things that happen in the markets, there are a few narratives that get created. And very clearly in 2024, one of the narratives was that promoters are selling. Valuations are looking ripe for them to take some money off the table. And very quickly that pendulum has swung the other way, because at this juncture you're seeing a few promoters that are coming in and saying, hey, hold your horses, the price has fallen too much, I'm going to go and buy. Let's talk about a few stocks where you're seeing some of this action take place, and it's across sectors actually, so it's an interesting list. Varsha joining in to tell you about where this action is taking place. Varsha, a few interesting stocks on that list?
Absolutely. So significant promoter buying activity has seen across several sectors. Notable transactions include in the agrochemical space, wherein Agrotech Foods saw promoters add over 25,000 shares, while Best Agro Life saw nearly 40,000 shares bought. BCL Industries witnessed a substantial increase with promoters acquiring over 1,50,000 shares. While if you see the real estate sectors, Godrej Property saw a significant purchase, while Sobha also added 20,000 shares. La Opala RG in the consumer space had promoters pick up almost 51,000 shares, while in the infrastructure and engineering sector, NCC saw 4,000 shares added. D Development Engineers saw around 24,000 shares purchased. Jindal Drilling saw over 23,000 shares added by the promoters. And in the manufacturing sector, if you see Shakti Pumps, TD Power Systems and Usha Martin also seen the promoters of these companies have added shares, while Sesha C Paper saw almost 10,000 shares purchased by the promoter. Lastly, if you see these broad-based promoter buying activities suggest confidence of the promoters in the respective companies.
And certainly an interesting list, right? You're talking about a couple of realty players, La Opala. You're talking about Jindal Drilling, Shakti Pumps, quite an interesting list to say the least. But Sunny, I want to come to you on a pack that we highlighted in the morning, of course, and we spoke about the fact that crude oil prices, and here I'm talking about Brent crude at 71.25 or close to 71.5. You have an update that says that the OPEC Plus is going to go ahead with supply increases in April, and that is likely to put further pressure on the downside for oil prices. What does that mean for oil marketing companies? And again, you're hearing murmurs that the GRMs are inching upwards. It's possible that the bottom has been hit for them?
Yes, definitely you are right, Alex, that valuation for all the oil marketing companies are very attractive at the current juncture. So what we have seen, just to go back 2 quarters back, September was a quarter where GRM has crashed significantly, and that led to the a dip in the earnings for all these oil marketing companies. And then we saw recovery in the December quarter. And now GRMs as of now are in a very stable range-bound manner. And at the same time, the correction in the crude oil prices. So there was a worry that with the sanctions on Russia, whether the discounted Russian crude oil will be available for the domestic oil marketing companies. But now, when the overall crude oil prices have corrected, definitely it augurs well for all the oil marketing companies. And I think the exposure towards the petrol, diesel, or for that matter, retail fuel is the more for IOC and HPCL. So I think if I have to prioritize the amongst all the 3 oil marketing companies, it will be IOC, HPCL, and then BPCL.
The thing is, one, that what it does to OMCs, the second is what it does to some of the upstream oil companies, right? And Reliance was a key loser yesterday. I'm not saying just because of oil, but there was a large loss in Reliance Industries yesterday, and it's now down to levels which seemed a bit unthinkable a few weeks ago.
People are talking about 1,000 on Reliance, right? And whether that's going to be broken now.
Yeah, so pretty interesting here. And therefore, actually, Kunal, it's a good question to ask you. Where do bottoms get formed in Reliance?
So Neeraj bhai, again, as I've been saying that we look at the trend, just let's go back and check out the levels of June 2020, that's 777. And post that we had April 2021, where the counter was at around 850. The third bottom, which I'm considering, is April 2023, that's 1000. If I connect all these, if I look at the trend, it's looking absolutely comfortable to me at 1170. Now coming to the point whether we should be buying at this level, I think this is the good level where one can think of initiating buys if the counter stays above 1160. If the counter stays above that, I think a good derivative strategy can be created by the traders, and that's long on futures and short straddle. Because I don't foresee the counter coming up vertical, V-shape, but if the counter consolidates even at this level, I think short straddle can give us good returns, and at the same time we stay on the long side of the market. So yeah, with 1160, I think Reliance is poised for a good buying opportunity at this level.
Okay. Certainly watch out for this stock, because this one, along with HDFC Bank, proving to be a drag for the benchmark in trade yesterday. Let's see what it does at the start today. But let's talk about Canfin Homes. It's something that you should put on your radar. Morgan Stanley has maintained an overweight rating on the counter after they're meeting with the management. The target price is 885. The stock price is 578. So very significant upside is implied there. Harsh, why are they so bullish on this counter?
Yeah, I'll break this up into three. First off, with regard to growth, they've reiterated growth guidance for FY25. Also, reiterated guidance of mid-teens growth in FY26. So, growth expected to stay solid with regard to the overall number. Disbursements, therefore, in Q4 will be roughly 2,400 odd crores. So, healthy pipeline in that sense as well. Second, with regard to situations in specific geographies, e-registration situation in Karnataka continues to improve, they say. Telangana market, though, remains tepid and may take some time to improve or turn around. So that's one space or pocket opportunity, in fact, which could see a bit of a turnaround as well. Third piece, with regard to margins and ROAs. Margins expected around 3.7%. They reiterated that. ROA, they are suggesting will be roughly 2.1 to 2.2%. That's the kind of band or range they've given. And 2.2 is what they've done in 9-month FY25. So largely around that number. And therefore super positive overall with regard to both the commentary, which is largely steady, but the target price seeing almost or reflecting at least a 52% upside from here.
And that's exactly what I want to ask Sunny Agarwal about. Sunny, it's one thing to be positive, and of course, some of these stocks have seen a massive re-rating on the downside, right? But 52% upside from the current market price would imply a very significant earnings growth from this point. Are you as sanguine on this counter?
So Alex, within the public sector linked housing finance companies, we are more bullish on PNB Housing Finance, and that's one of our pick as far as housing finance sector is concerned. And the reason being that we have seen a kind of turnaround during the last 4 to 8 quarter post change in management. Right now, the company is focusing on a prime segment, which is a relatively higher yielding segment for PNB Housing, and that's an affordable segment. So the yield is slightly higher over there. So we believe that with an improvement in asset quality and a shift in loan mix towards the affordable segment, the NIM is likely to expand. And recently we have seen a rating upgrade also for PNB Housing. So cost of fund is likely to go down. So we believe the fair value of PNB Housing is in the band of 1,000 rupees. So I think we are recommending PNB Housing as compared to Canfin to our clients.
All right, so PNB Housing over Canfin. Just a few minutes away from the start of trade, we have to slip into a very quick break. We've got more stocks to discuss. We're looking at a downside at the start, gap down in fact, and watch out for that 22,000 mark. Do stay tuned.
Very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have a loam. You can't just keep doing up and up in the breathing also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers, and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various ports.
Actually, instead of Viksit Bharat, we should call it Reviksit Bharat.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential.
Welcome back. You're watching India Market Open, and let's talk about a few more stocks that are in focus ahead of the start of trade. And I'm just wondering whether a pack that was gaining in trade yesterday, and that's the Realty pack, after a while you saw green on the screen for this entire pack. In fact, it was one of the top performers. Kunal, any opportunities that you are seeing on the upside for some of these counters that have consistently gotten beaten down over the course of the last several weeks and months?
So Alex, the only counter which I like as of now, where the trend is still okay, is the Oberoi Realty. Now this counter has come off from the highs by around 38%, and it's near to the previous massive high that was made somewhere in May 2024, where the counter was up by around 1.5 to I think a 2.5% in a week itself. So I think that, considering that, we can consider that previous bottom as a good support. 1460 is something to watch out for. If the counter holds on to 1460, then I think we can think of initiating a buy. But again, just one tick upside might not be the only reason for me to buy. So I'll wait for a while, wait for the consolidation, and then initiate a buy on it.
Okay, market. So just the pre-market rate just about hit 9 o'clock, and we're just waiting for the dust to settle at this juncture. Of course, may not get too much of a trend at the start. But let me go across to Sunny on this one, right? Because we've looked at earnings and we've looked at some of those pre-sales numbers for the realty companies post Q3, and they've not been a pretty picture. But there are still narratives that are in place with regard to the demand at the ultra luxury end of the spectrum, right? So if you were to be a buyer in some of these realty companies on the back of fundamentals, which would they be and why?
Yeah, Alex, so I think we believe still some micro markets where there is a rapid pace of infrastructure development, a case in point like Mumbai. So we believe Lodha developer, which is a macrotech developer, will be one of the beneficiary over the next 2-3 years. We have already seen they're one of the flagship township, that is a Palava, which is close to Dombivli, as the connectivity has improved significantly, and that's a pretty large project as far as macrotech is concerned. And at the same time, if you look at the balance sheet continues, the company is on the continuous period of deleveraging their balance sheet. So again, that augurs well for the players like Macrotech. And on the top of that, Macrotech is gradually diversifying from its volatile segment like residential sales to an rental business income through malls and offices. So I think it's a mix, many factors which are playing for players like Macrotech. And again, it's a large cap player doing well. So I think Macrotech is one of our top pick as far as real estate sector is concerned, and we believe the fair value is close to 1,300 rupees. Another smaller player from Mumbai market, Sunteck Realty. trading at a very reasonable valuation, and at the same time, the similar story of diversifying into the rental annuity portfolio over the period of next 2 years, focusing on a high demand pocket area like ODC, which is basically close to Goregaon belt. I think Sunteck Realty is another pick which we like. From Bangalore market, we like Brigade Enterprises. If you look at Brigade, very solid set of numbers they have reported with an very strong pre-sales number. So Brigade again trading at a reasonable valuation. So these are the few players which we like from real estate bank.
Okay, now, just before we get in our next guest as well, here's what's striking to me. A lot of talk around how the markets have retreated, and yes, that's all true. But here's some key data points or some observations. One, that the market is now falling so I want to say the reverse really. So while my page says this, the lower volumes are dragging the market, I'm saying that the market now is falling on very low volumes, and which is actually a good sign, because typically if market falls on very heavy volumes, that means that there is incessant selling. Now we are seeing are we coming to the fag end of this selling? Because typically that's what happens, that when the market is coming at the end and trying to bottom out, the last part actually could happen on very low volumes. So Feb actually saw the lowest average volumes traded in the last 1 year. So ignore this, okay? But the average turnover in Feb was at 75,000 crores versus a peak of 1.3 lakh crores that we saw in June. So the volumes have come off. Maybe there's a chart which shows this as well, but if not, the other piece that I do want to, right here. So look at this, right? The average turnover, and look at the average turnover that happened in June. Now you could argue that June was the election, budget, etc. But look at the petering down of volumes out here. And we are at the lowest level, lowest volumes since maybe November 2023. This to me is very striking. The other piece is, yes, you shouldn't look at the small cap index as an absolute index because it's a very diverse index. But here's some data, and let's get the data on the valuations of the small cap index if we can up next. So the small cap 250 is trading at 21 times FY26 EPS of 650. Now FY25 EPS is at 605. So I have only taken in the Bloomberg consensus estimate is estimating only 9% growth for the small cap 250 in FY26, which, well, you could argue is conservative, even if it is not. You may argue let's assume that you believe that this is optimistic. I think that would be wrong, because typically people would presume that earnings growth of the small caps would be between 16 to 18%. Here, the assumption is only 9%. The 10-year average of this index is about 28 times. We are already trading at 21 times FY26. Are we coming to the end? And remember, Quant MF does believe so, because in the morning note that they have put out, Sandeep Tandon and team, they say that they are now actively participating. Okay, here's the quote. They are saying that the Nifty 500 represents the top 500 companies based on full market capitalization and average daily turnover from the eligible universe. Let's move on. I think the more important part, effectively initiations about the free float, etc. But let's go towards the end of the note, because that's the key thing. What Sandeep Tandon is trying to say via this note is that because they are seeing valuations looking attractive, they are actively participating in mega large caps, and the mid caps and the small caps as well. So the street and select pockets are starting to turn bullish. Let's ask Ajay Bagga if he's turning bullish as well or not quite as yet, and why so. Mr. Bagga, thank you so much for joining in. Would love to understand, where are you on this argument? Is this the time to buy the dip, or is this still the time to stay on the sidelines?
For me, especially the retail audience who favor your channel, Neeraj, I would say every time is a buying time, and you should regularly keep buying. Now, as far as the bottom of the market is concerned, mathematically we can prove that, okay, now the valuations are this, valuations are that. One, valuations is an art. It's not a science. We don't know if it will actually come at 9%, or as you said, it might be 7, it might be 11, it might be 15% earnings growth also. So we have to look at history. We have to then aggregate it company-wise and make a portfolio. I would say we are probably about a couple of months into the bottoming process. It will take time. It won't happen very rationally, very scientifically, that the market participants will realize that, say, the Nifty is now below its 10-year average trailing PE, and now let's start buying. That won't happen. Mostly the momentum on both sides, Neeraj, it takes the markets up or down. So there is an overshooting that happens. Right now, we might be in the overshooting. That we will know a year down the line that, yes, this was the time when the turn should have happened, but the market overshot and then it made a turn. But definitely, yes, it's not the September end market of all-time highs. Is it going down 10% more? I don't think so. I think there's a very little probability, unless there is some shooting war or some geopolitical big event comes in. I think overall, the tariffs of Trump will not have that big an impact on India. They might bring in recession in pockets of the world. So that issue remains. But overall, I think we have weathered it well and we are near to the bottom. Now, whether it happens this week or 2 months down the line, it's an art. It's not a science. And I would say these numbers just give you an idea that now it's looking good. Is it very compelling? I think right now people are really hurting, with the 94 lakh crores of valuations that have evaporated. It's tough to tell people to bring in chunks of money. I would say regular money over the next 6 months, keep investing, because first the bottom will form. Recovery will take time again. Recovery will follow corporate earnings. Now we have a base effect coming in from June quarter. You will see better year-on-year numbers coming in because the slowdown really happened June and September. December, we have seen the small incipient recovery starting, and probably earnings bottomed out in December. So the next 9 months from April to December will give you a good base effect. And then markets will react in anticipation of that. So I think bottoming maybe 2 to 3 months from now, and then recovery takes another 3 months. And by year end, hopefully, we would have reached back where we were in September of 2024.
Ajay, hi, morning. Alex joining in as well. And your point is well made. Very tough to call levels and when that bottom is hit. Of course, the wisdom of retrospect is flawless and all of that. But I'm just wondering how you're positioning yourself, because there is word that some smart money is also venturing. And I know that the large conversation has been around finding quality, finding solace in the large caps. But some smart money venturing towards a few mid-cap names also that have gotten very heavily battered over the course of the last few weeks. How are you positioning yourself?
We have to go with free cash flow in this kind of a scenario because we are not in an early cycle. We are in a late cycle. It is a structural growth story of India. It is a structural bull market. It has got broken on the small cap, mid cap parts. So it is definitely, we have not seen capitulation. If, capitulation had happened, another 10%, the markets had gone down in 2 weeks, you would have happily said, go all in. I think that has to still come in. So that's why I'm worried. The issues are not anymore domestic. I think domestic, we have turned the corner. It was unfortunate that the 4 months of national elections delays and then the budget coming in by July. Around September, we were as much as 30% behind in terms of the government expenditure. We have caught up to about 9% behind now. And there have been big chunks coming in December. The capex went up 91% year on year. January, it went up 51%. So heavy lifting has started. We'll probably end at 9 lakhs to 9.5 lakh crores of capex for the full year. But it's giving good momentum for April. And then the consumption boost of 1 lakh crore starts hitting it, say 8 lakh crores, 8,000 crores a month starts coming in. So we'll enter April with a better momentum. Year on year, earnings, Neeraj, will look better come July as the June numbers come in. So we are heading up. We are setting it up. But smart money, all that, there are even options right now also. If you find fairly valued stocks with good free cash flow, the narrative stocks you have to avoid because this is late cycle.
Yeah. Okay, that's a valid point. Free cash flow is what you need to hunt for. Avoid narrative stocks. Mr. Bagga, stay on. We're 2 minutes away from market open. Harsh, I'm going to come to you for 1 minute and 1 minute sharp. The big brokerage call of the day. Tell us what it is.
Well, good morning, Neeraj. Point noted. So we've got CLSA, third note where they've upgraded to a high conviction outperform this week alone. And that's why it's looking interesting. They've reduced the target price from 802 to 770 on Varun Beverages, but still reflects a 70% upside from here. Stocks corrected 28%. Now believe risk reward is very compelling. It's underperformed due to multiple concerns, but primarily due to competition from Campa Cola, and come to that. But capex as a percentage of sales has peaked in calendar year 23, was elevated in calendar year 24 as well, and set to reduce now. So scale is going to start to kick in. Total addressable market is fairly large. PepsiCo is venturing into snacks, and Varun Beverages' contribution to that is going to also kickstart growth or kind of push growth higher. You're going to they've assumed, CLSA has assumed that Campa Cola's price for entire glass bottle portfolio will be competitive enough for, or Varun Beverages will compete against that, largely on the back of both margin, better margin that Varun Beverages does, and a value shift. Earnings estimates trimmed by 4 to 5%, and despite that a 70% upside. So very, very interesting, this one.
Wow, Harsh, I'm impressed. You stuck to the minute. Thank you so much for that. But that's CLSA on Varun Beverages. Watch out for that stock. Kunal, very quickly, 30 seconds. We are starting below 22,000. Is that significant, or are you watching for 21,800? Quick 30 seconds.
21,800 is something to watch out for, sir.
Okay, but so below 21,000, 22,000, is it a big deal, Kunal?
Not really. Looking at the trend, I think this levels are absolutely fine to hold on for now.
Okay, so looking at the trends, these levels are absolutely fine to hold on for now. 21,800 remains the key thing to watch out for. Gentlemen, stay on. We're just very close to the market open. Keep in mind, the news flow is not that heavy today, but let's wait and watch what the tariff tantrums do to specific pockets. Some of it might be discounted already, but some of it might not be as well. So that is the important thing. And we'll, of course, get you what some of the big voices in the street are saying as well. Mr. Bagga is with us. A bit later, Manish Dangi joins in as well. So lots to understand. But here's how the markets are starting off. Below 21,000 or just around below 22,000, excuse me, or around that 22,000 mark for whatever it's worth, looking to defend it. Mid caps 1% lower, small caps I would reckon 1% lower. IT should come up on your screen, just see what that is doing. 1.38%. This index is not finding favor. Let's get the heat map up on the screen and show you what's moving and what's not. Well, except for a couple of large banks, the top 3 banks, very interesting, and then a TCS thrown in and an ITC thrown in. So some heavyweights out there helping the index stay afloat. This is classic stuff, but look at the losses here. So ONGC, no one would be disappointed really, because this is on account of crude falling. But HCL Tech, Wipro, Infosys, all of them being hit. Nestle, Adani Ports, it shows that even the stable names are coming under pressure. BPCL, interestingly, oil price downtick should be positive for OMCs, but nothing doing. All in all, Alex, you might have better luck at spotting names, but the Nifty quickly gave way. So not quite holding on to 22,000, but as Kunal said, 22,000 was not as important a level as 21,800 would be.
Yeah, no doubt. And that, I guess to a certain extent, we were building into this based on what we saw across the globe. And Neeraj pointed out to you, the news flow is not very heavy. And so not too many stocks to talk about on the individual level. But let's talk about the sectors, right? You saw IT under pressure yesterday. It was showing as a pocket of strength. What does the sectoral map tell you? And well, it's a sea of red at this juncture, right? So let's talk about what's moving. Oil and gas. 1.8%, 1.7% lower, and in fact even the oil marketing companies under pressure today despite the fall of crude prices. We'll talk about that in just a bit. But you have realty that's under considerable amount of pressure today, down about 1.8%, 1.9%, nearly 2% at this point. You have energy that is lower. You have everything from IT, which is down about 1.8%, 1.7%. Auto is pack also down over 1% or so. And right on top of the list, maybe to a certain extent, you're seeing a little bit of resilience as we've been seeing in the financial names, with the Nifty Bank only down about 0.1% or so. Let's see if any strength is built through the day. Hope for that to take place. But let's look at a few individual stocks now. And Time Technoplast was on my list because it's adding a new product in the polyethylene pipes space. Let's see if there's a positive reaction to this. No, not even here, where you're seeing an outlook of 30% growth here. Even here, the stock is down about 0.7%. Let's pull up something like an IEX, where the volumes have increased by 9% in February. That is not being looked at positively either, down 2% in trade right now. IOC, BPCL, HPCL, we were talking about this. Let's see the extent of the declines, and boy, that is sharp as well, all down over 2%. So nothing is really being looked at in a positive light in trade today. Canfin Homes, Morgan Stanley, on the back of several factors, sees a 52% upside on any other day where the bulls might have had a little bit of steam. You would have seen the stock react on the upside, but today it's down about 0.2%. Godrej Properties, the promoter, is buying 1.3 lakh shares. Stock is down 2.4% or so. Azad Engineering, the company has raised 700 crore rupees in a QIP, down 1.6%. And what about the stocks that have gotten a thumbs down rating? Suraksha Diagnostic, it's yes, so there you go. Stocks where there's just a whiff of a negative sentiment getting beaten down very, very heavily, down about 6%, because you have a significant portion that is exiting the lock-in period, and so selling pressure is evident here. And Havells, where you had BofA that retained its underperform rating and cut its target price. In fact, you have a downtick of as much as 2.3% in trade. So Neeraj, I guess the thesis is that where there is even a whiff of negative news, there is a beating down that is taking place, and even positive news is being discounted.
Yep, positive news are getting discounted. Now, I wonder what trades exist. Kunal, I'll come to you first. It's not looking good. The breath is terrible, to say the least. What do you do in a scenario like this from a trade perspective?
So Neeraj bhai, again, we have, if you look at the index, I think Bank Nifty is clearly outperforming. Now it has turned even positive. So from the trading point of view, I think those counters which are participating in the trend should be picked up. First is SBI. I think with the stop of 690, one can go long. This counter is doing good. It actually lost the ground, but trying to reclaim the same. So with the stop of 690, one can go long, and the targets can be 715. And the second is ICICI Bank for the week and for the day also. I think with the stop of 1200, which was the consolidation zone for last 15 to 20 days, one can go long, and the targets can be 1235 to 1240. So these are the two counters as of now to watch out for.
Bullish. And I'm going to come to Mr. Bagga on IT because that's the pain point. But Sunny Agarwal, let me come to you first. As a house, are you telling clients to buy into any of the high quality SMID names that Mr. Bagga was referring to? For example, look at companies with cash flows, because that is very important in a late cycle, right? So I'm trying to understand, as a house, are you going out and telling clients to buy into some of those high quality SMID names, or not quite as yet?
Yes, definitely. I think, Neeraj, so we are advising a staggered buying over the period of next 2 to 3 months with an investment horizon of at least 24 to 36 months. And we are recommending quality name across the sector. So case in point within BFSI, especially on a private banking side, we like stocks like ICICI Bank, HDFC Bank, Federal Bank, Karur Vysya Bank. So these are the few banks on private sector side. NBFCs we have discussed earlier, Bajaj Finance, PNB Housing continue to remain our top pick as far as NBFCs are concerned. On capital market, although the sentiments are against the capital market as a story, but I feel within capital market, AMC businesses, so whether it is HDFC AMC or Nippon AMC, where if you look at a long-term structural growth story, that is still intact. So quality names from AMC like HDFC and Nippon, these are the few stocks we are recommending. From auto, Mahindra & Mahindra and Escort, purely on the back of increase in volume for tractor as a segment, and at the same time for M&M SUV portfolio continue to do well. Among the consumption play, we are recommending some companies from hotel and jewelry space like Indian Hotel and Titan. So these are the few quality names which we are recommending from various sectors.
Okay.
Well, like I was saying, I wanted to ask Mr. Bagga on IT because, he's got this wealth of sell-side experience, has looked multiple cycles. Mr. Bagga, this time people are saying that this time it might be different for IT because it's if not an existential challenge, a change of technology and not a one-off event like a Y2K or something else, which might disrupt the business model. How are you thinking about it? Because clearly, Indian IT is getting pummeled in the last few days.
Absolutely. And I think DeepSeek really represents an existential risk for Indian IT. China has invested in building up its AI capabilities. We are lagging to that extent. We need to catch up. What will be very interesting in the April management guidances and commentaries, Neeraj, would be how are the use cases coming up? If you see, the big majors have been saying they have like 250, 500 use cases now ready. They are helping companies implement various methods of automation, digitization, AI usage. But we will have to really see how is that coming around, and the Indian model of a competitive cost advantage on the low end of IT services is getting challenged. If a lot of that gets automated, then we are in trouble as an IT sector. And as a nation which benefits hugely, it helps us to balance our external balance sheet. So it's very critical that our IT majors and our IT companies evolve their business models. It's not coming through yet. And the rapid evolution of AI is really posing an existential challenge. So, and it will have a very deep-rooted impact on India, be it on the GCC end, be it on IT services, the pure play IT software end. I think if a lot of that goes the AI route, we will be in deep trouble. So that is what's I would say, the major question for the market, that how does this evolve? And we'll start getting some answers with the management commentaries in April.
Okay. All right. So that's the perspective on the IT side. Ajay, I'm just wondering, I'm wondering about, and you spoke about the low base effect or the base effect kicking in the June quarter, right? But I'm just wondering in terms of, and I was talking about the April salaries kicking in, where you're seeing consumption likely going to come in maybe April, May onwards, hopefully, where people have more money in their hands and hopefully increments also take place, all of that. But a lot of people betting on consumption names. What would you be talking about here?
The consumption, we've had an issue, but if you look at the December GDP growth number, the private consumption picked up 6% plus. So it is coming back. Urban consumption was the big issue, and we are seeing that be it in the automobile numbers, even in the plateauing of real estate. The premium real estate is still doing very well, but the overall average real estate, there is a plateauing happening. So overall, we have a consumption issue. We have an aggregate demand issue. The good news is with the new RBI governor, we have seen macroprudential breaks being removed. And that is, just say the NBFC lending book itself, if you look at 16 lakh crores, is what banks would have outstanding on the NBFC side. As the risk weightage reduces from 125% to 100, that is freeing up a chunk of money which can go into further credit. We saw the January numbers yesterday, 14% growth in personal loans. So clearly there was a slowdown which was engineered by RBI, who was quite rightly worried on the unsecured lending. We have seen the MFI issues coming in, but the MFI damage is about 50. The exposure, I would say, is about 50,000 crores. Mostly the companies have moved on. They have taken provision. So from here on, you will see recoveries. You will see MFIs selling off those loans to ARCs and releasing some of the provisions. Third part, which will be very critical for consumption, is where do interest rates go from here? There is a need for a monetary policy which is less restrictive. We saw the liquidity which had become very massively negative because of the RBI's protection of the rupee, the $70 billion that were spent out of the FX reserves in protecting the rupee, that sucked out a lot of market liquidity. RBI has been bringing that liquidity in a very calibrated manner because they don't want to push up inflation by pushing in too much liquidity. So they have done macroprudential, they have done one interest rate cut, and they have brought in liquidity. Come April, I'm expecting one more rate cut in the next RBI meeting. That should come through because the economy really needs now that kind of support. People might say, what does 25 basis point make a difference and this, all these kind of things. But on the margin, it has an impact. It takes 6 to 12 months to translate into the economy. So you're already late. It's good to start that process. One rate cut has happened. Second should happen hopefully by April. On the fiscal side, you are taking out 40 basis points of GDP in terms of the reduction in the fiscal deficit. So that much of a fiscal constraint is coming onto the economy. How do you grow the aggregate demand in that kind of a manner is by front-loading expenses. So we are expecting that come the new year, the government will really front-load a lot of those expenses.
Yeah, Ajay, point well made. Thanks so much for joining us this morning and for giving us your perspective. And indeed, thanks so much, gentlemen, Kunal, as well as everybody else on the panel, Sunny, for joining us today and for all the conversation we had. Let's talk about markets though, and we've come off the low point of the day, quite considerably so. Of course, for the benchmark Nifty 50, still trading with cuts of about 0.5%, but now 22,000 has been reclaimed. Let's see if that level gets defended by the bulls. And on the broader end, you have the mid-cap index that's come off quite considerably from the low point of the day. In fact, as much as 1% or 0.9% off the low point of the day, 1% from the small cap index perspective of the low point of the day, now trading with cuts of just about 0.2% or so. And in fact, it is quite considerable. In fact, it's a reclaiming of more than that for the small cap index. Some part of what Sandeep Tandon has said in that note that came through, right? Neeraj was making this point earlier. What they're saying is that they're participating in both large and mega large caps while selectively increasing their small cap exposures in most of their equity schemes. And what we have done is we're actually looking at some of the data that we have for the portfolio disclosures of last month. Of course, just in the next 3 or 4 days, you will see some portfolio disclosures of these funds come through, and you might actually see an interesting picture emerge for some of these companies or for some of these funds. In the quant small cap fund, based on the latest available data, actually on the cost basis, they had actually fallen to 63.2% allocation to small cap. By the way, the regulatory allocation is 65%. So remember that on a cost basis, they might have been 65%. It would have fallen based on the AUM number. And this is quite considerable, right? So it's for an average of the category that is about 73% for the small cap index, 73%. So if you look at all actively managed small caps, the category average, Neeraj, is 73% and the regulatory requirement is 65%. So small caps having brought down their holding of small caps to about 73% of portfolio is telling, right? So if they're saying that they're going out selectively to buy, it's positive.
Yep, he said it in an interview as well, but now just that actively looking at everything, because the trading bottom is round the corner. I think that was a key thing as well. Yeah. Let's see if it turns out to be true or no. In fact, on that note, let's move focus to some corporate conversations as well, because like we've been saying that a lot of stories, the pendulum has swung one way, viewers, to the point of pessimism or bearishness right now, and ignoring some of the good news and commentary. So therefore, we are trying to get companies to understand how confident or not confident are they about the short, medium and the long term with regards to their business. And a very important voice with regards to on that topic, on the topic of energy transition, wind energy and Suzlon itself, Mr. JP Chalsani, CEO of the Suzlon Group, Johnson right now on the show. Mr. Chalsani, thanks so much for joining in and taking the time out. Really appreciate your time this morning. Neeraj here, good morning. With me, Alex, of course. I'd love to understand, sir, there is some, because the times are tough, right? Small misses get thought of as big ones. And I would love to understand whether you believe that the delay of signing of PPAs, slowdown in power demand reflected with Coal India's lower offtake, does all of this spell some gloom, or do you believe this is a passing phase?
Yeah, I mean, Neeraj, the power sector can never be looked at from the point of view of 1 quarter, 2 quarters. Okay, power sector is always a long term. As long as the country is growing, power sector will continue to grow, because your elasticity between GDP growth and power growth is almost 1. So there is no question of the power demand coming down at all. Okay, it will never happen. You can't look at as temporary blips here and there and say that power demand is coming down. That's number one. Number two is that the issue you talked about, PPA signing. Yes, there are a few concerns about accumulated the projects which have been LOA been issued and PPAs not signed. But I think that's now happening, because you also need to understand the process is that once the bidding is done, if the multi-state PPA, it goes to each state regulator, all the state regulators have to approve, then it goes to CERC to get it approved before the PPA is signed. There's a process, because there's a sudden accumulation of projects, you feel that way. But I don't think any of these issues are going to halt the energy transition targets what you put in, and we are right on the track.
Okay, here's my question, sir. There were a lot of targets laid out, right, for wind and for overall energy transition till FY30, etc. You believe the country is on track for that? Because I'll tell you where the small, not a dichotomy, but a lesser understanding to mere mortals like us versus you comes in. We look at the guidance provided by companies like you or some of your peers. Maybe that gives visibility till FY26, till FY27, and then there are targets set up till FY30, and nobody knows what happens in that period between 27 and 30. So I would love to understand from you, while your con calls give an idea about what is likely going to happen till FY27, your answer right now tells us that don't look at it on a quarterly basis. Is there some soundbite or some thoughts that you can lay out for us for what happens beyond FY27 as well?
Neeraj, let's divide it into two parts. You can always look at quarterly basis for a company specific issues. Okay, that's fine. You know, all our stakeholders want to see us quarter on quarter basis. We are more than willing to talk about quarter on quarter basis. But when you look at the sector level, the 2030 targets are well laid down. All of us know 500 gigawatts of renewable energy. Out of that, 100 gigawatts is wind, 400 gigawatts is solar. Wind today we are almost at about 48.5 gigawatts today. Let's say an inch towards 50 gigawatts by the end of this year. Obviously that there are 5 years left out and 50 gigawatts more to be added. Needs a run rate of 10 gigawatts per year. The question everybody needs to ask is that, okay, today we are running at 3.54. For example, this year till about Feb, we did about 2.7 gigawatts, might touch around anywhere between 3.5 to 4. And what level do we reach? Do we reach 100 gigawatt? Do we reach somewhere close by striking range? There are different estimates of what is going to happen. If you look at the latest CRISIL estimate, which came out last week, they're talking about from next year onwards, it will double to 7 gigawatts a year. If you take 7 gigawatts in a year, we reach 85 gigawatts. Okay, But 7 for a couple of years, run it, and then subsequently go to 8, 8.5, you will touch 90. In my opinion, we gave guidance earlier also, is that we think it will be anywhere between 80 to 90 gigawatts we should be able to reach. But 2030 is not a full stop. It's a comma. We still have targets till 2032, we have targets till 2047. Okay, this will continue. Only thing is that ramp up, maintain that consistency, and the wind sector will continue to grow for the next couple of decades. I have no doubts about that because the country needs that power, not just the wind, the power needed and renewable energy is required. So there could be a temporary blips here and there could be temporary frustrations. People keep saying things are not moving, but on a long-term basis, I don't see any concern in this.
Okay. Do you, Mr. Chalsani, do you reckon that as a nation we can do more than 5 gigawatts per annum? Do we have the capacity to do that? Do we reach 7-8 gigawatts per annum? And when do we do that?
Neeraj, FY 17, as a country, we did 5.5 gigawatts.
Okay.
Those are 2 megawatt turbines. If you convert them into 3 megawatt minimum, which is everybody is doing today, that capacity itself is equal to 8 gigawatts today. What we had done in FY 17 was 8 gigawatts. So it's a proven track record. It's a question of a temporary issues like your land getting delayed or your evacuation getting delayed is the issue. I don't think we have any issue on capabilities because since FY 17 to now, our actual execution capabilities, number of parties who are there to actually do the project execution has gone up significantly. So therefore, I don't think that's an issue. It's not an execution issue per se. It is more on ground resolving the issues like land, ROWs, and then your evacuation system coming on time. Those things are not a permanent issues. Yes, last couple of years we faced these issues, but with concerted efforts of all, including government and the players, you're actually seeing the results. In fact, the next year itself will start seeing the results. Then next year, definitely, whatever we do this year, I expect that next year we'll double the capacity.
Okay. Mr. Chalsani, Alex joining in as well. And your points are very well made. The challenge, as you've pointed out, is on the land side. And I know that you've not jumped whole hog into offshore as an opportunity because there are challenges that exist there as well. But I'm just wondering, at some point, and I think there was an attempt that was made by the administration to maybe make it more lucrative. Do you think enough has been done? Do you think more can be done? And if it is that something that will significantly aid addition of capacity?
See, offshore is good to look at for us, and then it's a long-term goal. Is it going to move the needle in the next 5 years? I don't think so. Because even today with two states where 500 plus 500 megawatt, we're thinking of doing it with viability gap funding. There are still concerns in the sector that even with the viability gap funding, do you get a tariff which will attract, or the tariff is declared already, 4.5 for Gujarat and 4 rupees for Tamil Nadu. At that tariff, the project become viable. And second is that the offshore, you need to do it, you need to have the size. So it's going to take time for us to get into offshore and stabilize that. I don't think we will have any capacity addition coming from offshore before 2030. It is something which we can look at, between 2030 and 2047 to get added. Right now, it's not going to move the needle. So therefore, we are there. We have capabilities, but I think at this stage, the efforts are on to increase the significant capacity addition onshore because in onshore, we still have a huge amount of potential. At 116 meters hub height, our country's potential is 1,200 gigawatts. We are at 48 gigawatts today.
Wow. Okay.
So that's the potential what is available. So therefore, while we continue to put in efforts to see we get onto the offshore, because offshore also gives you better PLFs, so therefore your intermittency comes down to some extent. But then we can't take our eye off of the main capacity addition going to happen in the next 5 years from the onshore wind business.
So 1,200 gigawatts is a potential. Of course, the target for 2030 is 100 gigawatts. So it's basically a small pail of water in an ocean, I guess. So, Mr. Chalsani, then my question is, and based on some of the commentary that you've given us today itself, that some of the challenges that you're facing in terms of acquisition of land or availability of land are being resolved even as we speak. And from that perspective then, your current order book, is it likely that the completion of those orders will get done on time, or is there likely to be a spillover right now, as things stand right now?
Yeah, our current order book has become like a one-day match. It depends upon what time you're talking, score keeps changing. Okay. As we speak itself, I think our score got changed by under 200 megawatts. As we said, at any point of time, the order book, what we will have backlog, we'll have a time schedule of 18 to 24 months. Because that's what is the contractual time schedule for most of the contracts we had. So older contracts will get deleted, whatever we completed, new contracts get added. So therefore, entire capacity would get finished by 1824. But what will happen is that you keep adding new capacities. So at any point of time, you would have a visibility of next 1824 months. Means like our order book is what you can see at any point of time is an order book which needs to be executed in from the date when we talk about 1824 months.
Okay. So I have two questions rolled into one. So therefore, Mr. Chalsani, if the order book, and we love that comment about it being a one-day match. I mean, we hope it actually becomes 2020 soon and the quantum of orders goes up even more fast, but be that as it may. Jan order book at 5521 megawatts. Suffice to say that it gets executed by Jan 2027. And on the newer orders, I believe in the con call you said that you will focus on high quality orders beyond FY26 for better margins. Can you elaborate a bit on that?
Yeah, see, when we talk about high quality, it is we need to define the parameters by quality. Normally, people look at high quality means that better margins alone, but better margins alone is not high quality. High quality orders are the ones which there is the complete certainty that projects will go through. So and then who is the counterparty, and counterparty risk is the least. And then more importantly, also we are also looking at is that are we not just in terms of making a business of wind turbine supply, are we actually helping in terms of carbon footprint reduction in the country? Okay. So I think there are a number of factors. For example, if we see the today's order what we did for JSPL's subsidiary, General Renewables, 900 megawatt is what we signed till date. Okay. Which is the single largest C&I order for us, and entirely going towards making the steel green. Okay. So I think this is what is the quality of orders when I mean. One side is that counterparty is very strong, and second thing is that the generation what our turbines are going to give is going towards reducing the carbon footprint is one. So therefore the C&I would continue to be our focus area, which is today 60% of our order book. The other focus area obviously is going to be the public sector. You know that we have the largest single order of NTPC, then we bid for one more project in NTPC, and the other PSOs are coming with bids. That's going to be other area where we again feel that they are very quality orders. And the third in the IPP sector, we look at projects are where the PPAs are signed. Every single project, what we are 20% of our order book is the bid PPAs. The entire megawatt, what we got order book is got PPAs signed. So therefore, we are looking at one is improving our margins, and second is matching with the time schedule what we can actually deliver. Third is it's adding to the carbon footprint reduction for a specific sectors where we feel happy about it. Fourth is these projects would actually happen on the timelines without much of a thing. Otherwise, you can have a large order book and you keep looking at it, but you don't know whether it will happen in 24 months or 36 months or 48 months.
Yeah. It looks good on paper, but that's all it looks like, right? So, but Mr. Chalsani, I wanted to ask you also, we've spoken about the potential of the domestic market, but from your perspective, you would also have an eye on the globe and the opportunities from the exports perspective. Can you lay that out for us also in terms of what your outlook is in the near term and perhaps over the course of the next 2 to 3 to 4 years?
See, obviously, when we look at Indian market for us, it looks great. We have increased our manufacturing capacity from around 3.3 when I met last time nearest year in our campus today to 4.5 gigawatts. Okay, and which we can further increase. So our aim would be, in fact, I told him that day is that our aim should be not the market share, but can we actually deliver 80 to 90% of our manufacturing capacity? While India is growing, will continue to grow. But when we are growing and when things look good, is the time for us to look at what next. Okay? Not when you hit a roadblock. Because at that point of time, you will take decisions out of desperation. So this is the time for us to start thinking about what happens a couple of years down the line. Obviously, the geographical expansion with the least risk could be one of the possibilities. For evaluation at this stage, we're not saying that we're not getting into it. We have an experience earlier, we've done it earlier. We also have a lessons learned from earlier, whatever we have done. So therefore, there is a good potential outside today. We are looking at each market, evaluating each of the markets, whether it is US or Europe or neighboring countries. It looks very exciting. And also more important is that the number of European companies today are exporting from India. Okay? Huge capacity is getting exported. We believe with a reasonable confidence that our manufacturing cost is lower than anybody else in India. And if they can export and still make margins and they are competitive in external market, we believe that directionally it shows us that we would definitely be competitive. So therefore, that's obviously we will look at it, but without taking our eye away from the domestic market.
Mr. Chalsani, thanks so much for joining us this morning and for giving us the perspective that you did. Absolute pleasure having you on the program.
Thank you so much.
Neeraj, I was just looking at the data that we were speaking about. Very quick point that I want to make. We were speaking about the Sandeep Tandon comment and the fact that they're going to be buying selectively in the small cap space. I was looking at the latest disclosures for the month of February, and for their small cap fund, they have a 64% allocation towards small caps. In their flexi cap fund, which everybody obviously knows is a mix of all and is a free slate for the fund manager, they have a 72% allocation to large caps, 9.9% to mid caps, and 12.2% to small caps. So it's open for them to invest quite a considerable amount in the broader markets right now.
Well, let's see if Sandeep and team turn out to be right. A lot of people are echoing that. I wonder if somebody who looks at macro and micro with equal aplomb also thinks of it that way. Manish Dangi, founder of Macro Mosaic Investing and Research, and well, the Mosaic team per se, because they're doing a lot of investments across multiple asset classes. Johnson right now on the show. Manish, so good having you. Thank you so much for taking the time out and being with us.
Good morning, Neeraj.
Manish, I want to start off with this whole, how do I say, lack of clarity about the impact of the tariff war that Donald Trump has now firmly initiated. It is no longer just a bargaining tool, seemingly. How have you thought about it?
So it's a chess game, Neeraj. It has long, short implications. The man has, he is a lot more ideological today than he was in the first term. He is more determined. He has less worry of its impact, the first order impact on equity markets, almost certainly. Trump 1 was obsessed with equity markets. This time, one wonders whether he and Besant are actually obsessed with bonds instead of equity, So the primary objective seems to be sort of bringing down the sort of a bond. Now, tariff, as such, of course, it at margin in US for the first order is going to be inflationary, but eventually the growth actually takes a bigger hit, and which is why typically when big tariffs sort of are imposed, eventually paradoxically rates actually come down, they don't go up in US. So that's one implication that I kind of think we could be somewhat different to what a lot of people argue. So empirically tariffs could drive rates lower. Tariffs almost certainly are bad for profit pools, Neeraj, and therefore I kind of think that US markets are extraordinarily expensive and somewhat extremely dismissive to the impact that they will have, both in terms of economic impact and also the profit impact. So I think, there could be a substantial re-rating of US markets because of tariffs also. But hey, the most important thing, Neeraj, is actually what tariffs do is to the outside world, and which is an out and out malignant, So even though, let's say, we are not large exporters to US or, relative to US's size, tariffs could actually be sort of quite unsettling for our economy.
Okay. And just before you dwell on that point, Manish, can I just question you on the first point that you made? The normal line of thinking would be that if there are tariffs imposed, it makes a lot of goods, presumably services, expensive for the United States, and therefore it should be inflationary. You are giving the counter argument. Why so?
You see, the thing is that, it's everything in the economy are linked. So basically, the countermeasure that the macro does when tariffs are imposed, let's say if US were to impose 50% tariff on every country, on that day, big picture, I think the US dollar can appreciate by 25-30%, something like that. And neutralizes the impact of tariff whatsoever. So because these are open economies, so markets actually do the adjustments very, very quickly. So one of the reasons in September USTs have sold off was essentially as if, that the tariffs would lead to higher inflation expectations, but dollar also strengthened. So that is what is getting baked in right now, that the first order impact on the dollar would be strength of currency. Now, when the currency strengthens, in dollar terms, the TV and the fridge that they bought from China pretty much may cost the same. So that's how the tariffs sort of impact. It appears as if let's say nothing happened, if the dollar was pegged currency to CNY, then of course the very TV in the fridge and the automobile or anything else that the US bought would become expensive because of tariff. But if the dollar adjusts and appreciates, it won't. So I think that's why, as I said, the impact of, you get my point, the impact of this actually to the outside world is substantially more, because for us, the only risk currency is dollar. There is absolutely no way that dollar strengthens and India has a reflation. Reflation meaning, let's say, asset markets inflate. That's not possible at all.
Yeah.
We've discussed about it in 2022 many times, that, how malignant the strong dollar setup is. If you have nothing else to sort of track in terms of risk on, risk off, just the USD movement itself is almost sort of a very, very cool indicator to track. And tariffs certainly actually means tighter dollar, higher dollar, so to say.
Okay. So certainly a point of bother for EMs by and large. Now, I would love to for you to weigh in a little bit, Manish, on the positioning that exists on, let's say, an emerging market like India. I won't club emerging markets as a pack, because China and India are doing completely different things over the last couple of months at the very least, right? Highest underweight in the last 15 years, what have you. You speak to a lot of large global money managers who invest maybe with you as well. Would love to know how they think about investing into non-Chinese Asia Pacific markets, if you will, if that can be made a same brush. Or my interest, of course, is trying to understand how people are thinking about India, because the last 15 odd days, when I've spoken to some global money managers or heard them globally, they are saying that now with the correction and the pullback in valuations, pockets in India are starting to look interesting. So 5 months, $37 billion sold, done and dusted. It's now starting to look interesting to look at. How do you combine the valuation and the positioning argument versus your overall thesis that tariffs would largely be malignant for the rest of the world?
So, Neeraj, from a positioning point of view, the benign way of looking at India flow from outsider is that USD strength is overextended. In fact, given that DXY has actually cooled off a bit in last few weeks, you could argue that incremental noises being made from Oval Office in Washington is not making a big difference. And to that extent, it could pave way for a little bit of a risk on, meaning dollar may actually weaken. And therefore, lots and lots of money which left India may find it extremely difficult not to sort of return. That is, of course, a very benign way to look at it, and likely, let's say, 50% chance it will happen. The other thing that you have to sort of, in your chessboard, have to adjust now is that there is seriously a case of one, US-China sort of cozying up, two, China actually entering in the so-called tech world with sort of a full fanfare, and actually can potentially threaten both US's hegemony, but Indian hegemony in emerging markets, that we are the only play in the ground, where you could actually come and invest, as far as if you want to play an emerging market or short dollar trade. I think, and once you sort of account for China, is not a sort of uninvestable, so to say, then you will have to think that hundreds and hundreds of billions of dollars can actually move to China, because it's one, cheap, two, is actually starting to show signs of recovery from a macro standpoint. It also is likely in a position to do a major fiscal and monetary stimulus. And fourth, perhaps, under Donald Trump, it's not likely to be the pariah like, what it was under the previous administration. And so once you take that view, then, you begin to wonder, these Firangs who actually left us would actually come back to us, or would actually rather go to China. So, I'm going to give you both sides. It's not sure to me. And I've been a FI pessimist for many, many years. Neeraj, we've discussed about it, that, given demographics in US, this case of FI money on a secular basis coming in ended in 2010s, early 2012, 13, 14. After that, on net basis, FIs come and go. As a percentage of GDP, it doesn't happen. Something similar happened, I think, Neeraj, in Korea in the 90s. Initially, all that market was pumped up by FI, and eventually in the locals dominated. Sufficient money, not to make an argument. The jingoists argue that no, if we are such a strong dudes, that we are enough. But in a sense, for the capital need that the market requires, the businesses require, the local money is now pulled in, and to that extent, we are not going to be as hurt as we could. But I'm not very, very bullish. If you were to take a 3-5 year view, that on net, FI would still trickle in $5-10 billion annually. That's about it.
Okay. And this would be Indian equities, right? I mean, I'm guessing other asset classes, India might be inviting capital. You must be attracting oodles of capital to manage in India. So you're saying that capital may not necessarily enter into Indian equities, but other asset classes, what's the view there?
Yes, institutional money, which looks for yield, once sort of you have a good sight of a stable currency, would almost come to India, given that lots of large institutional money is looking for very long tenor assets. India is creating such assets, and I think West's money can still come there. Again, you have to see the private equity setup also. They're also on a net basis. India actually now ends up having withdrawals. So in general, both FI and FDI story is sort of overextended in our mind. In reality, its overall size has actually almost secularly been reducing over the last 10 years. And there are fundamental reasons to it. And I think we are best as a country not to sort of obsess over it too much.
Okay, fair call. Viewers, the other point is, in his note, Manish Dangi has written that, and rightly so, that if valuations can remain unfairly expensive for a long period of time, why can't they remain unfairly, cheap for a slightly longer period of time? We are used to the markets bouncing back. They may not do that necessarily, and we may remain inexpensive. By the way, we are not inexpensive right now, but we may remain inexpensive or cheap for a really long period of time as well before we do an eventual move back, whenever that happens. Yes, valuations are very attractive right now in select pockets. Let's wait and watch if that were to happen or no. Now, Manish, the one other aspect is, which I wanted your thought is on the macro positioning. The belief was that India, and not just the belief, it was visible that India was playing geopolitics well, friendly ties with a lot of countries, so on and so forth. The only issue with India was valuations. And hence I come to you on that. We can remain unfairly cheap, yes. But if the only problem was valuations, and then in the last few months, the problem was, let's say, inaction, perceived inaction by the government or the regulator, and if that is also getting corrected, isn't that an antidote to an investor's sentiment? RBI has done what it could do, or probably more than what was believed. The government has done its little bit as well on the budget and otherwise. So actions are being taken. Isn't that an antidote?
Neeraj, valuations don't have muscles to lift markets. It kind of perhaps is a lubricant. It can almost assure you of good returns if you actually buy cheap, but it doesn't have the muscle. It can get cheaper and cheaper and cheaper. Because in the end, it's about faith in the asset class. And typically in bull markets, almost everyone that you think sort of likes equity as an asset class is already in. So I don't believe that cheap valuation is a sufficient condition of markets to recover. Invariably, what happens, Neeraj, is that an external force, be it from the point of view of geopolitics or let's say, large local policy measures, if they are actually entered in this sort of equation of market, then they can get lifted. So never, as they say, never sell sort of expensive just because it's expensive. Never buy cheap just because it's cheap. If you're a cyclical guy, if you're actually a structural guy, wanted to do an SIP or wanted to accumulate, because for 20, 30 years you want to stay invested in, then yes, absolutely, it's a decent time. You're a fair valuation or thereabout, maybe 5-10% more. But take a sort of a step back, Neeraj, on the valuation, whether it's cheap enough, because frankly, at 9-10% of nominal GDP growth or 9-10% of credit growth at 20 times, it's sort of equity math does not add up. On top of it, you have to accept the fact that the margins haven't rolled over yet, Neeraj. So if the buoyancy in the economy is going to be low as it's been, isn't it sort of a fair case to make that margins can mean revert? They are very, very stretched right now as we speak, do not correspond with 9-10% of nominal GDP growth at all. So if margins were to roll over, then, this whole case of India being a high ROE, could be threatened, because you would remember the 2014-19 setup, right? We were all wondering as to why this country, who was delivering 20-25% ROE in 2000s, was barely sort of scratching surface at 12, 13, 14%.
Yeah.
So I understand that valuations have gotten cheaper relative to past. My general point is perhaps, for the macro setup, it could get cheaper for fundamental reasons also. But most importantly, in my view, that it simply doesn't have the muscle, to sort of lift the markets again. It's an insider. Insider is kind of a doped in this some sense, that he actually continues to do what he does, So if markets are moving up, the central tendency for the market, the inertia is actually to keep going up.
Yeah.
And on the reverse side, unless from outside someone shouts at it that, come on, don't do this, dude, he keeps going down. That's the way market sort of, if you were to think of market as an animated creature, it behaves like that.
And viewers, this is a very valid point. I mean, last 5-6 years, if 5-6 quarters, if it's a 5% growth per se, then where is the pricing power for the corporate to actually lift margins? I mean, and therefore it's a valid point. One hopes margins don't roll over and really go down, but let's wait and watch. Manish, we'll have to wrap it up here, unfortunately, because of time constraints, but this is so good talking to you. Thank you for joining us and giving us your thoughts.
Pleasure, always mine.
Yeah.
Thank you.
That's the view from Manish Dangi. We need to slip into a break. Back with more thoughts and more guests.
Very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
All right, back with India Market Open right here on NDTV Profit. A quick check on what the markets are doing, and a bit of a lift off from the lows of the day. IT2 is no longer down nearly 2%, but down about 1%, if you will. Small caps, in fact, in the green, emphatically in the green, and the Nifty defending 22,000 for whatever it's worth. So that's actually a good sign. Now, in a session wrought by yet another sharp correction, State Bank of India is bright, if you will, trading with about 2.5%, and in the current market context can be called as solid gains. What's driving this up move? Harsh Johnson with more on this. Harsh.
Well, the management met with the analysts at Citi, and it's followed by Citi giving SBI a big thumbs up and a double upgrade. So first off, on the target price, they've hiked the target price from 720 to 830, offering nearly a 19% upside to yesterday's close. In terms of what really stood out in terms of management commentary, one, you've got growth visibility backed by express credit corporate pipeline being healthy, as well as home loan rollout across the board. Those four levers likely to keep growth within the 13 to 14% band. That's the confidence which SBI has essentially expressed. Second one is with regard to asset quality. Unsecured retail slippages expected to be contained at just about 50 bips. Restoration of risk weights has helped, of course, capital adequacy by around 25 to 30 bips. Both of those levers to further aid numbers going forward, because lowering of risk weights means that SBI will also be able to continue to lend to NBFCs. That's the other piece. The last piece, and most importantly, is margins. SBI now focusing on margins. What they're calibrating is liability cost, and they're basically undertaking several optimization measures and initiatives. One, they're pushing with regard to current account deposits. How are they doing that? Commercial and corporate banking group, which earlier never used to look after current account, is now going to, there's going to be responsibility placed on that team to do current account and to grow the current account balances in meaningful fashion. They're going to reduce reliance on bulk deposits, and they are pushing their treasury and overseas business team to work on optimizing borrowing cost, and all of those measures likely to impact margins. That's why Citi is constructive. Again, 830 being the target price.
Thanks for that, Harsh. It was a call given in the morning by our guest Kunal Rambhya, and one would have scoffed at the call because of the way the market was. It's given you fabulous returns if you are a FNO trader. So kudos to Kunal on that call. Brave call, by the way, to give a long with the way the markets had started. Now, time to get a quick check on agri-based commodities, prices of which have seen a sharp uptick lately. What could it mean for FMCG companies? Mahima is here with the details. Mahima, fill us in.
Right. So, there's a very interesting Nomura report which came out yesterday, and they've, analyzed trends with respect to a lot of these raw materials which have seen a sharp uptick in the past 9 months to 1 year. Now, in terms of agri-based commodities, the company, of course, have started taking price hikes, but the price hikes are lower than the raw material inflation that is taking place. Now, there's sharp rise seen in prices of coffee, copra, palm oil, as well as gold, and minor deflation seen in crude oil, soda ash, maize, as well as methanol oil. Now, so Nomura has divided this into positives as well as negative. Some positive soft crude prices is positive for paint companies. High density polyethylene is down by around 6% YOY, and this is positive for packaging companies. Soda ash prices have moderated around 8% YOY, and this is positive for detergent makers like HUL and Tata Consumer Salt margins as well. Maize prices have softened around 3% YOY, and this should support Colgate gross margins overall. However, Colgate has also taken price hikes, so that will also be considered. In terms of amla prices, they have fallen by 20% quarter on quarter, so this should support overall Dabur margins. In terms of tea prices, they are down by around 20% quarter on quarter, so tea plus the tea companies have also taken double-digit hikes, so this could probably benefit counters like HUL as well as Tata Consumer. Prices of edible oil have continuously seen a sharp inflation, and this should be positive for Marico because they've also taken price hikes. Now, in terms of negatives, of course, palm oil has been the talking point. Both palm oil fatty acid as well as palm oil have seen sharp escalation. Palm oil fatty acid is 44% has seen a 44% uprise YOY. Soap players like HUL and Godrej Consumer are under pressure, and margins, of course, will be under pressure on the back of this. Palm oil is up around 30% YOY, and this impacts counters like Britannia and Nestle. Liquid paraffin is up by about 22%, and this is negative for hair oil companies like Dabur, Marico, Bajaj Consumer, and of course personal care companies like HUL and GCPL. Robusta coffee is up 66% YOY, and this puts pressures on margins of companies like Nestle as well as HUL. Milk prices is up 22% YOY, and this drags margins for Nestle, Britannia as well as QSR players that use cheese. Lastly, sugar is up around 5% YOY. Wheat is up around 21% YOY, and this could impact possible margins for biscuit makers like Britannia, ITC as well as Nestle and Dabur. So all of these consumer staple companies will see continued margin pressure in Q4 as well on the back of raw material price escalation.
Okay, thanks Mahima, and an important slice of data to watch out for. Now, amidst the advent of the global trade war, oil marketing companies could see a dual earnings trigger. Why is that the case? Somit gets us this detail. Somit.
Well, yes, oil marketing companies remain in focus. There's a potential double dhamaka for them, given the fact that oil prices have come down to around $71 per barrel level, which is the lowest that we are seeing in 2025, while gross refining margin, or the Singapore gross refining margin, which is the Asian benchmark, have climbed to nearly $5.4 per barrel, again the highest level that we are seeing since 2025. Now, higher GRMs and lower crude prices benefit oil marketing companies on earnings point of view, but do remember that actual financial benefit will only be realized if current prices remain at the current level for a longer period of time. Now, for refining margin, on the refining side, if you look at every $1 per barrel rise in the gross refining margin benefits MRPL's EBITDA by nearly 1,000 odd crore rupees. It increases Chennai Petroleum's EPS by around 30%. For Indian Oil Corporation, BPCL and HPCL, their EPS goes up by nearly 14 to 16%, and for Reliance Industries, the consolidated earnings increases by around 4 to 5%. But then again, for actual benefits to realize, Singapore gross refining margins need to remain at the current levels for a longish period of time. Now, when it comes to a marketing side, lower oil prices boost the gross marketing margin that the oil marketing company earns on selling every liter of petrol and diesel. Now, current fuel refining marketing margins, if you look at, is at around 9 rupees per liter for petrol and 7 rupees per liter at diesel, which is at a multi-quarter high for both the retail fuels. Now, every 0.5 rupees per liter increase in the gross marketing margin benefits Indian Oil Corporation's EBITDA by nearly 7%. For BPCL, it increases their EBITDA by nearly 8%, and for HPCL, the delta is much higher at around 11%. So keep an eye out for oil marketing companies, given the fact that GRMs have risen to 2025 high levels and crude prices are at 2025 low, and both these factors could boost their earnings if the prices remain at current level for a longish period of time.
Well, the oily moily trade has been long hoped for, let's see if we finally actually see that. Now, just pull up, for reference, pull up the prices of HP, BP, IOC for the last 6 months. And you will see what I'm talking about. I mean, this is, of course, today's move, but in the last 6 months, you will probably see them just languishing. And this has been a period wherein oil prices have actually seen a serious dip. Somehow, this trade doesn't work. Dinshaw Rani of Helios Capital Management is with me. Let me try and ask him, why does this happen? Dinshaw, we start off with the large picture and then go on to the micro, but I would love to understand from you. I mean, somehow this PSU trade, except for a brief period of defense stocks, etc., and some banking names, SBI, etc., likes working, doesn't quite really play out as expected or as normal trades would.
Yeah, actually, you're right, Neil, because first of all, thank you for having me on your show and a very good morning to your viewers. So let me start off with this. So basically, PSUs has always been a question mark about government intervention and stuff like that. We've always been very careful on one of the criteria that we use is management, right? Here, there's a lot of interference in the sense the management though is supposedly independent, but frankly, there's a lot of government intervention in these. If you remember earlier, the PSU banks used to have a lot of NPAs thanks to their exposure to sectors which were forced upon them by the government. Fortunately, that went away for a while, and that's why things turned around. And in fact, in one of the speeches in the parliament, our prime minister did state that my PSUs are my gems. And after that, people started really looking at PSUs in a very constructive way. And frankly, only pockets which really benefited, like railway PSUs and defense PSUs, oil and gas were always there. But unfortunately, the valuations shot up too huge for any PSU company as such in India. And that's why I think the corrections came about. And yeah, I think right now, looking at the way the stocks have collapsed, maybe it's time to relook at them, but frankly, we're not too excited right now.
Got it. Okay, Dinshaw, what's your thesis? I think we were speaking to Manish Dangi just before you came in, and there's so much of talk around the valuation reset that has happened over the last 4 or 5 months in India, but he makes a point that valuations don't have the muscle to lift the market, and the incremental capital globally might still continue to go to China if it does not go into the US, because China is currently the talk of town with DeepSeek, with valuation comfort, and with possible stimulus coming in, etc. So where does that leave us? Can we as a market remain a market with benign valuations for a lot longer than the bulls would like?
Okay, Neil, let me answer this in different parts as such. So first, let's start from December end, when DeepSeek had just come in, right? China rally was just about starting. Both India and China were underweight in global indices, whatever, the global funds and stuff like that, ETFs, whatever you have, right? So I don't think the money was going from India to China. Even after the DeepSeek rally, I think the money was going back to the US. And frankly, I think it was quite a few factors playing out at that point in time. For India, especially because one, the rupee was looking fairly weak. Obviously, the FIs didn't want to take a call on the rupee as such, and were moving lock, stock, and barrel money out, whatever they could. And frankly, the fundamentals weren't looking that great either. And as you rightly put it, the valuations looking very stretched at that point in time, especially in the small cap and pockets of mid cap as such. So obviously that was the one which was driving the money out, but I don't think the money was going to China. It was moving to US to be in dollar assets. And frankly, that trade has worked perfectly because they've probably earned 6-7% on the rupee. They've earned 6-7% or rather more on the market correction. And plus, US has done 3-4% up again. So they've earned quite a bit of delta on that trade, I suppose. So I don't, and by the way, our feel is if the US starts weakening, which is already as happening. Looking at what's happening in the US, even the economic numbers are not looking that great. I think the money will flow back to India. It's a very contrarian call, But I think that money which is parked there may just come back to India, but won't happen in a rush. I think our rupee has to stabilize at some point, and then probably things will work out. Looking at China, though, I think the rally was all driven by AI. I don't think the Chinese manufacturing companies have benefited because of this. It's mainly the AI-led flows which have propped up China per se. And I don't think that was the money which was moving out of India. So we were very clear that that's not going to happen. Coming to the valuations, again, I mean, if you look at 1 year forward, and by the way, that 1 year forward figure will change in April, because now we'll start talking about FY27. I think things will start looking far better than what they were on the FY26 platform. But even if you look at the rolling 1 year, in the large cap space, I think we're somewhere there. In the mid cap space, if you remove the frothy 2030 stocks, which are there in the 150 odd, I think again we are somewhere there. Small cap, fortunately, the one which we talk about normally is the 250 stocks in the index. But if you go beyond that, the corrections are much more deeper, and obviously value is much more there as such. So I think somewhere near we're in the end game. We're somewhere there at the bottom. I can't go, I mean, nobody can call out the bottom, but our heart tells us that we're somewhere there, and probably now is probably the time to start nibbling at whatever cash you've raised in the past. And we have quite a bit of cash lying with us, so maybe we'll start looking at the markets once again constructively.
Okay, and Dinshaw, the common narrative, at least a few days back, was, only look at large caps, don't look at mid caps. The last few days, I'm hearing people say that now we have stopped making that distinction. We're going to buy growth because even the valuations at the broader end of the spectrum in select names are looking attractive. Are you of the same camp, or are you preferring the safety of large caps?
No, Neeraj, I think I'm in the same camp. I think basically, I mean, there's a lot of value lying in certain mid caps. In fact, we have a large and mid cap fund where we've been, constantly underweight our mid caps as such. In fact, it's gone down to quite ridiculous levels now. But we want to up that percentage, and I think now is the time to start, as I said, nibbling at your mid caps, and that's why you'll notice that in most of our funds, you'll see additions to mid caps happening on a regular basis. And frankly, I mean, not only mid cap, there's also small caps which are there, which are looking fairly attractive in terms of valuations. In fact, you can see them, right? I mean, you don't have to be too predictive out here, but if you run the screener on the mid cap index, you'll see that certain stocks have remained strong in the past couple of weeks. So it's obvious that there's value there, and there's people are coming back to them. So I'm in that camp, that where I would rather look at adding to mid caps rather than running for the safety of large caps. I think that trade is done and dusted. From here on, you have to look at alpha generation. And frankly, I mean, this is the time when stock pickers can really thrive. This is the time when they can really create value for their investors. I think that's where we are today.
What do you like, Dinshaw? I mean, can you just, give us some sense, because the SMIDs are such a large bucket, right? And there are a lot of companies which have given some fairly good commentary. So I know you can't talk companies, of course, but I'm just trying to understand where do you find? Is it the energy transition? Is it EMS? Is it something else? What do you like?
None of the ones which you talked about, though, Neeraj, but I think those are still frothy according to us.
Okay.
By the way, so our feel is that it's more of the domestic plays, like say healthcare, not pharma particularly, but say hospital space. I think that has done fairly well going forward. IT we were fairly okay with, but after the NESCOM meeting, I think what we did underestimate in IT was AI. I think AI is going to be a major disruptor for IT. In fact, one of our rejection criteria is disruption. And I think AI is a big disruptor in the IT space. In fact, hearing all these leaders of large cap stocking, we realize that they are also floating around right now. They're not even aware how this AI is going to impact. But what we're clear about is that the contract tenors are going to shrink. Obviously, the manpower requirement is going to shrink. And this is what the model used to be earlier. So there's a total reset in the model in IT. So I think that's one space which is avoidable according to us. In fact, today, if you ask me, we are heavily underweight IT as such, and haven't been increasing the weight also going forward. So as I said, the pockets of, and by the way, the domestic capex plays, they are looking very, very attractive to us. Discretionary plays, not autos, by the way, are looking fairly okay to us. So these are the few spaces that, and obviously financials. I think, unfortunately, in the bank space, you don't have many mid caps, but at least and by the way, the ones in the mid caps we don't like anyways. But in the NBFC space and the services space, there are quite a few mid cap plays which we like as such. So these are the few sectors that we like and a few that we don't.
Noted. Dinshaw, so good talking to you today. Thank you so much for taking the time out and being with us, and all the best for the quarters ahead.
Thank you, Neil. It's always a pleasure to be on your show.
Likewise, it's a pleasure having you, and that's Mr. Dinshaw Irani of Helios with his thoughts. But on that note, and on the note that small caps still continue to do well, yes, they do, about 1% higher. IT doesn't, but small caps do. It's a wrap on this leg of India Markets Open. Thanks so much for tuning in.
Very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers, and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
Hi, thanks so much for joining in. You're watching Ask Profit on NDTV Profit. My name is Alex Matthew, and with me is Mahima Vajrajani, and we will take you through the next 1 hour of trade. The picture is already looking significantly better than it did even about an hour back, where the markets have come off the low point of the day, quite significantly so, that 22,000 mark being defended quite stoically by the bulls. Of course, we broke below that mark at the open, but then we reclaimed it in quite quick fashion, if you can call it that. But the broader markets are where you see most of the recovery take place. In fact, we're trading in the green for the mid-cap index, and the small-cap index also, which was trading with sharp cuts at the start, is now trading with gains of about 0.8%. Some of that capitulation that you've seen in the broader markets being reversed in trade today. Let's see if that continues to hold towards the end of the session as well. What are the sectors that you should watch out for? IT is where the pain continues, and it remains the lowest performer or the worst performer, down about 1%. Of course, at the start it was down close to 2%, but it has recovered from that point. The PSU banking pack about 1.7% higher as the top gainer. SBI, State Bank of India, is doing quite a bit of the heavy lifting there, and certainly something to watch. We'll come back to that in just a bit. But the Nifty Bank, of course, also gaining about 1/3%. It's the financials that have been up and about, and we've been speaking about the Bajaj twins as well and how they've performed over the last month or so. And since the benchmark has fallen quite considerably, this is a pair of counters that has actually bucked the trend and has gained quite considerably in that time frame. It's up about 0.9%, but you see just over the last couple of weeks, the gains have been quite considerable for these two counters. Mahima, what else are you spotting?
Right. So, a couple of counters like Varun Beverages is seeing an up move of around 3% in trade today. And this is after the CLSA note. They've cut a target price by a bit, but it's still around a 70% upside, from the current market price. And we're seeing those up moves in the stock. It did open in red, but, it's recovered quite a bit, and it's up around 3% as we speak. SBI is another counter which is doing well. I mean, in these markets, SBI, a heavyweight like SBI is up by around 3% again. So all of these counters are the counters which are actually doing well in terms of, the contribution as well.
Yeah, and you know what? Oh, sorry.
Yeah,
Did you have more?
Yeah, sure.
No, but I'm saying at the start, our watch list, we actually pointed out quite a few stocks that had positive developments that were in the red,
right,
but they've recovered quite smartly from the low point. In fact, pull up something like a Time Technoplast, where there is an update in terms of a new product that is launched in the polyethylene pipe space. The stock has recovered as much as 4.7% from the low point of the day to trade with gains of about 3%. The oil marketing companies, we were talking about this at the start, and crude oil prices at $70 or thereabouts, or $71 thereabouts for Brent crude, and the expectation that gross refining margins are going to improve for these oil marketing companies. HPCL trading with gains of about 3% or so. Let's pull up IOC and BPCL as well, because those stocks have gained quite considerably from the low point of the day. 2.5% for IOC right now, and 1.3% or thereabouts for BPCL. Maybe the worst is over. Azad Engineering, there was a QIP where the fund raise was to the extent of 700 crore rupees. This is a stock that is gaining about 3% or so. Godrej Properties, there's promoter buying that has taken place. The stock is gaining about 2%. And the real estate pack, by the way, has gotten beaten down quite considerably. So it's a good move up. And Canfin Homes, Morgan Stanley has a 52% upside as of yesterday's close on this counter. It was down in trade at the start, but it's up about 1%. So these are some of the stocks that I was looking at.
Absolutely. Even Ask Automotive is something that's doing well in trade today. But some counters, worth flagging off, which are not doing well also. So Ask Automotive is locked in upper circuit. Paytm is one such counter. Sudarshan Chemical is one such counter which is not doing well. There are counters like Inox Green, Inox Wind, Intellect Design. All of these counters are down by about 2%. Inox Green has recovered quite bit. It's up by 6%. But Intellect Design down. Glenmark Pharmaceuticals, Suntech Realty, all of these counters, on the back of news flow post-market hours yesterday, are in focus. But with that, let's also welcome in our guest for the day, Asa Jain, Senior Research Analyst at HEM Securities, and Swati Hotkar, AVP Technical Research Analyst at Nirmal Bang, is joining us now. The first query for the day is on the counter of Cochin Shipyard. Rajendra Kumar has bought 113 odd shares at 2,755 a piece, and he's saying that he's incurring a loss of around 1.7 lakh odd rupees. He wants to know whether he should hold or book loss or switch to something else, and he's also given options that he wants to either switch to Reliance or Infosys. Now, all of these three counters are in different sectors. Asa, I'll come to you. Cochin Shipyard, what's the outlook like, and should he exit at the current levels and switch to something like a Reliance or Infosys?
Talking about this counter, I think Cochin Shipyard is a better stock rather than going anywhere else, because the results that have come out were also very decent. They have a good order visibility, and in fact, what I believe that going ahead, their financial performance will definitely going to show improvement. So on all these bases, I think there is no need to exit from this counter as of now. This counter can show more upside from here, and that are the better opportunities to make exit rather than now. So your idea is to stay invested in this counter.
Okay, hold is a view from Asta. Asta, good morning, and Swati, good morning to you as well. Thanks so much for joining us this morning. Kushal is calling us from Bengaluru, I believe. Kushal, good morning to you, and how can we help you today?
Yeah, very good morning, sir. So, basically, I'm planning to purchase Genus Power.
Okay.
So, which is completely into smart meter production. So, I have been following up with the company since 1 year, reading with all the con calls. So, they are very confident in achieving whatever the targets they have set. So, is it the right time to enter into the stock or with this PE? This is my query, sir.
Okay, and so you've not bought yet. You've identified this for the long term, right? And you are planning to hold for a year plus? What is the time frame?
No. Actually, I'm planning to hold up to 5 years because they have a revenue potential up to 3 to 4 years.
Okay.
So, I'm planning to lump sum investment as of now into the stock.
Okay, got it. All right, Kushal, and I'm glad that you've done your research. The stock is up and about in trade today, 3.5% or so. Asta, I'm coming back to you on the fundamentals. This is a 7,850 crore market capitalization company involved, as Kushal has pointed out, in smart metering and metering solutions. Would you buy into this, or is there another play that is better in the smart meter space?
So I think this is a very good counter to make a fresh investments. Also, the only problem was with the downside, which we have seen in the market conditions. And that is the major concern. That's why we have seen this stock is also not performing. Now, idea behind this stock to be a good investment option is that, first of all, their results were exceptionally well. And definitely, I would like to congratulate the investor that definitely he has done a very good research, because even when I have gone through their con call, in every con call they have mentioned that they are getting very, very strong demand, and it is visible through their order book also, because they have got a very strong order book. And in fact, the results which they have posted in the Q3 of FY25, it is like a turnaround result, because in the last year's same quarter, if I take out all the other exceptional items, etc., it was a negative performance on the bottom line front. So from negative to positive, a very strong set of number which this company has posted in this quarter. Yes, I think this is a counter where one can make fresh entry. The only problem is that don't put all your money into it. Just make a staggered buying, maybe 30% as of now, 30% or 40% later on, and remaining 30% again later on. So in that way, in a staggered buying way, one can make entry into this counter. But definitely this counter is poised for a good upside momentum from here. So one can make a fresh entry into this counter.
All right, one can make a fresh entry in Genus Power, but in a staggered manner is the view coming in from Asta. The next counter that we are talking about is Siemens India. John from Puducherry is asking this question, and he wants a technical view on this one. Swati, I'll come to you. Yesterday, Jefferies had an interesting note with an upside of almost 56% on the counter, and they said that this is a good company, in the power transmission play, and also will benefit from higher capex spending as well. Do you also, agree with the 56% upside in the next 6 to 12 odd months?
Yes, first of all, good morning, all of you, all the panelists. Definitely, the view is positive at the current level. Whatever rally we have seen by the end of the 2023, from almost 4,000 to 8,000, now the stock has already retraced its 50% of that particular rally. And also the interesting fact that it is just trading in the oversold zone, and I believe that its momentum indicators such as the RSI is likely to witness some sort of a positive crossover from the oversold zone. So the bottom is we are making a bottom at around nearby 45, 44 levels, and from there onwards we are likely to witnessing some bounce back rally towards to 6,000 to 6,500. So at the current level, definitely one should invest at least 20-30% at the current market price. I believe in a short period of time 6,000 levels can be achieved, and beyond that 6,500 levels can be be seen. So it's one of the strong counter one can do for investments.
Buy is the view coming in on Siemens with respect to the technicals, and that's the view coming in from Swati. Sanjay from Mumbai is calling us. Sanjay, a very good morning to you. How can we help you?
Good morning. I want to know about Abbott India Limited. I have bought 51 shares, about 28,100.
Okay.
And I want to know the possible range to which it can go. Asta in the past had recommended his share at about 6,000 rupees just before Corona, and I had that time made a gain of 10,000 rupees per share on that script. And therefore, I want to ask the question to Asta.
Okay.
And about the future of this.
Okay, Sanjay, just to understand, you bought it at 6,000 and then sold, and then you again entered at 28,100 levels.
Yes.
Okay,
yes,
all right.
Yes.
Oh, got your query. Interesting one, Sanjay. Then it's interesting that you remember the call that Asta had given back then in COVID as well. Asta, so, he's followed your footsteps and he's, taken your advice. That was back in COVID, of course, but now what do you think? Are these the right levels to keep holding Abbott India? He's sitting on a profit of around 1.7 odd lakh rupees. Should he book profits or continue to hold?
So first of all, thank you so much for following that advice. And it is really nice to watch that still, there are some counters which are yielding good results because we have seen a strong capitulation in the market. And now talking about this counter, first of all, the reason why I was so positive about this counter and right now also is that 8 of their total 10 brands are the category leaders. And one important point about this counter is that none of their brand is holding the share of more than 24% or 25% in their portfolio. So there is no concentration risk in their portfolio about the product, and 8 of the brands are the category leader. Now the kind of results which this company has posted in Q3 of FY21 were exceptionally well and ahead of our expectations. So in fact, recent also, I have again given out buy call on this counter with a price target of 32,700 to 32,900. So idea here is to stay invested in this counter, but these market conditions are so volatile that I don't want that anyone should fetch any sort of negative return. So partial profit booking is recommended, partial or 1/4 of the position, but keep holding 3/4 of your position because I think this stock can move till the level of 32,500 to 32,700.
It's had a tremendous run and what a gain since the start of February. Let's pull up the 1 month chart just to see what it has done. And it has gained quite considerably over the last 1 month, 20% or thereabouts. It's flown under the radar somewhat. Yeah. I mean, we was having similar conversations about the Bajaj twins and Bajaj Finance having gained quite considerably. But Abbott India, certainly something to look at. And let's take a look at the, let's get in touch with the research team also to ask why they didn't spot this. I'm gonna talk to you after the show. But let's talk about State Bank of India and let's talk about Bank of Maharashtra. 2 counters. Bank of Maharashtra maybe is something to sell, and that's something that Ekambara is wondering. He's bought at levels of 54 and he's wondering whether to get out of this counter and get into something like a State Bank of India, which is doing particularly well for itself in trade today. Swati, on the charts, what would you do with this?
Yeah, as of now, definitely we are likely to witness some good momentum into the banking stocks. I will not suggest to switch on the counters, but definitely SBI is really one of the strong counter at the current levels. One can put an extra investment into this particular stock, but into the Maha Bank also we have seen that the 42 is acting as a very strong support level, Alex. And in this fall, this particular counter has respected that support levels, which gives some sort of a relief sign. I believe that the upside momentums can be seen up to 50 to 52 levels on the higher sides. So definitely one should hold the long positions into the Maha Bank. And SBI, definitely one can take a long-term investment bet at the current market price as well, because it is an index-based stock. Definitely one of the very strong counter on the technical as well as on the fundamental side. I believe for a short-term period targets, the 780 to 820 levels can be seen in the near term. So the fresh positions can be also added into the SBI at the current market price.
All right. Fresh position is possible in State Bank of India. The stock is down about 16% over the last 3 months, but it's up and about in trade today, close to 3%. And remember, there is a target, I can't remember who, 850 is a target, if I'm not mistaken.
I think it's Citi.
Citi has a target of 850 on State Bank of India. All right, let's go to the next caller. We've got Mahadev calling us from Bengaluru. And I believe, Mahadev, you want to know about Jio Financial Services. You bought at levels of 227, right?
Yeah.
Okay, so can you tell me what your thinking was? When did you buy this and how long do you intend to hold?
Just in 1 month time, I bought these all.
Okay, so you bought okay, Mahadev, I want to point out that the line is not very clear, so maybe we'll try and dial you back, but I kind of got your question. You bought 500 shares at 227 and you want to know what the prospects are going forward. The stock is down about, it's down to 200 or thereabouts. No, it's down about 20 rupees or thereabouts from his buy price. Let's go across to Swati on the charts to see what the upside potential is. The stock has been under a tad bit of pressure for quite a while now. Has the bottom been hit and what is the upside potential from this point, Swati?
Alex, you rightly pointed out, if you look towards the last 3 months data, the stock was not doing very well, almost 30% down on quarter-on-quarter basis. But if you look towards the chart momentums, no wonder, according to the market scenario, all the stocks we have seen at a bitten down, and the majority of the stocks are trading in the oversold zones, trying to finding out the supports at the lower levels. This particular counter is finding out a support nearby 195 to 190 levels. An interesting fact that the momentum indicators such as RSI is just forming the positive divergence, which indicates that the momentum is likely to be seen on the positive side in the near-term future, which might take a stocks towards 240 to 50 levels. So at the current level, one doesn't book the losses. Definitely one should hold on. As the market starts performing, this particular counter will also participate in the upside rally. So it should be a hold at the current momentum counters.
Right, so that's the view with respect to Jio Financial. The next counter that we're talking about is NMDC. Jay from Andhra Pradesh is holding 100 shares at an average price of 61. And he wants a long-term view on this particular counter. Astha, what's the view like and what are the prospects going ahead for this counter?
So here, as the view is long-term, definitely the view is positive. One can remain invested in this counter for the long-term. Although what we have seen in the bottom line, there was a average jump of the 10% in the bottom line which this company has posted. But again, I see the future prospects, and on those bases, I think this counter is well poised to go till the level of 70 from here. So better to stay invested in this counter.
All right, so that's the view with respect to NMDC. We have our next caller. Ram from Chennai is calling in. Ram, a very good morning to you. How can we help you?
Yeah, very good morning. So my query is regarding Tata Motors. I am holding 35 shares of Tata Motors.
Okay.
At the average price of 715 around it. So like the stock is corrected very huge now.
Right.
So can I accommodate more shares or should I, what is the target price I should wait? So will it break 600 or 500 something? Just want to know whether I can add few more. My budget is around 50 to 60,000 rupees on Tata Motors.
Okay.
Is the right time? Yeah.
And you are seeing this from a longer term perspective or
yeah, longer term.
Okay.
Long term, 2-3 years. Yeah.
All right. Okay, 2-3 years. Astha, Tata Motors is the counter. Yesterday only we pulled out a data where we saw that Tata Motors is down by about 38% from the highs of 26,000 Nifty levels. And that's the steep correction that Tata Motors has seen. But 2 to 3 years is the time horizon that Ram is looking for. What's the view like?
So view is positive. First of all, what we have seen in their result that ASP, that is average selling price, was declined in the JLR. So, and in fact, the company has reduced the JLR guidance also. But now, if I talk about their India's business, first of all, India's passenger vehicle business, the outlook is positive. In fact, in the India CV vehicle segment also, the outlook is positive. So I think on these basis, definitely this company can show some good financial performance going ahead. So idea here is to stay invested in this counter. Maybe it will take some more time to show some sort of improvement in the stock prices. But I think over the period of a time, it will yield strong results. So idea here is to hold the counter with the initial price target, which I'm setting for this counter is 700 to 710.
Okay, 700 to 710 is the initial target. Tata Motors underperforming, and of course the auto pack as a whole not doing particularly well at this juncture. It was under pressure yesterday as well. Let's talk about Adani Power, and this is a question from Patel, who's writing in from Ahmedabad, and he's bought at levels of 526. He's wondering what the short-term and long-term prospects are, and since he's not specified what exactly his time horizon is, let me go across to you, Swati, on the charts. What's your opinion, and what should he do? What are the key levels to watch?
See, Alex, my view at the current level is being cautious because from continuously last 1 year, the stock is not really doing very well. It's trading in the formations of the lower top, lower bottom formations. And I believe that the stock will try to find out a support nearby 440 to 430 levels. Up to that level, we might witness more selling pressure into this particular stocks. The view will convert into the positive sides only if the stock manages to give the breakout of a 540 levels, which is acting as a very cluster resistance zone from the last few months as well. So unless and until it stays below 530, 540 levels, my view will remain cautious, not to average it out at the current level. Let the stocks find out a support nearby 440 to 430 levels. And once again, you can take a review of this particular counters. And as of now, I will suggest to hold on this particular stock.
All right. Adani Power is what we just discussed. It's part of the Adani Group. NDTV Profit is part of the NDTV Group, which is owned by the Adani AMG Media Networks, which is part of the Adani Group. Let's get Shivam on the phone line. Shivam is calling us from Jamnagar in Gujarat. Shivam, good morning to you, and how can we help you today?
Yeah, good morning. I want to know about the IT floaters. Is the right time to buy?
Okay. And what is the time horizon that you have, Shivam? Why do you like the stock?
Yeah, IT floater is the best floater company. It operates in all the level, entry level, mid premium, premium luxury.
Right. Okay, so you're buying based on the fundamentals, right?
Yeah, fundamentals and brand value, ITC.
So I'm sure that you've studied it, Shivam. So you don't like IHCL, Indian Hotels?
IHCL is good, but ITC, I think valuation is much good than IHCL.
Okay, that's a good point that you're making, and I'm glad that you've studied the company so closely, Shivam. Let me go across to Asta on the fundamentals and on the valuation picture that you've just spoken about. ITC Hotels, is it a good buy based on valuations and based on fundamentals? And we've spoken about this in quite a lot of detail in the recent past. The trajectory on room addition is quite strong heading into 2027, 2030 as well.
Yes, and in fact, they are scaling up of their recent green fields also. So that is what you are talking. And this is, I think, number two ranking. This hotel owns number 2 ranking in the hotel space. And I think this counter is really well set because their management is really very strong. In fact, I have my own personal experience at the hotel. So I think this counter is a good counter to stay invested on. And one can continue their holding in this counter. And our price target for this counter at the initial level is 175.
All right, so that's the view with respect to ITC Hotels, and hold is the view coming in from Astha. The next counter that we're talking about is JK Paper. Shivani from Mumbai has purchased at the price of 483, and she's incurring a loss of around 77,000 odd rupees. She would like to know the fundamentals of the company, and is there a scope of improvement is what she's asking. Astha, do you have a view with respect to JK Paper?
Yes, if I talk about the fundamentals of this counter, fundamentals are not looking very strong because the kind of results this company has posted, there was simply and clearly a degrowth of more than 30% in their bottom line. So right now, fundamentals are not in a very good shape. It's better to let the stock fall more and then make entry into this counter if anyone wants to make a fresh entry, or one can do like entry after the result declaration for Q4 of FY25. But right now, I am not advising to enter into this counter purely on the basis of fundamental because financial performance was not up to the mark in Q3 FY25.
All right, so JK Paper is an avoid based on the fundamentals. We've got more stocks that we'll talk about, but we have to slip into a very quick break. Astha, Swati, do stay with us, and we'll see you on the other side of this very quick commercial break.
very warm welcome to you all for this NDTV Profit conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial.
Welcome back. You're watching Ask Profit, a show that gets all your stock-related queries answered, whether they're fundamental or technical. For viewers who are just tuning in, you can either call us or WhatsApp us on the number that's flashing on your screens right now. We have our next caller lined up. Upendra from Bengaluru is calling us. Upendra, a very good morning to you. How can we help you?
Hi ma'am, good morning.
Good morning.
I call you regarding this Tanla platforms.
Okay.
I had bought 400 shares at 750.
Okay.
Currently it's funding 430 plus.
Right. So you want a long-term query? Are you a long-term investor? And have you
Yes,
seen the
ma'am,
fundamentals of the company while investing?
Yes.
Okay. As I'll come to you, Tanla Platforms is the counter. What's the view like?
So it is the largest communication platform, I suppose, and there are 90% of the businesses coming from the enterprise segment, while 10% from the platform segment. Now, talking about the fundamentals and the financial performance of this counter, it was not up to the mark. The company faced the challenges in their margins as well in the Q3 of FY25. And in fact, their international messaging business is not performing strongly for them. So on those bases, the results were not good. The only, I think, comfort right now is regarding the valuation, because the stock has seen a sharp decline. So in that way, the valuations are now in the favor, because it has already seen sharp correction. So my idea here is to stay invested in this counter, but financial performance need to show the improvement for getting a boost for upside from here. But right now, one can stay invested in this counter. Initial price target can be set at around 470 to 475 odd levels.
Oh, okay. We've got an interesting company, and Asta, I'm going to request you to pull it up if you can. This is Manorama Industries, and it is a 5,000 crore company. It is involved or engaged in the manufacture of specialty fats and butter made from exotic seeds and nuts. It says it is a producer of mango-based cocoa butter equivalent, which is interesting, right? Or shea-based CBE and mango, sal and shea-based specialty fats. All very interesting. Not a mainstream company to say the very least, but an interesting company, because this is something that Santosh from Chennai has highlighted. He's bought 15 shares at a price of 1,093. The stock is up 9% today, or close to 10% today. Is this something that you've looked at in the past, and what would you say about it?
So I think this company has performed very strong results in the Q3 of FY25. And the reason behind it was that they have got a very strong demand for the products. And now I think it was more than, very strong percentage of jump which they have shown in the top line and bottom line. In fact, now this company is looking for capex also, as far as I remember, and they are going for forward integration and backward both sort of integration. So I think these all are the major pointers towards this company. My idea here is to stay invested in this counter because it has shown very strong financial performance and management is quite optimistic about the outlook of company. So hold this counter. At least I think one can get break even at around 1,000 or 1,050 odd levels.
Strong move in the counter trade today. And fundamentals are looking strong as well. So kudos to you for having picked up this small cap and for having looked at the data. I'm sure you've studied it as well. Dheeraj from Hyderabad is calling us. Hi Dheeraj, morning. How can we help you today?
Hi sir, good morning. My query is regarding Ganesha Ecosphere.
Okay.
I'm holding 100 shares of Ganesha Ecosphere at 198 rupees.
Okay.
So, at current level, should I add more or should I sell is my query.
Okay, what is the time horizon that you have in mind, Dheeraj? Is it long-term or short-term in nature?
Short-term, sir.
Okay, and when you define short-term, is it a few months, less than a...
Few weeks.
Few weeks.
Like yesterday, okay. I bought the stock yesterday actually.
Okay, you bought it yesterday. How much data do we have? Do we have enough data? Okay, so, yeah, all right. So, I'll come to you, Swati, on the charts. It's down about 30% over the last 6 months, but it's up about 4% in trade today. And quite a few of these names, smaller names from the broader markets, are doing quite well in trade today. What are the key levels to watch out for on the upside?
Alex, we have already seen a very strong sell-off in this particular counter from the month of the last year, October, November, from 2,450 to now 1250 levels. So I believe that the stock has really found out a support nearby 1200 and 1220 levels and showing some turnaround. Interesting fact that the positive divergence is witnessing on the daily chart. So I believe that it has a strong potential to reach up to at least for a short-term period, say for a week, for a few weeks, 1500 is the likely target, the resistance provided by its 20 days moving average. So up to that level, we are likely to witness some positive momentum, and beyond that levels, once it manages to give the positive closing above 1500 all levels, the rally is likely to be extended towards to 1750 to 1800 levels. So view is definitely positive. If you are interested to add on the more positions, you can go for it. Downside, it has a very good support formation at around 1240 to 1220 levels. So by keeping that stop loss, you can definitely create a long positions.
Right, so buy is the view coming in on Ganesha Ecosphere. The next counter is GSK Pharma. Rajesh from Mumbai wants to buy 50 shares of GSK Pharma at 2,600. So he's also given the price at which he wants to enter. But he wants to know whether making entry at this price makes sense or not. And he's not mentioned whether he wants a shorter term view or a longer term view. But Astha, I'll come to you. GSK Pharma, what are the fundamentals saying?
Fundamentals were quite okayish because they have posted a 7% growth in their bottom line. But the price where to enter, I think technical analyst is in a better position just on the basis of chart. But my view here is that one can make entry into this counter at a lower price level. And right now it is quoting at around 26.24. So I think at the lower price level of around 25.50 or 25.80 are the better levels to make entry into this counter.
All right, so that's the view with respect to GSK Pharma. Vishnu Prasad is our next caller. He's calling in from Kerala. Vishnu, a very good morning to you. I believe you have a query on Adani Ports.
Yes, good morning. So I am currently having 100 shares with me. So since today morning I was thinking about adding 400 or 500 shares more.
Okay.
So what's your take on that? Yeah.
All right, and you are a long-term investor in Adani Ports?
Yes.
All right. Astha, Adani Ports is the counter. He's already holding 100 shares and he wants to invest into another 400 to 500 odd shares. Is this the right levels to enter in?
So it is like, one of the largest port operator in the private space in India. Now, if I talk about the prospects and fundamental prospects of this counter, it seems to be good because the growth prospects are really good. I think that. And on that basis, yes, one can make an entry into this counter at the lower price level of around 990 to 980 odd levels. And those who have this counter in their portfolio, they can remain invested with an initial price target of 1,090 to 1,095.
Okay. All right. Stock is up about 0.5% or so, and it's a hold. By the way, we just spoke about Adani Ports. It is part of the Adani Group, and so is NDTV Profit, which is part of the NDTV Group. Let's talk about Excel Industries, and we've got a question from DJ Kandan, who wants to get in at the current level. So Swati, the question is, does the current price look attractive to you?
Yeah, as of now, I will not suggest to take a long position in this particular counter, Alex, because we are likely to witness more selling pressure in this particular stocks, which might take a counters towards at least 800 and 780 levels. So that levels will act as a crucial support levels, and the risk reward ratio will be a favorable. So if you're looking any dips towards to 800 or 780 levels, then you can think about it, but not at the current market price.
Okay, all right. We've got our next caller. Venkat is calling us from Andhra Pradesh. Hi, Venkat. Good morning to you. How can we help you?
Alex, I have Yatharth Hospital shares.
Okay, Yatharth Hospital, is that right?
Yeah.
Okay. So what would you like to know?
I have 100 shares.
Okay.
I have bought at 562 real price.
Okay.
Now it is almost 360.
Yes.
It has been corrected 35%.
Yeah.
And I have a long-term view of 2 years.
Okay.
So should I continue to hold, or I can add some more?
You can add some more. Okay. I got your question. Is this the only healthcare company that you have, or do you own some more companies in the healthcare space?
No, only this hospital.
Only Yatharth Hospital. Okay,
yeah,
fine.
Yeah.
All right. So Asta, on the fundamentals then, because this is another stock that is from the broader markets that has seen a substantial erosion in value. Would you buy more at the current level?
So this counter is posted at good numbers, but I think there was some news related to the corporate governance, something like that. And that was a major reason that we have seen a good correction in the stock prices. But if I talk about the financial performance, it was good because their average revenue per occupied bed was on a good side. And in fact, they have raised funds through the QIP also, which they were intending to deploy towards the capacity expansion in the form of more bed addition. So I think all in all, and after that, even the management has made certain clarifications regarding the governance issues. So this stock can perform strongly on the long-term prospects basis until or unless some negative news should not come. Otherwise, I think there is no harm in remain invested in this counter. So one can remain invested in this counter, and the price target at the initial level, which we want to give, is around 410 to 415 odd levels.
All right, so that's the view coming in on Yatharth Hospital. The next query is from Kiran Tejwani, who's from Karnataka. So, this is actually a broader end question. She's asking if this is the right time to invest in the market, and if yes, please suggest good stocks for long-term investing. And her time horizon is 5 years. Asta, if you can name 3 counters for her from a longer-term perspective, and if those counters are attractive at the current levels in the market right now.
So as I was indicating earlier also, that staggered buying is always a good option in this kind of market conditions, because none of us know where the market bottoms out. So right now, because I think if 22,000, which is a crucial level for the Nifty, if it breaks that level, then definitely it can move till the level of 21,800 also. So right now, staggered buying is always a beneficial, rather than going with any other manner. And here, 2-3 stocks which looks good from the long-term perspective is, first of all, in this steel space, Tata Steel. I think Tata Steel has a room to move more upside from here. So this is the counter which I'm betting on right now with a price target at the initial level, not a big price target I'm giving, but it is only around 155 to 160, which I'm attributing to this counter. Definitely in the banking space, ICICI Bank, it is like a no-brainer sort of stock recommendation. So one can invest in that counter as well, because banking sectors are again looking positive. So there, and again in the capital goods space, L&T is all-time favorite. So these are some counters which we are really positive on at this moment of time.
All right, so these are the counters that Asta has given from a longer term perspective. Avi from Kolkata is our next caller. He's calling in. And Avi, a very good morning to you. I believe you have a query on PVR Inox.
Yes, that's right. Good morning to the NDTV family.
Good morning.
Yes, I've got PVR at, I bought it today, like 9320 quantity at 926.17.
Okay.
So I was thinking, like, what could be the price target, like, let's say, like, within a year?
Within a year, okay. And have you seen the fundamentals of the company, or did you see the charts and enter the counter?
Honestly, actually, I just saw the chart. I just thought, like, it has come pretty down from,
Understood.
I think, 2000 or 1800 levels. So I just thought, like, because today morning, actually, I was holding, like, HUL and one more stock.
Right.
So I booked a loss of, like, 20 lakhs, and I just thought, like, probably it's time to start fresh. So I just thought of entering this counter, yes.
All right. Booked a loss of 20 lakhs. That's quite significant. Is that what you mentioned, Avi? 20 lakhs?
Yeah, let's try it.
All right. So I believe that would be a part of your portfolio then.
Of course.
Yes.
All right.
Actually, I was holding two stocks, so I exited and I just bought, like, everything. I put in a PVR as of now, yes.
Okay. All right. Swati, PVR Inox is the counter. He's just entered today. What are the charts looking like for the next 1 year? And as he rightly mentioned, they've come off, the stock has come off quite a bit.
Yes, it's correctly pointed out that on the price basis, if you compare the previous formations, it's highly beaten down counters. But on a larger degree, my view is a little bit cautious itself. More downfall can be seen into these particular counters nearby 850 to 840 levels up to that levels. But today, the market is doing really well. That's why we are witnessing some positive momentum or say the pullback rally. And this pullback rally can be continued towards to 980 to 1000 levels, but it might be a short-lived. So if you are looking for a trading perspective, try to book your profits on every rise towards to 980 to 1000 levels. Downside, you can keep a strong support of 880 levels. As long as it stays above that level, this positive momentum is likely to be carried forward towards the mentioned support levels. But for a longer term durations, might be a little bit cautious not to create major long positions at the current market price.
Right. All right, so that's the view with respect to PVR Inox. The next counter is IGI, that is International Gemological Institute. Vijay Sharma from Bengaluru is asking about this counter. He's saying that the share has touched bottom line in the past 2 days, and he wants to know if this is the right time to invest. He already is holding 90 shares at an average price of 355. Asta, they announced their earnings, day before yesterday post market hours, and as per my analysis, there were a couple of reasons as to why the stock has fallen so much. First one being that the revenue growth was just 6%, versus the jewelry companies which have definitely clocked a double-digit growth in this festive season. And in the con call, they also mentioned that their share of lab-grown diamonds has overall gone up. Plus, their trade receivables have gone up significantly, and cash flows have also turned negative. So this is my reading, but what's your reading with respect to the results? And from a longer-term perspective, is this a good counter to enter at the current levels?
I don't think so, because I think IPO came in December, if I remember correctly, and it was at the issue price of around 417. So from that, we have seen a sharp fall. Although they provide certification, they are one of the global leaders, and the kind of work which they are into, they have no close competition. But idea here is that how much growth we can see in certain type of or such type of business. So that is the major concern. And apart from that, you have rightly said the financial performance was not up to the mark. So, and we have seen the stock has shown a very, sharp downside momentum. So there is no need to make entry into this counter, because even I am not very much positive on the growth outlook going ahead. And idea here is to just try to exit from this counter at any upper level, but don't make entry into this counter, and exit is a strategy which I would like to recommend for this counter.
The call on IGI. I must confess, I didn't really see a reason for the stock to get beaten down as much, but the way that Asta is looking at it, perhaps it does warrant the kind of downside that it's seeing. Trent is the name of the counter that we're talking. Actually, let's go to our caller. Suresh is calling us from Hyderabad. Hi, Suresh. How can we help you?
Hi, I'm holding Steel Leather of India at 110.
Okay.
But from past couple of days, I'm seeing some recovery. So in this recovery, can I expect? I'm holding around 1,000 shares.
Okay.
Can I add 1,000 more to target for around 130 to 150 in a time within 3 to 6 months?
Okay. since you have a short-term time horizon, let me go across to Swati on this one. Swati, he's bought at levels of 110, not too far away from the current market price. What are the upside potential for the next 2 to 3 months, or maybe even a little more than that?
Yeah, Alex, the view is definitely positive because the counter is forming a very cluster supports nearby 198 levels. And from there onwards, from the last 2 months, we have seen a very strong consolidation phase within the range of 100 to 110. 110 is the breakout level if it manages to give the breakout of level stat level. 130 is the likely target for the coming 1 to 2 months or 3 months in period of time we can witness stat levels. So definitely one should hold on the long positions. Downside, you can keep a stop loss of 98 rupees. I'm looking for a target of 130 levels in the few months as such.
All right, so that's the view with respect to sale. The next counter that we're talking about is Trent. Pradeep has bought at levels of 5,100 and he's bought 100 odd shares. He wants to know whether he can continue to hold or buy more at the current levels. Asta, what's the view like for Trent?
So I think view is to hold this counter rather than making exit or making entry also. So I would not suggest any of these two. Just remain invested in this counter because results were okay, but I think markets were expecting more or a stronger set of a number, and there were certain concerns which the market were having at the time of the result outcome, and that is why we have seen the stock has not performed well. So better to wait for the more clarity to come on the financial performance side. So hold is a strategy which I would like to recommend rather than making entry or exit in this junction.
Another question, this one's from the financial space and specifically on the microfinance space. And I know that we've spoken about this space quite in a quite detailed manner over the course of the last few months. It's a space that is under a tad bit of pressure, but let's pull up Credit Access Grameen from this space, and this is a counter that saw considerable selling pressure because frankly the fundamentals were looking a little bleak. We've got Ramya from Chennai who's bought 52 shares at a price of 1494, and from that level the stock is down quite considerably at 919 or thereabouts now. So Asta, on the fundamentals, quite a bit has been said in the investor presentation as well. All of the targets that were set at the start of the financial year have been revised multiple times downwards, and the asset quality is also not looking particularly great. What would you do with this if you've got a very long-term time horizon and she's got a horizon of 5 years, so she's wondering what to do, she doesn't want to sell at a loss? Would you recommend holding on?
Yes, one can hold on this counter because here the time horizon is 5 years. So just looking after that time horizon, and our viewer or an investor does not want to book losses, the idea here is to stay invested. Now we should understand why the stock is not performing good. Because first of all, it is a third consecutive quarter that we have seen the contraction in their loan book. In fact, their financial performance was not up to the mark because of the elevated credit cost also. And the kind of headwind which this credit financing sector is witnessing, I think that is also playing spoil sport at this point of a time. So all these factors are pointing that maybe this stock can go more downside from here. But just because the time horizon is 5 years, idea here is to stay invested. But this is a recommendation purely to the investor who has raised this query and not in a general, because I don't think that this stock can perform well in the coming quarter as well.
We've got a next caller, and Arjun is calling us from Bengaluru. Arjun, I want to know if I'm reading this correct. You've got 14,278 shares of Suzlon, is that right?
Yes, sir. I'm having 14,220.
Okay, so you've got quite the conviction on this stock. Tell me what you want to know.
So my average price is 52 rupees.
Yes.
And I would like to know, I mean, even for a short, long term, probably 6 months, is it okay to hold or should I sell it once I get one?
Okay, so
any good price?
Okay, so you've got a short-term view on the stock. Have you by any chance studied the fundamentals?
No, sir, I haven't.
Oh, so you're looking at the price activity. Okay.
Yeah.
Okay. By the way, in case you're interested, we did speak with the management earlier today, and that should be available on our YouTube page as well. But since you have a short-term question, and 6 months is your time horizon, right?
Correct, sir.
Okay. So Swati, I'll come to you on this one. Bought at levels of 52, which is very close to the current market price. It's quite considerably off its 52-week high, which is close to that 80 rupee mark. What is the potential over the next 6 months?
Yeah, Alex, the buying price is quite attractive at the current levels because the depth is very limited. We have seen that if you look towards past history, the counter is forming a very strong formation within the range of a 45 to 46 levels. So that is acting as a very strong cluster supports levels. Upside, this momentum is likely to be chased up to 60 to 65 levels. So my view is positive since the risk-reward ratio is very favorable at the current market price. You can hold on your long positions by maintaining a strict stop loss of a 46 levels on the downside. For immediate target of first will be a 60 and beyond that level 65 levels can be seen. So it's a hold from my end.
All right, so that's the view with respect to Suzlon. The next counter is Shipping Corporation of India. Sunita Rai from Bengaluru is holding 500 odd shares bought at the levels of 80 rupees. So she's sitting on a profit of around 33,000 odd rupees. She wants a longer term view on this. Astha, what's the view like for Shipping Corporation of India?
So longer term view is positive, and I would recommend to hold this counter just because what we have seen that in the latest results, that is Q2 of FY25, the results were not up to the mark, and that is the major reason we have seen the stock is not performing well on the bourses. But in the longer term, we are quite positive on this industry also and the kind of work they are into. Definitely a hold is recommended for this counter from the longer term perspective.
Swati, quick view on some of these capital market plays, specifically BSE and CDSL. BSE in particular getting beaten down the recent past, but it's up about 3% in trade today, bouncing back. Chandan Jain wants to know whether to buy into either one of these, BSE or CDSL.
If you look on the price momentum as such, we have seen a very sharp decline in the CDSL, this particular counter, because it's already bitten down counters. Compared to if we do the comparative analysis between the BSE or the CDSL on the technical spurt, I believe CDSL looks good on the technical front as of now, because we have seen a price correction and it has forming a bottom out nearby 1050 levels. So we are likely to witness a sharp uptick or say the bounce back rally for a short term period of time, which might take a counter towards to 1300 odd level. So at the current market price, one should create a long position or one can hold on also. For the BSE, I believe that more selling pressures can be seen in the coming few trading sessions, and the stock is likely to find out a bottom nearby the 4000 or 3800 level. That level, if it's come down, then we can see some sort of a support formations, but not at the current price momentum. So I'm positive on the CDSL compared to the BSE.
So comprehensive view on both of those based on the charts. It's time to hit the rapid fire segment. Astha, Swati, you know what this means. We'll throw as many questions at you over the course of 2 minutes. Do keep your answers as brief as possible. The first one's on Canara Bank, and this is Aman's question. He's bought at levels of 85.24, 600 quantity. Should he hold or buy more? Swati?
Yeah, you should hold. Upside target I'm looking for 90. Stop loss can be kept at 80 levels.
All right, Tamil Nadu Mercantile Bank is the next counter. Regan Rajan from Madurai is asking this question: should he hold or exit? What's the view like, Astha?
I would recommend to hold on this counter with a price target of somewhere at around 425 to 450.
Okay, that was Rangarajan's question. IRCTC is the name of the counter. Abhishek wants to know 1000 bought at levels of 700 for the short term. Swati?
Yes, you can hold on. This particular counter downside support is placed at 650. The bounce back rally can be continued towards to 720. So it's hold from my end.
All right, PTC Industries is the next counter. 2000 shares have been bought by John at 175 piece. What's the view like, Astha, from a longer term?
Longer term is looking positive. Remain invested in this.
Okay, Indian Hotels bought at levels of 725. Gul wants to know whether you would add more at the current level. Swati?
Yes, you can add on every dips towards to 700 price, not at the current price. Positive momentum can be carried forward towards to 780. So view is positive.
All right. Muralidhar from Hyderabad has bought 200 shares of Rate Gain at 742 a piece. His holding period is 9 to 12 months. What's the view like with respect to charts, Swati?
The Rate Gain CS definitely view is positive. Downside, it has a cluster support at around 470. Upside rally can be extended towards to 600. So you can hold on the long position.
Astha, Marine Electricals, any view on this one? We've got Vinay who's bought at levels of 250.
No, I don't track this counter. Sorry, okay.
No problem. BPCL, what about this one? It's up and about in trade today. 289 is the buy price. Vikas Thorat wants to know hold or exit. Swati?
You can hold on this particular counter because upside rally can be extended up to the 260. So every rise towards 260, one can book their profits or exit the long position. But at the current market price, you should hold on.
Hold is the call on BPCL. All right, Asta, Swati, on that note, thanks so much for joining in, for answering all the questions that you did. Always a pleasure having you on the program. All right, and that brings us to the end of this edition of Ask Profit. Thanks so much for joining in from Mahima and myself and the team that put this show together. Thank you so much for watching. Do stay tuned. This is NDTV Profit.
Very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers, and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where
Hello and welcome. This is KYC, a show designed to give regular investors powerful, actionable insights into the fundamentals of a single NSE listed company every single day. Well, the summer months are upon us. They will be, of course, in a certain next few weeks, notwithstanding the heat wave that many regions in India are already facing. Well, we are taking up a company which addresses exactly that, Symphony. This company, as we all know, is one that focuses on coolers specifically. And of course, not only does it manufacture, but also trades and markets air coolers across India and certain other regions in the world as well. Well, it does have a presence in the domestic markets where it is, of course, the largest player here as far as air coolers are concerned, but also has a considerable presence in international markets. As far as its presence is concerned, it is considered to be one of the largest air cooler manufacturers, in fact, in the world. And it doesn't just look at residential, but also looks at commercial and industrial coolers too. So that gives the company that much of an optionality and an advantage as well. Well, notwithstanding that, there have been times of late where there's been a little bit of volatility with respect to earnings from the company. But if you disregard that, there certainly has been a dominance as far as its presence in the coolers space is concerned. While there are a lot of other companies, there are a lot of other listed companies who also deal in coolers, it does seem like that at the moment that Symphony has taken it upon itself to focus only and essentially on the cooler segment. So that is something which stands out for Symphony. But, I'm going to shift focus to all that we're going to talk about with respect to Symphony. So, as usual, what we tend to do is that we talk to you about the company's fundamentals. So, we start by taking a look at the income statement. We take a look at the balance sheet and how things are panning out. Cash flows, of course, along with return ratios. And once we're done with the financial statements, we look beyond and take a look at the shareholding pattern, how the company's stock has done over the past many periods, not to forget the valuations as well as street coverage. So these are some of the aspects that we are going to take a look at. Of course, when it comes to valuations, we will also compare it to some of their closest peers in this case. But to take us through some of these aspects, I am also joined by my colleague Mahima Vachrajani, who's going to also help us elucidate further as to how things have panned out. So, Mahima, good morning and thank you for joining in. Let's start by looking at how things have in fact panned out when it comes to growth in the bottom line for Symphony.
Right. So, in terms of the four key metrics, that we always evaluate where income statement comes into picture, revenue as well as net profit, both have seen, high single digits or an early double digits growth when we see the 3-year CAGR. Revenue in terms of 9 months FY25 stood around 1,088 crores. The 3-year CAGR for revenue has been around 8.7%. EBITDA CAGR has been 6.5%. This is a 3-year CAGR, of course. Margins, however, have improved for the company from 14.7% in FY24 to around 19.4% in 9 months FY25, and this is because there are certain margin accretive products which are now picking up in terms of sales, and they've also taken initiatives to optimize their costs, which is why margins are going up. But net profit overall has also had a 3-year CAGR of around 11%. So since the growth is in high single digits and low double digits, we're giving a thumbs down when it comes to the income statement. In terms of the subsidiary performance, 9 months performance, Mexico saw a revenue growth of around 8% in INR terms. China revenue growth was around 2 times. But China, of course, is on the lower base as well. It's comparatively newer. Brazil revenue growth was at 61%, and Australia, however, is not performing well for them. The Mexico and the Australia subsidiaries are also going under transformation, and the focus in both of these areas is reduction of cost. And for Australia specifically, the management has said that they plan to reduce costs from around 15 million to around 7.5 million. In terms of product developments, recently in the past 9 months, they've launched 17 new model of air coolers, which are the high margin accretive coolers, and they've also entered into the water heater segment. So in terms of the where income statement is concerned, it's a thumbs down, but overall subsidiaries are doing well except for Australia, and new product launches definitely working in favor of the company.
Okay, so that's as far as your income statement is concerned, and again, I know that we've been talking about how things have potentially panned out for some of its subsidiaries. So, of course, as we've been talking about, Australia, Mexico, China, and Brazil have been showing some amount of contribution as far as growth is concerned. but we'll potentially take this up with the management as well in terms of what we can in fact expect going forward. But I'll talk about the balance sheet at the moment, and it does seem like it's in a reasonably good place as far as the balance sheet goes, because firstly, its net worth at the end of FY24 stood at around 750 crores, and it doesn't have too much of a gross debt, so it does seem like it's in a comfortable place. In fact, its cash and bank stood at around 43 odd crores at the end of FY24. So it actually has negligible debt on its book, which always bodes well for the company. It's nearly the same when it comes to the first half of this financial year as well. Not much has changed there. And well, again, on a virtual basis, net debt free, which means that as far as its balance sheet is concerned, it's in a fairly good place, and which is why we'll give this one a thumbs up as well. In that case, on the Mahima, let's also talk about its cash flows and cash flows from operations particularly.
Right. So, in terms of cash flow from operations, there has been, a trend where they have improved as compared to the first half of FY24. First half of FY25 has done much better. FY24, the numbers stood around 353 crores, which is now come up to around 494 crores. And net cash flow position for the company has turned into positive. In first half of FY24, it was a negative cash flow of around 28 odd crores, but that has now turned cash positive, and it stands at around 5 crores. So, since both the cash flow from operations as well as the net cash flows are improving, and the net cash flows have turned positive, we've given a thumbs up when it comes to the cash flow metrics.
Okay, so that's as far as cash flows go. I'll talk about return ratios. We want to talk about the dividend payout ratio as well, but we'll talk about that a little later on when we take up street credentials, because, it just adds up in that particular area. So I'll talk about return ratios right now. Firstly, when it comes to your return capital employed and return on equity, the ratios are sub 20%. This is a consumer durables company, so it's not unlike you can't have 20% return ratios, but at least as far as Symphony is concerned, for 2023 the ROC stood at around 18%, and that's actually come off further. That's also bearing in mind that it's been a challenging handful of quarters for Symphony as well. Return on equity, again, there's been a little bit of an improvement over the last 1 year. There's no doubt about that. But this particular one is also below the mark of 20%, which means that we're going to give this particular aspect of the return ratios a thumbs down. And while we have seen an improvement in ROEs, ROCEs has also come off, and this particular year is also going to be one which has already turned out to be a challenging one given the way things have panned out over the last 9 months. It's going to be a wait and watch as to how things could pan out eventually for the final quarter of this financial year. And do remember that this final quarter of the financial year also has a little bit of a seasonality effect, which in fact plays in favor of the company. Hence, we'll just wait for the last 15 days and the earnings to come through over this, and then perhaps we can take a better look at some of your return ratios as a metric as well. But for now, it's a thumbs down. Mahima, why don't you tell us about shareholding then in this case right now?
So, in terms of shareholding, the promoter hold is definitely strong in this particular country, and it hasn't changed, since years. I mean, if we compare March 22 position to December 2024 position, the promoter holding has probably increased from 73.2 to 73.4. So, promoter holding in the company is pretty strong, which is why we've given a thumbs up. In fact, the FII position has also improved from 4.5% in March 22 to around 6.8 in December 24 as well, and we are seeing that FIs have steadily increased their stake in this particular counter. DIs, however, have been kind of reducing their stake. DIs were holding around 10% in March 2022, which has come down to around 9% in September 2024, and further come off to around 8.5% in December 2024. So in this case, FIs are kind of steadily increasing their stake, but DIs are kind of steadily decreasing their stake. And in terms of public shareholding has pretty much remained within the same range. It was around 12% in March 2022, which has gone to around 11% in September 2024, and as of December 2024, it stands at around 11.3%. But overall, strong promoter holding, FIs also steadily buying, and that's why we've given a thumbs up where the shareholding pattern is concerned.
Just a quick note on DIIs as well. At the moment, for all the companies listed with an ownership of over 1%, we have HDFC Mutual Fund only. But over the past many quarters, there have been plenty of AMCs who have held Symphony at some point of time or the other. Of course, we must remember that it's been a very volatile bunch of months, not just for Symphony, but the entire mid-cap and small-cap space. And I'd reckon that Symphony will be, one of those companies where the shareholding of some of these AMCs will have gone sub 1%, which is why they don't show up in terms of ownership right now. But it doesn't mean that a lot of these, AMCs don't have ownership in the company. But the other, of course, positive here is that we just have about 11% out there in terms of the hands of retail and HNIs, which means that there's a little bit of scarcity as well, because a majority, that means nearly 89%, is held by promoters and institutions. And the assumption here, of course, is that a lot of these institutions hold on for the long term, which also gives the company a little bit of a scarcity premium, so to speak. So that's as far as your shareholding is concerned. But I come to the aspect of street credentials. So when it comes to returns for this particular company, we do know that it's been a challenging time for the entire mid-cap and the small-cap space. And I'd reckon that Symphony has also been, a victim of this particular correction, so to speak. So we have seen a slide of around 31% in the last 6 months. And if in fact, year-to-date basis also, we've seen a decline of around 16%. But Symphony has also underperformed the respective mid-cap and the small-cap indices as well. And besides that, the only thing that could potentially work in favor of Symphony is a fairly decent dividend payout ratio. Now, remember that this is meant to be a growth company because of the size at which it currently operates, but it does give out, it does have a fairly large dividend payout ratio, which may work in favor of the company. As you can see, 61% in FY24. But as far as your returns are concerned, if you're looking for capital appreciation, and usually investors look for capital appreciation for a size at which Symphony operates, that's just not come through. And while we can understand that there could be a little bit of a decline on account of your overall weakness in the markets, well, it's going to be a wait and watch whether or not if the recovery comes in at what point in time. It's not like it's been a growth stock, because as Mahima has already mentioned, we're not looking at anything in terms of your net profits on your top line growth over the last 3 years. So it's been a challenging time, and that's also the reason why we are looking at that, below average price action with respect to the respective mid-cap and the small-cap indices. But that's as far as your returns go in terms of price action. Has that had any impact on valuations? Well, Mahima, why don't you tell us that?
Right. So, not really, because valuations, on a standalone basis still look expensive, because 12 months trailing PE, it stands at around 51 times. Going ahead also, as per Bloomberg estimates, 2025 and 2026, 2025 it goes to around 32 times, 2026 it goes to around 28 times. So still not looking cheap, but as compared to peers, something like a Whirlpool or a Blue Star or a Voltas, although Blue Star and Voltas are into ACs, but still, since they are, they produce, products that are useful in summers, that is ACs, they are, if they're not like peers, they're still peers, which is why, as compared to peers like Whirlpool, Blue Star and Voltas, the valuations are a tad bit better for Symphony, because Symphony is 12-month trailing at 51 times, but Whirlpool is at 54, Blue Star at 97, and the most expensive one is Voltas, which is at 179 times. So since on a standalone basis it does not look very cheap, but as compared to peers, it is a tad bit better. We've given a neutral rating where valuations come into picture.
So there's no taking away of the fact that the entire sector is looking at a little bit of a slowdown. But that said, we still have at least the street giving a considerably higher growth rate for, well, some of its peers like Blue Star. On the other hand, we also have a lot of volatility in earnings for a company like a Voltas or a Whirlpool. I want to make this mention again, something that Mahima has spoken about. It is not a like-to-like comparison because Symphony in this case focuses essentially on coolers, whereas all the other peers do have a lot of the other segments which they cater to as well, which is why it may not be a completely fair picture in terms of comparing Symphony with perhaps a Whirlpool, a Blue Star or a Voltas, but it's just that in the listed universe, these are some of its relatively closer peers. And as Mahima once again mentioned, that it does currently trade at a discount to, well, its overall valuations when it comes to its peers. But I'll come to analyst recommendations then. So firstly, on the street, there are 8 analysts who cover the stock. And of these 8 analysts, we have 4 analysts who have a buy on this particular company. 2 analysts have a hold and 2 have a sell. So when it comes to positive versus potentially not going anywhere, it's a 1:1. And which is why we're going to give this a neutral rating as well. Sure enough, if you do take the consensus, well, target price for Symphony, that entails a 34% return potential from current market levels. So there's a 35% upside from current market levels. And that's something that you can take in, you can consider, which is why we're going to give it a neutral rating as well. So that actually brings us to your overall rating. So let's bring that aspect, into consideration as well. Now, notwithstanding the volatility that the entire sector has seen in terms of, the earnings, there you have it. These are some of the ratings that we're giving. So very strong balance sheet, very strong cash flows, income statement. We're seeing growth, but maybe not to the extent that the street may expect. And moving on to the next set of, parameters, shareholding, of course, looks very strong. Valuations and street coverage, well, it's going to be a neutral rating. So the question really is that how much does it score? Well, it gets a 4 out of 8 at the moment. But let's move on and talk about certain other aspects. We do have the management here with us, and Rupesh Shah is waiting by to talk to us. But before that, I want to just quickly explore a handful of other ideas before we actually take this forward with him. So, Mahima, let's talk about the outlook as well.
Right. So, in the recent investor presentation, they did mention that, there's a robust summer demand which is coming in, and that calls in for a higher demand in the margin accretive products. And there have been good responses that they've received in these margin accretive models. They've also said that there is decent traction and thrust in semi-urban and rural markets, and of course in adjacent product categories, which will augur growth going ahead. And they're focusing on expanding product portfolio in Australia. And long-term strategy includes leveraging the Chinese subsidiary also for sourcing components and expanding geographically as well. So these are some points to definitely ponder upon, because they are expecting a strong summer demand as well as planning to expand into more geographies. So these are the few guidances or outlook that the management has given with respect to the recent Q3 earnings call.
Okay, on that note, let's get in Rupesh Shah. He's the Managing Director of Corporate Affairs at Symphony, who's joining us. Mr. Shah, good afternoon, and thank you so much for taking the time out. The question clearly will be, in this case, the outlook for the upcoming summer, because that's essentially what we wanted to understand. In the past couple of years, the summer has been brought forward, which means that a lot of the sales already start taking place. A lot of the seasonal sales start taking place towards March and then onwards April and May. Can you give us an idea about what you are expecting as far as this particular summer season is concerned?
So as we pointed out earlier, season has begun very well. In fact, there is early summer, and not only there is a trade demand, but in some pockets of the country, there is an early consumer sales of air cooler, particularly South India and few other pockets of the country. And this is coupled with last year at the end of the summer, trade wasn't left with any inventory. So that is also helping overall. So in nutshell, we expect very robust growth and performance during the quarter.
Mahima also joining in, I just wanted to understand, with respect to all of your subsidiary, what's the outlook like? Because Mexico has shown a revenue growth of around 8% 9 months. China, of course, on a back of a lower base, growing at around 2 times. Brazil has also been resilient when it comes to growth, but Australia is the weak pocket for you. What's the outlook like for all of these subsidiaries, and especially for Australia, because you are, undergoing a transformation there?
So Australia is still bleeding, and the first phase of transformation in Australia we are done with. So cost of doing the business on its fixed overheads, we have succeeded in reducing to less than half. When we acquired, its annual overheads were more than 15 million Australian dollars. Now it is less than 7 million Australian dollars. Second phase of transformation is almost done. That is converting completely integrated manufacturing facility into outsourced manufacturing, asset light, capital light, and on top of it, launching host of new products and direct selling to the consumers, establishing the dealer distribution network. That is in very advanced stage. And we believe that once we are done with that, just like IMCO Mexico as well as GSK China, their initial phase was like this. It is exactly at that stage. And I believe that in a year or two, Australia should also turn around. Coming to our other good subsidiaries, that is IMCO Mexico as well as GSK China, they are doing very well and they are on a very strong growth and performance trajectory. And so is Brazil. Brazil is essentially a trading subsidiary. So essentially Brazil should be seen as exports from India, because there we do have a decent profit in India as well as margin at trading subsidiary level.
Okay. Mr. Shah, with respect to a couple of things. You've mentioned that your long-term strategy does include leveraging the Chinese subsidiary for sourcing components, and this is because you want to expand geographically as well. What are the plans where geographical expansion is concerned? Which are the other areas that you're planning to tap into?
We are not planning any further acquisition, whether in the country or internationally, because we believe that all important geographies and territories we are well covered. We can really serve very well from our existing companies. And in each of these geography, there is a huge potential to have organic growth.
Mr. Shah, the way I see your 9 months pan out, it certainly looks like you guys will register a good growth in FY25. I'm not asking you for a guidance, but I do want an indication of whether or not your growth rate for FY26 will be better as compared to what we have seen over the past 2 to 3 years.
Again, it amounts to guidance, but all signs are summer is likely to be good, and so our June quarter performance may be good, and that drives the performance of the entire year. And in that case, in line with 24-25, we expect strong 25-26, not only Symphony India, but also our international subsidiaries.
And so I'm assuming that with the hope from investors' point of view that you do see a double-digit growth in FY26 as well, do you think that margins could come in at around 18-19%? Because that's what we've seen in the first 9 months of the FY25. Do you expect to hold on to these margins, or do you think there will still be some challenges which will be taken care of over the next few quarters, and after that you start seeing a sustainable margin guidance of around 18-19%?
So whatever EBITDA margin percentage we have witnessed in first 9 months, we believe that we should maintain it. Maybe in the current quarter, we should improve upon that.
All right. And Mr. Shah, one last question, with respect to the new models that you've introduced. In terms of these new models, they are margin accretive. Maybe you'll maintain this, margin guidance in 9 months FY25. Going forward, FY26, 27, what's the scope of margin expansion? Because the new products that you've already mentioned are margin accretive, are comparatively newer, but will have a further effect going forward in FY26 as well as 27.
Depends upon the sales mix and product mix, but we believe that our current quarter, in terms of the EBITDA margin, should see the effect of EBITDA margin on new models, and down the line, that improved EBITDA margin percentage should be maintained.
Well, Mr. Shah, we'll leave it at that. Thank you so much for joining us here and talking to us here at NDTV Profit.
Pleasure.
So there you have it. So a lot more clarity, and certainly with a little bit more of a positive outlook coming in. Well, the management has already suggested that firstly, that summer has already picked up, and because of that, seasonal sales have also started contributing to the top line, and they are hoping that the FY26 will be a lot stronger in terms of your operational metrics. But on that note, we are completely out of time on this edition of KYC, but lost my lineup on the other side. Stay tuned in, and we'll be back in just a bit.
Very, very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers, and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Very, very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and
Hello and welcome. Good afternoon. Welcome to The Big Story. This is Malika Mishra, and today we're talking about something really important. US President Donald Trump has signed into forcing tariffs on Mexico, Canada, and China. Mexico and Canada face 25% tariffs, while the cumulative tariffs on China work out to be 20%. Speaking at the White House, Trump said there is no room for delay. Now, apart from these, Trump has already slated he will impose 25% tariff on all steel and aluminum imports from all countries. He has also spoken of his plans for sectoral tariffs on autos, semiconductors, and pharma, which could be imposed from April 2nd. Canada retaliated to Trump's tariff move by announcing a sweeping package of tariffs on $107 billion worth of American products. Prime Minister Justin Trudeau took a confrontational stance in a statement. Mexican President Claudia Sheinbaum stated that her administration will take a decision based on what the US does in terms of tariffs. And China plans to levy tariffs up to 15% on some goods, including agri items like soybeans, chicken, and beef. It also intends to file a lawsuit to WTO over America's additional tariffs. The other part of the tariff story is reciprocal tariffs. As far as India is concerned, April 2nd is the deadline for these reciprocal tariffs to come into effect. Commerce and Industries Minister Piyush Goyal is in Washington right now to finalize the bilateral treaty and to hold talks on the quantum of reciprocal tariffs. India has also lowered tariffs on some American goods in a preemptive move. Now, let's get you some global voices on the Trump tariffs. Sentiment is really low due to Trump's tariffs. That's the word coming in from Matt Orton of Raymond James Investment Management.
Obviously, markets hate uncertainty, and I think that's where we are right now. There's uncertainty with respect to how long these tariffs might actually be implemented for. I don't think markets, whether the equity markets, currency markets, bond markets, I don't think anything has fully priced in what tariffs might look like if they are left to be implemented in the current state for a longer period of time. That being said, sentiment is nearly washed out, particularly in the U.S. equity markets. I think in Indian markets too, sentiment is incredibly low on the retail side. In particular, earnings, the actual fundamental backdrop for the market remain very strong, particularly in the U.S. And a lot of management teams that I speak with, they're thinking about tariffs and they're factoring some of that into their expectations going forward. So while we might be seeing a little bit of economic weakening with the intersection of tariffs coming in, I still think as we let all of this play out and digest what this means for the market, there will be an opportunity on the other side of this to perhaps buy the dip that we see, but we're definitely not there yet because there's still a lot more that I think has to play out in the near term with respect to where we eventually go on the tariff front.
So Trump has done what he said he would do. And he will make America great, says Jonathan Barrett of ETO Markets. Here's his view on how the markets will react to tariffs.
I think, as Donald Trump always does, he comes out punching. And then I've been a little bit surprised here that I haven't seen more rhetoric come from Mexico and Canada, and also China in terms of, okay, once they go into play, these tariffs, what retaliations are we actually going to see? And is the market actually looking at these? Because it seems to me that the market is just purely focused on a tariff, which eventually is inflationary down the track. That's why we're seeing the Fed hold off a little bit, because they're unsure of what's happening. Investors are unsure what's happening. But at the end of the day, if they're not coming, people aren't coming to the table to discuss these tariffs. Remember, Trump has done what he has said he will do, and he will make America great. And if that means protectionist policies, that's what he's going to put in place. The flip side of that are the problems that we're going to see once you put those tariffs in place, because the economy might slow and you'll get to that scenario where you get inflation again and the economy slowing. And I think that's where investors now are starting to turn towards and say, well, hey, hang on, this is what's happening. This is what could happen. And we could get that sort of, stagflation style of economy, which China has been trying to get away from so many years and is just finally starting to do it.
Now, while we have listened to the experts talking about the implication of Donald Trump's tariffs globally, it's also important for us to look into the statement that he made on imposing these 25% tariffs on Mexico, Canada, and China. Take a look.
On the tariffs, is there any room left for Canada and Mexico to make a deal before midnight? And should we expect those Chinese tariffs, the extra 10%, to take
No room left for
Mexico or for Canada. No, the tariffs, they're all set. They go into effect tomorrow. And just so you understand, vast amounts of fentanyl have poured into our country from Mexico. And as you know, also from China, where it goes to Mexico and goes to Canada. And China also had an additional 10, so it's 10 plus 10. And it comes in from Canada and it comes in from Mexico, and that's very important.
Now that Trump has announced tariffs, what is the impact of these tariffs on Indian markets? Well, my colleague Somit is here to explain us the details.
So first, let's see what has been announced or what could be announced in the next couple of weeks. Firstly, it's the 25% tariff on all imports coming in from Mexico and China. Then there is a 10% additional tariff on China, which will take the cumulative tariffs on China in the last 1.5 months to 20%. Then there's a possibility of 25% tariff on steel and aluminum imports from all T8 partners from March 12th. And then in April, there's a possibility of the reciprocal tariff coming in. Firstly, let's try and understand the impact of the tariffs that could come in the next couple of weeks and which Indian companies stand to either benefit or lose out of it. Firstly, coming on to the chemical companies like PI Industries, UPL and Jubilant Ingrevia. Now, these three companies stand to benefit because these three companies are manufacturers of the top 5 chemicals that are imported by US. So if there is any tariffs on China, then these three companies could stand to benefit. Now, when it comes to the auto ancillary space, it is a bit complicated. Companies like Samvardhana Motherson, Bharat Forge, Sona BLW, JK Tyre, Balkrishna Industries, Sundaram Fasteners and Timken India. All these companies have direct exposure to US, but the impact could be limited because most of them also have plants in US. But given the complex auto supply scenario that is there, an auto supply chain there could be an indirect impact on all these auto ancillary companies because auto ancillary companies customers, that is the OEMs, have a high dependent on Mexico and China for manufacturing to serve the US market. All these companies, that is Ford, GM, Volkswagen Group, BMW, Mercedes, have manufacturing units in Mexico and Canada which serve the US market. So any tariff could lead to pricing pressure for this auto ancillaries as well. Now, when it comes to metal companies like Vedanta, Hindalco, Nalco, SAIL, JSW Steel and Tata Steel, no direct impact because we hardly import metals to the US market, so no direct impact. But again, this tariff imposition may have an impact on the steel and aluminum prices because of the changing demand-supply scenario, so that could impact these companies. Also, the indirect impact could be on steel dumping coming in from China, South Korea and Vietnam in the Indian market, so that could impact the steel players as well. Now, apart from that, two companies that stand to benefit directly, JSW Steel, they have a 1.5 million ton capacity in Ohio, which contributes nearly 4.5% to the total revenue, and this stands to benefit if prices move higher. Then there is Hindalco. Now, for the Novelis unit, the impact is still not sure, given the fact that the company could benefit from higher aluminum prices, but on the flip side, the raw material prices could also move higher for the company. However, the company believes that they can be exempted, like something similar that happened last time as well. So currently, we do not have a clear view about what happens to Hindalco as a subsidiary, that is Novelis. Then there is one company, Cummins, that could stand to benefit because higher tariffs on Mexico may open up higher prospects of exports for Cummins India. Currently, exports is a very small portion for the company, but Cummins Mexico unit exports nearly $1.5 billion of components and diesel engines to the US market. And if there are tariffs, this or part of this exports could move to the Indian unit going forward. And lastly, it comes to the IT sector. Now, direct impact is very limited via nearshoring from Mexico and Canada, less than 5% of the supply, so not much of an impact, but still a list of companies that have direct exposure to the US market are Infosys, LTI Mindtree and HCL, which have a highest exposure, and companies that have the least exposure are KPIT Tech, Tata Tech and Tata Elxsi. So keep an eye out for these companies, given the fact that tariffs could come in the next couple of weeks.
Well, very much needed information on the impact of Trump tariffs on various sectors in the Indian market, but also let's get your view on Trump tariffs coming in from an industry veteran. Tata Sons chairman N. Chandrasekaran was unconcerned about tariffs. He was speaking in Jamshedpur at an event at Tata Steel. Take a look at his comment.
But the most important thing to recognize is steel का demand बढ़ेगा और उनको capacity डालना चाहिए. And in short term to medium term, these cycles will continue. We have seen ऊपर भी देखा है, नीचे भी देखा है. So the best way to be prepared इस एफिशिएंसी में जाना चाहिए। कॉस्ट मैनेजमेंट हर एक साल टारगेट रखना चाहिए और प्रोडक्टिविटी इंक्रीज करना चाहिए। So we will continue to run an efficient operation. For that, सबको साथ में लेके जाना पड़ेगा। हमको एम्प्लॉइज़ का मदद चाहिए, गवर्नमेंट का मदद चाहिए, पॉलिसी वगैरह में गवर्नमेंट का मदद चाहिए। जो हमारा कंट्रोल पे है, लाइक प्रोडक्टिविटी एफिशिएंसी, उसमें ध्यान रखना चाहिए। ठीक है। No point in talking about what will be the price, what will be the tariff. That जो होगा होगा, हम गवर्नमेंट के साथ बातचीत करेंगे और whatever help government has to provide, government will provide, but we have to be efficient.
Now, as this global trade war looms, how will these tariffs affect oil marketing companies? So Amit is joining us again to explain exactly that.
Well, yes, oil marketing companies remain in focus. There's a potential double dhamaka for them, given the fact that oil prices have come down to around $71 per barrel level, which is the lowest that we are seeing in 2025, while gross refining margin, or the Singapore gross refining margin, which is the Asian benchmark, have climbed to nearly $5.4 per barrel, again the highest level that we are seeing since 2025. Now, higher GRMs and lower crude prices benefit oil marketing companies on earnings point of view, but do remember that actual financial benefit will only be realized if current prices remain at the current level for a longer period of time. Now, for refining margin, on the refining side, if you look at every $1 per barrel rise in the gross refining margin benefits MRPL's EBITDA by nearly 1,000 odd crore rupees. It increases Chennai Petroleum's EPS by around 30%. For Indian Oil Corporation, BPCL and HPCL, their EPS goes up by nearly 14 to 16%, and for Reliance Industries, the consolidated earnings increases by around 4 to 5%. But then again, for actual benefits to realize, Singapore gross refining margins need to remain at the current levels for a longish period of time. Now, when it comes to a marketing side, lower oil prices boost the gross marketing margin that the oil marketing company earns on selling every liter of petrol and diesel. Now, current fuel refining marketing margins, if you look at, is at around 9 rupees per liter for petrol and 7 rupees per liter at diesel, which is at a multi-quarter high for both the retail fuels. Now, every 0.5 rupees per liter increase in the gross marketing margin benefits Indian Oil Corporation's EBITDA by nearly 7%. For BPCL, it increases their EBITDA by nearly 8%, and for HPCL, the delta is much higher at around 11%. So keep an eye out for oil marketing companies, given the fact that GRMs have risen to 2025 high levels and crude prices are at 2025 low, and both these factors could boost their earnings if the prices remain at current level for a longish period of time.
Well, now you just heard N. Chandrasekhan be unconcerned about these Trump tariffs, but domestic investors back in India do seem to be concerned and want to know how will this Trump tariff affect their investments here. Now, the advice for retail investors from market veteran Ajay Bagga is to continue investing. He said that the markets are likely to begin recovering after 2 to 3 months. He also said tariffs are not likely to have a big impact on India. Take a look at his comment.
I would say every time is a buying time, and you should regularly keep buying. Now, as far as the bottom of the market is concerned, mathematically we can prove that, okay, now the valuations are this, valuations are that. One, valuations is an art. It's not a science. We don't know if it will actually come at 9%, or as you said, it might be 7, it might be 11, it might be 15% earnings growth also. So we have to look at history. We have to then aggregate it company-wise and make a portfolio. I would say we are probably about a couple of months into the bottoming process. It will take time. It won't happen very rationally, very scientifically, that the market participants will realize that, say, the Nifty is now below its 10-year average trailing PE. And now let's start buying. That won't happen. Mostly the momentum on both sides, Neeraj, it takes the markets up or down. So there is an overshooting that happens. Right now, we might be in the overshooting. That we will know a year down the line that, yes, this was the time when the turn should have happened, but the market overshot and then it made a turn. But Definitely, yes. It's not the September end market of all-time highs. Is it going down 10% more? I don't think so. I think there's a very little probability, unless there is some shooting war or some geopolitical big event comes in. I think overall, the tariffs of Trump will not have that big an impact on India. They might bring in recession in pockets of the world. So that issue remains. But overall, I think we have weathered it well and we are near to the bottom. Now, whether it happens this week or 2 months down the line, it's an art, it's not a science. And I would say these numbers just give you an idea that now it's looking good. Is it very compelling? I think right now people are really hurting, with the 94 lakh crores of valuations that have evaporated. It's tough to tell people to bring in chunks of money. I would say regular money over the next 6 months, keep investing, because first the bottom will form. Recovery will take time again. Recovery will follow corporate earnings. Now we have a base effect coming in from June quarter. You will see better year-on-year numbers coming in because the slowdown really happened June and September. December, we have seen the small incipient recovery starting, and probably earnings bottomed out in December. So the next 9 months from April to December will give you a good base effect, and then markets will react in anticipation of that. So I think bottoming maybe 2 to 3 months from now, and then recovery takes another 3 months. And by year end, hopefully, we would have reached back where we were in September of 2024.
So according to Ajay Bagga, we might now be in pain, we might be hurting, but in the longer run, we will definitely recover. But just like how a coin has two sides, there are two different opinions and views of what's happening around Trump tariffs as well. Tariffs are not good news to the rest of the world, including India. Tariffs could unsettle the economy, says Manish Dangi, founder of Macroeconomic Investment and Research. Take a look at why he said so.
So it's a chess game, Neeraj. It has long, short implications. The man he is a lot more ideological today than he was in the first term. He is more determined. He has less worry of its impact, the first order impact on equity markets, almost certainly. Trump 1 was obsessed with equity markets. This time, one wonders whether he and Besant are actually obsessed with bonds instead of equity, So the primary objective seems to be sort of bringing down the sort of a bond. Now, tariff, as such, of course, it at margin in US for the first order is going to be inflationary, but eventually the growth actually takes a bigger hit. And which is why typically when, big tariffs sort of are imposed, eventually, paradoxically, rates actually come down. They don't go up in the US, So that's one implication that I kind of think which could be somewhat different to what a lot of people argue, So empirically, tariffs could drive rates lower. Tariffs almost certainly are bad for profit pools, Neeraj, and therefore, I kind of think that US markets are extraordinarily expensive and somewhat extremely dismissive to the impact that they will have, both in terms of economic impact and also the profit impact. So I think, there could be a substantial re-rating of US markets because of tariffs also. But hey, the most important thing, Neeraj, is actually what tariffs do is to the outside world, and which is an out-and-out malignant, So even though, let's say, we are not large exporters to US or, relative to US's size, tariffs could actually be sort of quite unsettling for our economy.
Okay. And just before you dwell on that point, Manish, can I just question you on the first point that you made? The normal line of thinking would be that if there are tariffs imposed, it makes a lot of goods, presumably services, expensive for the United States, and therefore it should be inflationary. You are giving the counter argument. Why so?
You see, the thing is that, everything in the economy are linked. So basically, the countermeasure that the macro does when tariffs are imposed. Let's say if US were to impose 50% tariff on every country, on that day, big picture, I think the US dollar can appreciate by 25-30%, something like that. And so and neutralizes the impact of tariff whatsoever. So because these are open economies, so markets actually do the adjustments very, very quickly. So one of the reasons in September USTs have sold off was essentially as if that the tariffs would lead to higher inflationary expectations, but dollar also strengthened. So that is what is getting baked in right now, that the first order impact on the dollar would be strength of currency. Now, when the currency strengthens, in dollar terms, the TV and the fridge that they bought from China pretty much may cost the same. So that's how the tariffs sort of impact. It appears as if let's say nothing happened, if the dollar was pegged currency to CNY, then of course the very TV in the fridge and the automobile or anything else that the US bought would become expensive because of tariff. But if the dollar adjusts and appreciates, it won't. So I think that's why, as I said, the impact of, you get my point, the impact of this actually to the outside world is substantially more, because for us, the only risk currency is dollar. There is absolutely no way that dollar strengthens and India has a reflation. Reflation meaning, let's say, asset markets inflate. That's not possible at all.
Yeah.
We've discussed about it in 2022 many times, that how malignant the strong dollar setup is. If you have nothing else to sort of track in terms of risk on, risk off, just the USD movement itself is almost sort of a very, very cool indicator to track. And tariffs certainly actually means tighter dollar, higher dollar, so to say.
I'm now being joined by Vivek Kumar. He's an economist with Quant Echo Research. Welcome to the show, Vivek. Thank you so much for talking to us. My first question to you is, it appears that a tariff war has begun. China has retaliated with 15% tariffs. Canada has brought billions of US goods under higher tariffs. If I could say that this is, the initial sign of perhaps a larger global trade war, how do you think India is going to get impacted by all of this, and what does India's positioning at the moment looks like?
Thank you for having me on the show. Yes, indeed, it is the second leg of global trade war. The first global trade war started in 2017 under the first presidency of Donald Trump. This is obviously the second chapter of it. The second chapter looks much more devastating than what the first chapter looked like, because obviously in the first round of trade war, the political clout or the administrative clout that Trump enjoyed was lesser compared to the current regime that he has. So he has full majority. He is much more stronger to be able to push through some of his ideas internally within the government quarters. So this is going to be a much more impactful, if I can use that word, from a US perspective. And it is going to have a tectonic shift vis-a-vis how global trade was getting underway, or at least how it was being undertaken by various members. Now, from an India perspective, I think there are various angles to look at. One is that US, for us, is one of the biggest trade partners. Hello?
Yes, I can hear you, Mr. Vivek. Please continue.
Sorry.
No, that's okay.
So from an India perspective, what this essentially means is that US is one of our largest trade partners. So if you look at it from both exports and imports put together, US has about 10% weight in our total trade balance. And total merchandise trade. And if you just put in services also in the basket, then the importance of US actually increases manifold. Now, the question that one would probably need to find an answer to is, what happens when US takes a very hardline stance against India? Is this something which is there on the horizon? Well, as far as initial feelers are concerned, there is a possibility of US marking out India as one of the countries which has relatively higher degree of tariffs. And I think in the last 1 month, this has been a point which President Trump has been making, that they want to concentrate not just on universal tariffs. So what we saw in the initial rounds with Canada, Mexico, and China, those were examples of universal tariffs. You just, for example, China is a case of universal tariff, 10%, and then you top it up with another 10%. Similarly, Mexico and Canada is again an example of a universal tariff. India probably was not featuring in the list of universal tariff, but when the focus shifted to reciprocal tariff, that is where India probably will find its mention a lot more than desirable.
Right.
Because
And
all said and done, as of 2020, correct. All said and done, as of 2023, among the major trade partners, India's tariff stands out as one of the highest. It is somewhere close to, the differential is somewhere close to 9 to 10% vis-a-vis US.
Right, Vivek. Thank you so much. And I would also want to understand, you spoke about how, India has chosen to be very wise with its diplomatic stance at the moment. And there's a bilateral treaty also in the offering as well. What is the best case scenario for India as a country at this given point of time, and how can inflation be contained? Okay. We seem to have lost Mr. Vivek Kumar, but his points were very interesting. He said that Trump has more majority at the moment. He came to his second term with a lot more support as compared to his first term. And now he described the global trade war as a tectonic shift where India is trying its best to balance. India is one of our largest trade partners, and US holds approximately 10% weightage. We have Vivek Kumar joining us back again. And I'd like to understand, Vivek, as I was saying, that what is the best case scenario for India at the moment, and how can we control the inflation? Do we have Vivek with us? Okay, no problem. But we have lost Vivek, but we definitely have a lot to learn from his comments. And viewers, keep watching NDTV Profit for more news and updates. A lot more lined up for you on the other side.
Very warm welcome to you all for this NDTV Profit conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breathing also. You have to come down. So the correction and healthy correction is a very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers, and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
Hello and welcome to NDTV Profit. My name is Varsha and welcome to Profit Buzzers. Let's look at how our market's faring. Let's look at Nifty. Let's see Nifty. Nifty is actually kind of down 0.2%. Let's see who are the constituents. When it comes to losers, you have Bajaj Auto, you have Nestle, you have Bajaj Finserv, Hero Moto, Titan. When it comes to the losers list, there you go. While gainers, if I would talk about the gainers, you have SBI. Now this is on the back of Citi's note. Citi is bullish on SBI. We'll of course speak on this. You have BEL, you have Trent, you have BPCL, and you have TCS also, which are on the gainers list when it comes to Nifty 50. Well, let's pull up the Nifty sectorial heat map. Let's see how are the sectors there. Last time, okay, so there you go. So you have Nifty Realty, Nifty Bank, Nifty Media, which are in green, while rather Nifty Infra is down, and so pretty much back I mean few minutes before I saw that Nifty Realty, Nifty Bank and Nifty Media were actually in green, and except that all the sectors were in red. But now maybe the time something you see on the recovery mode, but let's see what let's see the market at 3:30 what it shows. When it comes to broader markets, let's see how broader markets are doing. So typically broader markets are actually doing good. They are not mirroring Nifty 50. Nifty Mid Cap 150 what to talk about is up almost 0.17%. Let's see who are the gainers there. You have Carborundum, you have GSK Pharma, you have Bharat Dynamics, you have Hitachi Energy, when it comes to gainers. On the losers list, when it comes to Nifty 150, the losers list, you have Paytm, you have Balkrishna Industries, you have Astral, you have Supreme Industries, you have Colgate, which are in the losers list when it comes to Nifty Mid Cap 150. Well, moving on, if you see it's Nifty Small Cap 250 now. Let's see who are the gainers there. Vijaya Diagnostic, let's just pull up that chart. Beautiful recovery. Rather, the stock is up almost 13%. Now this is on the back of MK's note, where MK had a note on whole diagnostic sector, who had a whole diagnostic sector wherein MK is actually bullish, or MK has rated buy when it comes to Vijaya Diagnostic, and that's the reason the stock is up almost 13%. But before that, let's just cut across to Prime Minister Narendra Modi addressing the second series of budget announcement. Let's see.
साथियों, आज देश एक दशक से भी ज्यादा समय से सरकार की नीतियों में इतनी कंसिस्टेंसी देख रहा है। बीते 10 वर्षों में भारत ने लगातार रिफॉर्म्स, फाइनेंशियल डिसिप्लिन, ट्रांसपेरेंसी और इंक्लूसिव ग्रोथ को लेकर अपनी प्रतिबद्धता दिखाई है। कंसिस्टेंसी और रिफॉर्म्स का एश्योरेंस एक ऐसा बदलाव है जिसकी वजह से हमारी इंडस्ट्री के भीतर नया आत्मविश्वास आया है। मैं मैन्युफैक्चरिंग और एक्सपोर्ट से जुड़े प्रत्येक स्टेक होल्डर को ये विश्वास दिलाता हूं कि ये निरंतरता आने वाले वर्षों में ऐसी ही बनी रहेगी। आप मेरे पूरे विश्वास के साथ मैं आपसे आग्रह करता हूं, पूरे आत्मविश्वास से निकल पड़िए, बड़े कदम उठाइए। देश के लिए मैन्युफैक्चरिंग और एक्सपोर्ट ये नए एवेन्यूज हमने ओपन करने चाहिए। आज दुनिया का हर देश भारत के साथ अपनी इकोनॉमिक पार्टनरशिप को मजबूत करना चाहता है। हमारे मैन्युफैक्चरिंग सेक्टर्स को इस पार्टनरशिप का ज्यादा से ज्यादा लाभ उठाने के लिए आगे आना चाहिए। साथियों, किसी भी देश में विकास के लिए स्टेबल पॉलिसी और बेहतर बिजनेस एनवायरनमेंट बहुत जरूरी है। इसलिए कुछ वर्ष पहले हम जन विश्वास एक्ट लेकर आए। हमने कंप्लायंसेस को कम करने का प्रयास किया। केंद्र और राज्य स्तर पर 40,000 से ज्यादा कंप्लायंसेस खत्म किए गए। इससे ईज ऑफ डूइंग बिजनेस को बढ़ावा मिला और हमारी सरकार ये मानती है कि एक्सरसाइज निरंतर चलती रहनी चाहिए। इसलिए हम सिंप्लीफाइड इनकम टैक्स की व्यवस्था लेकर आए। हम जन विश्वास 2.0 बिल पर काम कर रहे हैं। नॉन फाइनेंशियल सेक्टर के रेगुलेशंस को रिव्यू करने के लिए एक कमेटी का गठन का भी निर्णय हुआ है। हमारा प्रयास है कि इन्हें मॉडर्न, फ्लेक्सिबल, पीपल फ्रेंडली और ट्रस्ट बेस्ड बनाया जा सके। इस एक्सरसाइज में इंडस्ट्री की बहुत बड़ी भूमिका है। आप अपने अनुभवों से उन समस्याओं की पहचान कर सकते हैं जिनके समाधान में ज्यादा समय लगता है। आप प्रोसेसेस को और ज्यादा सरल बनाने के सुझाव दे सकते हैं। आप गाइड कर सकते हैं कि कहां पर टेक्नोलॉजी का उपयोग करके हम जल्दी और बेहतर परिणाम हासिल कर सकते हैं। साथियों, आज दुनिया राजनीतिक अनिश्चितता के दौर से गुजर रही है। पूरी दुनिया भारत को एक ग्रोथ सेंटर के तौर पर देख रही है। कोविड संकट के दौरान जब ग्लोबल इकोनॉमी में मंदी आई, तब भारत ने ग्लोबल ग्रोथ को रफ्तार दी। ये ऐसे ही नहीं हो गया। हमने आत्मनिर्भर भारत के विजन को आगे बढ़ाया और रिफॉर्म्स की अपनी गति को और तेज किया। हमारे प्रयासों से इकोनॉमी पर कोविड का प्रभाव कम हुआ। इससे भारत को तेज गति से बढ़ने वाली अर्थव्यवस्था बनाने में मदद मिली। आज भी भारत ग्लोबल इकोनॉमी के लिए एक ग्रोथ इंजन बना हुआ है। यानी भारत मुश्किल से मुश्किल हालातों में अपने रेजिलियंस को साबित कर चुका है। पिछले कुछ वर्षों में हमने देखा है कि जब सप्लाई चेन डिस्टर्ब होती है तो उसका असर पूरी दुनिया की अर्थव्यवस्था पर पड़ता है। दुनिया को आज ऐसे भरोसेमंद पार्टनर की जरूरत है जहां से हाई क्वालिटी प्रोडक्ट्स निकले और सप्लाई रिलायबल हो। हमारा देश ये करने में सक्षम है। आप सब सामर्थ्यवान है। ये हमारे लिए बहुत बड़ा मौका है, बहुत बड़ी अपॉर्चुनिटी है। मैं चाहता हूं विश्व की इन अपेक्षाओं को हमारी इंडस्ट्री एक स्पेक्टेटर की तरह न देखे। हम दर्शक बनकर के नहीं रह सकते हैं। आपको इसमें अपनी भूमिका तलाशनी होगी, अपने लिए अवसरों को आगे बढ़ाकर तराशना होगा। पुराने समय की तुलना में आज ये कहीं आसान है। आज इन अवसरों के लिए देश के पास फ्रेंडली नीतियां हैं। आज सरकार इंडस्ट्री के साथ कंधे से कंधा मिलाकर खड़ी है। एक मजबूत संकल्प, ऑब्जेक्टिविटी के साथ ग्लोबल सप्लाई चेन में अवसर की तलाश, चैलेंज को एक्सेप्ट करना, इस तरह हर इंडस्ट्री एक एक कदम आगे बढ़े तो हम कई मील आगे निकल सकते हैं। साथियों, आज 14 सेक्टर्स को हमारी पीएलआई स्कीम का फायदा मिल रहा है। इस योजना के तहत 750 से ज्यादा यूनिट्स को मंजूरी दी गई है। इससे 1.5 लाख करोड़ रुपए से ज्यादा का इन्वेस्टमेंट आया है। 13 लाख करोड़ रुपए से ज्यादा का प्रोडक्शन हुआ है और 5 लाख करोड़ रुपए से ज्यादा का एक्सपोर्ट हुआ है। ये दिखाता है कि अगर हमारे एंटरप्रेन्योर्स, अगर उनको अवसर मिले तो वो हर नए क्षेत्रों में भी आगे बढ़ सकते हैं।
Right, that's the Prime Minister of India telling us about the support that MSME sector can get at this point in time and the importance that it can, of course, have for the nation in propelling the environment and the economic factors forward. But we talk about fund flows. And speaking of fund flows, with rising yields and high valuations, foreign investors are making some big moves. They have sold $37 billion in the past 5 months. Let's bring in Somit to give us a breakdown of the FII selling patterns. Somit, over to you.
Well, yes, FII selling has been one of the major reasons when it comes to the fall in the Indian equity markets. In fact, to be precise, in the last 5 months, Indian benchmark, that is Nifty 50, has fallen nearly 20% on dollar terms, while the broader market, that is the Nifty mid cap and the Nifty small cap indices, have declined anywhere between 25 to 30%. And the major reason behind this is the sell-off coming in from the FIIs. Nearly $37 billion of Indian equities has been sold in the last 5 months by FIIs. Now, there are two reasons for which could have led to this sell-off. Firstly, the non-India factors. Firstly, it could be the fact that the global investors might be shifting to debt from equity, given the fact that US yields had risen to 4.5%. The second reason is the shift from India to other emerging markets and developed markets, given the fact that there has been a lot of global uncertainties on the back of the tariffs that are expected to come in. Now, when it comes to India-specific factors, the first reason is high valuation coupled with lower earnings growth. Now, we started the financial year, that is FY25, with earnings growth expectation of around 13 to 15%, But right now, we are seeing an earnings growth that could be just 5% for FY25. So that is one of the major reasons. Apart from that is the lower capital expenditure or the slowdown in capital expenditure owing to general elections and various state elections. And then there is tight liquidity and lower credit growth, which also constrain the overall economic growth in the country. So what or who are these FIs that have been selling this data? Now to come to that data, we have used the NSDL published category-wise foreign portfolio investors asset under management data. Now we have compared the September month data with the January month data to see which of the FPI categories have seen the biggest drop in their asset under management. Now why the asset under management would have reduced? It could have been because of the fall in the stock price and or because of the selling that we have been seen by the funds. Now based on these factors, it is very safe to assume that if a certain categories certain FPI categories AUM has fallen much more than the overall FPI AUM, then it could be safe to assume that that FPI category must have been a seller in the Indian equity markets in the last 5 months. So in the last 5 months, if you look at the overall FPI AUM, that has come down by 13%, but the FPIs of these categories have fallen much more than that. So who are these categories? Firstly, if you look at it, it's the investment managers and investment advisors, which have seen a decline of nearly 37% and 32% in their AUM, which is way higher than the overall FPI AUM fall and the market fall. So these guys must be definitely the sellers in the Indian equity markets in the last 5 months. Then there is University Fund and AMC, which have seen a decline of nearly 25 to 28% in their AUM, followed by regulated entities, central banks and pension fund, which have seen a decline in their AUM of anywhere between 13 to 20%, and this is higher compared to the overall FPI AUM fall and the market fall. Now if you look at which categories would be the buyers in this market, now these categories like insurance and reinsurance entity have seen a decline in their AUM of just 10%, which is way below than the market fall and the overall FPI AUM fall. So definitely they must be buyer in the Indian equity markets in the last 5 months. Then there is sovereign wealth fund, government owned entities, endowments, which have seen a decline of just 8 to 9%, followed by LLPs, that is limited liability partnership, trust, banks and family offices, which have seen a decline in their AUM of just 4 to 7%. So these categories would be definitely a buyer in the Indian equity markets in the last 5 months.
Okay, well, on that note, let's get in Raghvendra Kedia, founder of Prosperity Advisors, who joins us on the show. Raghvendra, good morning and thanks for joining in. Why don't you tell us about what you are making of the fund flows, especially given the the relatively stronger dollar against the rest of the currencies. How do you expect it to pan out, and what does it mean for fund flows here? Raghvendra, I think you're on mute.
Yeah, am I audible now?
Yes.
Okay. Good afternoon, Agam. Broadly, we feel we are taking few silver linings at current levels of Nifty, which is significantly beaten down. We believe that the US 10-year yields, which has a moved towards, which were eyeing levels of 5% yield, have come down to around 4.33. So there might be a slowdown in sell-off in equity and that money being shifted into the debt market. So that's one positivity we take. We believe that with this US-China war getting escalated, there might be a significant stimulus declaration from China in the weeks ahead in various tranches. So the metal sector in India and overall liquidity can get some boost in terms of this China stimulus prospects becoming very high. Third factor, on the domestic front, we believe that we are starting the Q1 earnings season on a very low base, where Q4 earnings season on a low base, where Q3 and Q2 have been pretty muted. So in terms of some pop in terms of the earnings and results could come. Fourth factor, again from the domestic positive side, is the massive efforts from Ministry of Finance and Reserve Bank of India in giving some kind of liquidity push, lowering compliance, making lenient regulations for the banking sector, where a leadership could come in from the private banks. So broadly, and icing on the cake could be some correction in Brent crude oil prices in the days ahead, considering OPEC's production increase announcement. So with oil prices coming down, stimulus from RBI, Ministry of Finance, China stimulus, US yields slightly coming down, these all factors collectively can bring some positivity to the Indian market at beaten down levels. And we believe that starting second half of March and April onwards, we could see some significant fresh buying in the equity markets for India, which could also comfort in terms of valuations and some kind of low ownership becoming moderate level ownership. So we are upbeat at current levels overall on the market.
Well, speaking of valuations, Raghavendra, let me apprise our viewers on how things are panning out as far as the mid-cap and the small-cap valuations are concerned. So firstly, we have seen a significant shift and a significant decline in both your crucial broader market indices, that is the mid-cap 150 index and the small-cap 250 index. I just want to point out, firstly, in terms of returns on a financial year basis, financial year-to-date basis, and it's nearly been a year, because we will end the financial year in just about 25 odd days from now. The mid-cap index is now as flat as it can get, and the small-cap index is in fact in the red by around 3%. And this is after the first 6 months of this financial year saw a significant alpha for both the small-cap and the mid-cap indices with respect to the Nifty 50. What does it mean for valuations? Are we looking at better valuations at this point in time, especially given the fact that the small cap, the mid cap indices are actually in bear territory right now? The small cap index particularly has come off well off from 20% from its peak. So at the moment, the mid cap index is trading at around 33 times price to earnings, whereas its 5-year average is around 37 times. Discount to its 5-year average, but this discount is not that deep. Also, the mid-cap index especially, even at this point in time, is still very, very expensive, considerably expensive, more expensive as compared to the Nifty 50. Look at the small-cap index as well. Sure, it is trading at a discount as compared to its 5-year average at around 24 times, but is this deep enough? That's the question I reckon that traders and investors will have to ask themselves. But while we do have Raghavendra with us, Raghavendra, this question is for you as well. What are you looking at when it comes to broader markets, particularly mid-cap and small-cap indices, which according to you still have scope to show about 20-25% growth, and I'm talking about earnings growth. That said, do you still think that at this point in time that valuations are much more reasonable, and are they warranted, or do you still think that there is a little bit of overvaluation? We do know that the froth is out of the system, but is there still a little bit of overvaluation left?
Well, Agam, we definitely agree with your narrative that froth is out of the system and the valuations are not cheap. I would use the word they are moderately priced. Mid cap and small cap have historically always been at a premium valuation to broader Nifty 50 or even Nifty 100, and that continues to be the case. There has been some earning uptick in small cap and mid cap. So if you consider a higher single digit earning growth of around 8 to 10% across the mid cap and around 12 to 14%, which is our broader estimate for small cap index, this discount to historical averages where is around the current discount is around 15%. Now add to it the earnings growth. So we do believe that there becomes a scope of around 20% price appreciation at current levels in the mid cap space and around 25% in the small cap space. We do believe that this historical average, which is currently the current averages on the P multiples are at a discount, they might revert to their 5-year average means in the first half of the next financial year. So starting April, the H1 of the next financial year would again see some price recovery. And on top of it, this could be substantiated by positive earnings shows of Q4 and Q1, which will be reported in the next 1 to 4 months. So we believe that an earning uptick based on a low base effect, some valuation discount, fraud getting over, and some policy continuity and reformist measures by the government and global macro coming to our help, or at least not denting the overall domestic structure, might see a broadly 20% upside starting April in terms of price appreciation in mid cap and small cap. That is our bullish take going ahead.
All right. Well, here we are again. Markets all over have been under pressure due to Trump tariff taken into effect today. But some of the Indian companies, may get benefited from them. Let's get in Somit to tell us about what has been announced so far and what impact could it have on Indian companies. Somit, take it away.
So first, let's see what has been announced or what could be announced in the next couple of weeks. Firstly, it's the 25% tariff on all imports coming in from Mexico and China. Then there is a 10% additional tariff on China, which will take the cumulative tariffs on China in the last 1.5 months to 20%. Then there's a possibility of 25% tariff on steel and aluminum imports from all T8 partners from March 12th. And then in April, there's a possibility of the reciprocal tariff coming in. Firstly, let's try and understand the impact of the tariffs that could come in the next couple of weeks and which Indian companies stand to either benefit or lose out of it. Firstly, coming on to the chemical companies like PI Industries, UPL and Jubilant Ingrevia. Now, these three companies stand to benefit because these three companies are manufacturers of the top 5 chemicals that are imported by US. So if there is any tariffs on China, then these three companies could stand to benefit. Now, when it comes to the auto ancillary space, it is a bit complicated. Companies like Samvardhana Motherson, Bharat Forge, Sona BLW, JK Tyre, Balkrishna Industries, Sundaram Fasteners and Timken India. All these companies have direct exposure to US, but the impact could be limited because most of them also have plants in US. But given the complex auto supply scenario that is there, an auto supply chain there could be an indirect impact on all these auto ancillary companies because auto ancillary companies customers, that is the OEMs, have a high dependent on Mexico and China for manufacturing to serve the US market. All these companies, that is Ford, GM, Volkswagen Group, BMW, Mercedes, have manufacturing units in Mexico and Canada which serve the US market. So any tariff could lead to pricing pressure for this auto ancillaries as well. Now, when it comes to metal companies like Vedanta, Hindalco, Nalco, SAIL, JSW Steel and Tata Steel, no direct impact because we hardly import metals to the US market, so no direct impact. But again, this tariff imposition may have an impact on the steel and aluminum prices because of the changing demand supply scenario, so that could impact these companies. Also, the indirect impact could be on steel dumping coming in from China, South Korea and Vietnam in the Indian market, so that could impact the steel players as well. Now, apart from that, two companies that stand to benefit directly, JSW Steel, they have a 1.5 million ton capacity in Ohio, which contributes nearly 4.5% to the total revenue, and this stands to benefit if prices move higher. Then there is Hindalco. Now, for the Novelis unit, the impact is still not sure, given the fact that the company could benefit from higher aluminum prices, but on the flip side, the raw material prices could also move higher for the company. However, the company believes that they can be exempted, like something similar that happened last time as well. So currently, we do not have a clear view of what happens to Hindalco as a subsidiary, that is Novelis. Then there is one company, Cummins, that could stand to benefit because higher tariffs on Mexico may open up higher prospects of exports for Cummins India. Currently, exports is a very small portion for the company, but Cummins Mexico unit exports nearly $1.5 billion of components and diesel engines to the US market. And if there are tariffs, this or part of this exports could move to the Indian unit going forward. And lastly, it comes to the IT sector. Now, direct impact is very limited via nearshoring from Mexico and Canada, less than 5% of the supply, so not much of an impact, but still a list of companies that have direct exposure to the US market are Infosys, LTI Mindtree and HCL, which have a highest exposure, and companies that have the least exposure are KPIT Tech, Tata Tech and Tata Elxsi. So keep an eye out for these companies, given the fact that tariffs could come in the next couple of weeks.
Well, thank you, Somit, for all the details. Raghvendra, of all the stocks that Somit was mentioning, you have few stocks from chemicals, auto ancillaries, metals and IT. Which are few stocks that you are actually bullish on considering the tariffs impact?
Good afternoon, Varsha. Broadly, we believe that as the trade war escalates between US and Mexico or US and China, India might be a net beneficiary of this. And as of this escalation, we believe the auto ancillary space specifically would be a significant benefiting sector, where if there is any kind of steel dumping into India, their cost price might come down. So we believe that could be certain expansion in their margins for the auto ancillary companies. Their exports might increase overall from India to the OEMs, the original equipment manufacturers, to US and also to Europe. So we believe the auto ancillary sector could be one theme which can be actually a bit about this trade war getting and the tariff war getting escalated. Samvardhan Motherson would be a top pick in the large cap space. Ask Automotive is another stock we like in the auto ancillary space. Moving on to the IT, we do believe that their order book might look robust if there is a significant corporate tax reduction declaration, which there has been some indications and narrative floating around in the US. If there is some kind of tax reduction on the corporate side, we believe that there could be a significant upside in the order books of software IT companies, and the large cap names like Infosys, HCL Tech, Wipro, TCS could be, and Persistent from the mid cap space could be benefiting IT sector. Dollar strength also aids their margins. So based on the strengthening dollar, corporate tax reduction prospect in US, and this tariff war getting escalated, auto ancillaries, these are few themes we are a bit about, and actually believe that with this significant price corrections in overall market, there can be an entry point in these names.
Right, all right. Well, time for a short break. Don't go anywhere. Stay tuned to NDTV Profit.
Very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction and healthy correction is a very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers, and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction and healthy correction is a very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers, and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
welcome back. This is Profit Buzzers. We now shift and put the spotlight on a relief for former SEBI Chief Madhavi Puri Booch and 3 whole-time members of the SEBI. The High Court has issued a stay on the FIR ordered by the Special Court. This FIR was based on the allegations of irregularities in the case of listing of a firm called Cal's Refinery way back in 1994. My colleague Charu Singh has more details.
The single-judge bench of the Bombay High Court has just stayed the order of the Special Corruption Court of Mumbai that had ordered for an FIR to be registered against the former chairperson of Securities and Exchange Board of India, 3 WTMs, that is the whole-time members who are currently serving in the market regulator SEBI, as well as 2 BSE officials. Now, the court also orally observed that this was some sort of a mechanical order passed by the special court's judge without really going into the intricacies of the matter. The parties were represented in the following orders. The Solicitor General Tushar Mehta represented the serving WTMs, whereas Madhavi Puri Booch was represented by another senior advocate, and the petitioner Sapan Srivastava was representing himself in the court. The court gave him 4 weeks to give a reply to the arguments made by Booch, the WTMs and the BSE officials, and the matter is going to be taken up next after the completion of 4 weeks. The petitioner also alleged several irregularities during the listing of Cal's Refinery by the SEBI officials as well as the BSE officials. However, they have alleged in the Bombay High Court that this is a case of time pass and frivolous applications and petitions being filed by the petitioner several times in an ordinary course of nature without any specifics being given.
Let's move on and talk about, well, the largest public sector bank in session wrought with yet another correction. SBI shines brightly and is trading with solid gains. What's driving the up move? We have Harsh joining us to give us more on this. Harsh.
Well, the management met with the analysts at Citi, and it's followed by Citi giving SBI a big thumbs up and a double upgrade. So first off, on the target price, they've hiked the target price from 720 to 830, offering nearly a 19% upside to yesterday's close. In terms of what really stood out in terms of management commentary, one, you've got growth visibility backed by express credit corporate pipeline being healthy as well as home loan rollout across the board. Those 4 levers likely to keep growth within the 13 to 14% band. That's the confidence which SBI has essentially expressed. Second one is with regard to asset quality. Unsecured retail slippages expected to be contained at just about 50 bips. Restoration of risk weights has helped, of course, capital adequacy by around 25 to 30 bips. Both of those levers to further aid numbers going forward, because lowering of risk weights means that SBI will also be able to continue to lend to NBFCs. That's the other piece. The last piece, and most importantly, is margins. SBI now focusing on margins. What they're calibrating is liability cost, and they're basically undertaking several optimization measures and initiatives. One, they're pushing with regard to current account deposits. How are they doing that? Commercial and corporate banking group, which earlier never used to look after current account, is now going to, there's going to be responsibility placed on that team to do current account and to grow the current account balances in meaningful fashion. They're going to reduce reliance on bulk deposits, and they are pushing their treasury and overseas business team to work on optimizing borrowing cost. And all of those measures likely to impact margins. That's why Citi is constructive. Again, 830 being the target price.
Right, Harsh, thank you so much for getting us all those details. But on that note also, let's get in Sneha Seth. She's a senior analyst at Angel One who joins us on the show. Good afternoon, Sneha, and thanks for joining in. We've seen a little bit of a bounce for SBI, the State Bank of India. Is this a dead cat one, or do you think that there could be some more legs to this up move that we are seeing right now?
So, if you look at the chart structure, yes, we have seen decent up move in today's session. In fact, yesterday also we have seen some short covering move. At this point in time, I believe any up move above 720, 725 would be interesting for this counter. In case we manage to surpass 720 on the closing basis, that would be interesting. And then, maybe we can head again at least towards 760, 780 zone is very much possible. So at this point in time, if someone wants to go ahead and long, I think there is no harm. The risk reward ratio is quite good. On a weekly chart, if this counter manages to close above 720, that will be a good indication and possibility of a further up move at least towards 760, 780 zone.
Got it. Well, Vijaya Diagnostics is another counter in focus today. The stock has staged a sharp up move after opening lower. Now, this comes on the back of recent note from MK. Let's see what MK is saying. So basically, MK had monitored price data of various diagnostic tests offered by players. You have Dr. Lal, you have Metropolis, and Vijaya also across key markets for gauging competitive dynamics. Well, MK is also bullish on some other counters like Metropolis, but let's talk about Vijaya. So MK has reiterated buy on Vijaya Diagnostics at a target price of around 1200. Now, what are they saying is that Vijaya Diagnostics has maintained stable pricing and is benefiting from a firm market, and the market is actually shifting towards organized diagnostic players favoring Vijaya. Now, we all know that the diagnostic sector, a lot of healthcare analysts are actually bullish when it comes to hospitals and diagnostics, considering the double-digit growth that the sector is going through. MK also says that the rising demand for preventive test boost Vijaya's growth potential, one of the reasons why they've reiterated buy, and Vijaya's current stock valuation is considered attractive as per the brokerage firm. While the network expansion and operating leverage are expected to drive Vijaya's growth, that's one of the highlighting point of the note. And the Vijaya also has been able to maintain pricing while online and hospital chains are competitive. Lastly, they say that market analysis shows a stabilizing competitive landscape which will help Vijaya in future. Now, we all know that Vijaya is mostly south centric and they are trying to expand into other geographies as well. Raghvendra, let me come to you first on this. How are you seeing this counter? Vijaya, the stock is up 13%. First of all, are you bullish when it comes to overall sector, and also talk about Vijaya to us?
Well, Varsha, we are bullish on the overall sector in terms of the diagnostic space, where more and more preventive tests and the disposable income going up. So that could be some kind of expansion in terms of the revenue and overall sales of the entire companies. But specific to Vijay Diagnostics at current levels of 1050, we think that the stock is currently trading at a very expensive valuations, where the price to earning P multiple is north of 75 times. So that is not very comforting to us. Even at current levels of 1050, that makes it trading at a price to book value of 15 times. So again, that is very astronomical valuations. And we believe that though the overall macro and theme for the diagnostic sector looks good, Vijay Diagnostics at 1050, we would avoid unless the stocks correct significantly in terms of the valuation basis. We like the commentary of the management, the growth and the overall expansion, but not at current levels unless the stocks comes down to levels of around 900, 920. That is where we would review. As of now, it's an avoid.
Got it. Sneha, how are the charts showing for Vijaya? Because the stock is up 13%. Would you advise investors to get in or get out? What's your view?
Yeah, I believe looking at the chart structure and recent volume activity, we have seen some buying interest coming in. In fact, today's volume is very good. So in case of any follow-up buying, at least above 1,000, 1,090, 1,100, that would be very interesting. For someone who's already holding a long position, they may continue to hold. Any move above 1,100 would be interesting, and this counter can head towards 1250, 1260 zone even. So the chart is decent. someone who's holding, they can continue. If someone wants to go ahead and take a fresh long, I would say that around 1000 zone, that would be the level you can watch in. You can get a fresh trade, and the stop loss can be maintained around 900 in that case.
Okay, well, on that note, let's get in Mihika to tell us about why India Cements is also on the move. Mihika, over to you.
So there are mainly two triggers. Stock is up almost 14% on an intraday basis, and the trading volume of the company is double than the 20-day average just today. One, there were two large trades that we saw. 26,062 shares were traded for a price of 287.1 per share, and another 39,851 shares were traded in another large deal for a price of 278.15 per share. And we've also got on a Nomura note that's come in today talking about how cement prices are picking up. The pan-India trade prices have increased 3 rupees per bag month on month in March 2025. That means they're up 2% quarter on quarter if you look at Q4 FY25 so far. When you look at the region-wise prices, North has seen the highest, one of the highest upticks at 7 rupees per bag. East has seen the highest, 11 rupees per bag. South has seen a price increase in March of 5 rupees per bag, and West has seen 4 rupees per bag. Central has seen no changes. And if you look at how India Cement's market share is, well, the company does have major presence in the south with 14.5 MTPA in the region. In terms of FY24, their south region market share stood at 8% as per ICRA ratings, and the FY24 all India market share as per capacity stood at 3%.
Okay, Mihika, thank you so much for getting us those details on India Cement. Perhaps I can go across to Raghvendra on his view on what he makes of this particular company. Raghvendra, do you track this one?
Yeah. So India Cement, we do track, and we are even bullish in spite of this price jump of 9% today at current levels of 280. We believe that this corporate action which is going on would actually see some more upside in the counter. Broadly, if you see the overall cement sector, there has been no major capacity expansion in the last 3 years. There has been significant consolidation where the small players have been taken over by the likes of Adani or Ultratech. So there has been a significant consolidation where the industry is now majorly in pan-India basis around the top 4 to 5 players. So that would see some kind of upside overall in the cement space. And India Cements, even at current levels of 280, we are upbeat and expect a 15% upside from here with a price target of around 320, 325 from a 1-year investment horizon.
Perhaps a harder stock to track on a technical basis. Still, Sneha, if you can give us your view on this one as well.
Yes, Nagam, if we look at the chart structure, we have seen this counter being very volatile recently. A sharp correction of late in the January series, and now after the consolidation, again, this counter is attracting some, volume-based buying today. So I would rather wait for an up move at least above 290. In case this counter sustain about 290, then only I would initiate any fresh long for now. In case of up move above 290, I expect this counter to head towards 320, 330. That zone is possible. For now, if anyone wants to go ahead and long, I would suggest at this level you should be avoiding. But in case of any dips towards 260, then possibly we can go ahead and long with a strict stop loss around 244.
All right, got it. Well, on to other brokerage notes, CLSA has upgraded Varun Beverages to high conviction outperform, but cut target price to rupees 770. Mahima will join in with more details, of course, from the report.
Right. So, as you rightly mentioned, CLSA has, upgraded Varun Beverages to high conviction outperform from outperform and given the target price of 770. And they've cut the target price from 802. But still, compared to yesterday's closing, that's still a 70% upside on the stock. And we're seeing those moves in the stock. The stock is currently up around 4% as we speak. What they're saying is that Varun Beverages has corrected 28% in the last 3 months with a 12-month forward PE correcting from 62.8 to 43.8. While the broader markets have also seen a sharp drawdown, Varun Beverages has underperformed due to the added concerns around increasing competition coming on from Campa Cola as well as competition from Coca-Cola as the bottling arm undergoes a restructuring. But what they're saying is that higher capex guidance and investor concerns are around slowing urban consumption in India are still a concern, but they believe that investor concerns are now overdone for Varun Beverages. The stock is trading at below its average multiple, and their outlook on growth and profitability remains robust, which is what makes them also bullish. They've adjusted their estimates and potential price cuts as well, and what they're saying is that the pricing scenario, they've given different pricing scenario and the outcome for the same, but they're also saying that capex as a percentage of sales has peaked in calendar year 2023 for them, and they expect that capex intensity will ease going forward. Varun Beverages has also already seen higher capex intensity in 2023 as well as 2024, largely due to new greenfield projects, but they expect that capex intensity will be now at a slowdown but higher than other FMCG players. Now for them, total addressable market remains very large, which is why they're saying that there's a large upside for soft drink consumption, and which is why they're saying that the competition coming in for Campa Cola might not hurt as much as the market is penciling in, which is another reason that makes them extremely bullish on Varun Beverages. Lastly, they've cut their earnings estimate by 4 to 5% to reflect heightened competition. Now, in terms of the new target price, it's as I mentioned earlier, it stands around 770 as compared to 802 earlier.
Right. Well, thank you, Mahima, for all the details. Raghavendra, market is concerned about the competition when it comes to Varun Beverage. What are your views?
Well, there are a lot of positive catalysts in Varun Beverages. The company has significantly reduced its debt. That's a positive. If you see the return on equity, that has been substantially high at around 26% for the last 3 years. So that's a very good track record in terms of ROE. If you see the full year EPS of Varun Beverages, we are expecting the EPS to be around 10 rupees. And considering if it's sector in FMCG space, price to earning multiple of 60 gives us a target of around 600. That's around 25% upside even at current levels. The shareholding of the promoters is around 60-61%, which is also comforting. So based on the valuation metric, execution track record, P of moderate levels of around 60, good corporate governance, we are upbeat about on Varun Beverages and expect a 25% upside in a 1 year investment horizon.
Got it. Well, Raghavendra is actually bullish on Varun Beverages. Let's see what Sneha has to say. Sneha, the stock is up 4%. What are your charts saying?
If you look at the chart structure, yes, we have seen this counter correcting. In fact, we have seen decent short formation in this counter initially. But at this point in time, it is the second session wherein we are seeing decent recovery. If you look at the monthly chart as well, I believe this counter has, has been rebounding from the 50% retracement of the up move what we have seen. So I believe 400, 420 is a very strong support zone. In case someone who's holding a long position in this counter may continue to hold. For me, 500 zone is very important. In case any up move beyond this, that would be very interesting, and that may bring this counter again towards 600 plus zone even. But for me, 500 is the level which is very important. In case of any move above this, then only I would initiate any long positions.
Okay, from there on, we move on to Canfin Homes. Morgan Stanley has maintained its overweight rating on the company after their management meeting with a price target of 885 for Canfin Homes. It's currently trading at 585. Harsh joins us to tell us more about this one. Harsh.
Yeah, I'll break this up into three. First off, with regard to growth, they've reiterated growth guidance for FY25. Also reiterated guidance of mid-teens growth in FY26. So growth expected to stay solid with regard to the overall number. Disbursements, therefore, in Q4 will be roughly 2,400 odd crores. So healthy pipeline in that sense as well. Second, with regard to situations in specific geographies, e-registration situation in Karnataka continues to improve, they say. Telangana market, though, remains tepid and may take some time to improve or turn around. So that's one space or pocket opportunity, in fact, which could see a bit of a turnaround as well. Third piece, with regard to margins and ROAs. Margins expected around 3.7%. They reiterated that. ROA they are suggesting will be roughly 2.1 to 2.2%. That's the kind of band or range they've given. And 2.2 is what they've done in 9-month FY25. So largely around that number. And therefore super positive overall with regard to both the commentary, which is largely steady, but the target price seeing a almost or reflecting at least a 52% upside from here.
Okay, so that's your fundamental view on, Canfin Homes. Sneha, very quickly coming back to you on what you are making of this stock or the charts.
If we look at the chart structure, it's been quite some month, I guess. It is 5th month, wherein 5 consecutive months wherein we saw this counter correcting. And at this point in time, if you look at the monthly chart, this counter is taking support near, or it is, around the 89 EMA. So the probability of a short covering move from here is quite high. So I believe if someone wants to go ahead and long, the risk reward ratio is quite good. Keep a stop around 559 and go long over here. On the upside, I believe the first target would be around 610, 620. In case an up move above this, I think then we may see some momentum coming over here. So at this point in time, even one can go long with a stop around 560 zone.
Okay, on that note, taking a moment to thank both our experts, Raghvendra and Sneha, for joining us and taking us through the many queries that we have had for them. And with it, it's also a wrap on this edition of Profit Buzzers. Lots more lined up on the other side. We go into a short break, and on the other side, we continue with all the market action. You're watching NDTV Profit.
Very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers, and Indian companies will not be affected.
Hello and welcome to NDTV Profit. You're watching Top Trades. I'm your host Anushi Vakharia. Let's go quickly to the markets. It's been an absolute mayhem, and this is after those tariff impact has come effective today. We've seen what has happened to the global markets. The global markets did take a beating in trade. Let's shift our focus to the Indian markets. If we see Nifty down about 0.3%, now it's a choppy day of session that we are seeing. Nifty levels remaining in those highs. If you are looking at the day's low, that stood at about 21,964. So just off the day's lows, you can say so. For Nifty 50, let's see some of the overall breadth of what the Nifty 50 is. So we are looking at more declines than advances in trade today. If you can pull out that, the advance decline ratio in trade. So we are looking at around, so overall breadth of the market, we are seeing about 1,300 advances in contrast with 925 declines. So again, overall broader markets, we are seeing it in favor of advances, in favor to the red that is there. But coming back to the benchmark indices, cuts of around 0.3%. Let's see, pull out some of those key contributors which are leading to these losses that we are seeing. Now we have something like Infosys, Reliance in pressure. Reliance Industries has been pressure for quite some time now. We've seen erosion in the market cap also. Even in yesterday we noted that SBI is one of the top gainers in trade today. This is after the Citi's double upgrade on the stock. ICICI Bank, HDFC Bank, all the banking stocks are in favor of green today, while something like a Bajaj Auto is in red. So this is in terms of what is happening with the Nifty 50. But let's also see what's happening on the sectoral side of the index today. So in the sectoral, we are seeing Nifty Media being the top gainer in trade today. Now, this is in contrast to the fact that just yesterday, Nifty Media was down about 1%, while we have something like Nifty Auto, which is seeing cuts of around more than a 1%. Nifty IT also taking a beating in the market. Again, this would be on the back of the Trump tariff impact also that we are looking at. Let's pull out some of the key losers in Nifty Auto Pack if we can. We've seen stocks like Hero Motor being in pressure, but let's pull out the Bajaj Auto seeing cuts of 4%, Balkrishna Industries, Hero Motor Corp, Samvardhana, all of these clocking in about 2 to 3% of losses. Now, if we pull out the broader market indices, let's see Nifty mid-cap indices, what's currently happening over there. We are looking at 0.19% of decline. So, broader markets doing favorably better than benchmark indices is what we are looking at. Some of the key contributors to this, some of the top gainers in Nifty mid-cap index, if we can see what's happening in trade with those counters, if we can, we have something like HPCL Tube Investments and Volta seeing gains of around 3%, 4%. In fact, I would also like to pull out something like a Jyoti CNC, which is up around 12 to 13% in trade today. Now that's in regards to the Nifty mid-cap, what's pulling up the index. But in terms of some key draggers, we have Paytm, Astral, Supreme Industries, which are seeing cuts of around 3 to 4%. Balkrishna Industries, in line with whatever is happening in the auto pack, is also under pressure. In the Nifty small cap indices, we are seeing gainers like India Cements, Vijay Diagnostic, Concord Biotech, seeing gains of 8 to 9%, while on the draggers, we have something like Wellspun, MAP, My India, and MCX seeing cuts of 2 to 3%. Now, again, this is the overall trend that we are seeing in the market today. But let's get a market voice. Let's see what his view is on the market. So I would like to welcome our guest for today, which is Prashant Tapse, Senior VP Research Analyst at Mehta Equities. Thank you so much for joining to NDTV Profit. Firstly, your view on the overall markets, and this is especially effective after what has been happening in the global side and all.
I think markets is looking to have some kind of not clear trend for upside. So I think overall the markets are still facing a lot of pressure from the FII selling, which they have sold from last 2 to 3 months. So I think that is the only concern which Indian markets are facing at this point of time. But overall, global markets, the Trump tariff war, I think it's fully discounted in the Indian markets. I think the newer the headlines which are made by tariff are creating some kind of volatility in the global markets. But I think Indian markets, a lot of Atmanirbhar sectors like PSU banks or any other sectors which are only dealing with Indian markets, those sectors are doing better. But the sectors which are linked with again global markets like auto and others, pharma as well, so those stocks are still under pressure considering the volatility in the global markets.
In fact, we'll delve deeper into this, which stocks and which sectors are in effect. Now the markets are at AM on account of these Trump tariffs that we are looking on various countries being effective today. But what is the impact on the overall tariffs on these Indian markets? Somit has all the details on the same.
So first, let's see what has been announced or what could be announced in the next couple of weeks. Firstly, it's the 25% tariff on all imports coming in from Mexico and China. Then there is a 10% additional tariff on China, which will take the cumulative tariffs on China in the last 1.5 months to 20%. Then there's a possibility of 25% tariff on steel and aluminum imports from all T8 partners from March 12th. And then in April, there's a possibility of the reciprocal tariff coming in. Firstly, let's try and understand the impact of the tariffs that could come in the next couple of weeks and which Indian companies stand to either benefit or lose out of it. Firstly, coming on to the chemical companies like PI Industries, UPL and Jubilant Ingrevia. Now, these three companies stand to benefit because these three companies are manufacturers of the top 5 chemicals that are imported by US. So if there is any tariffs on China, then these three companies could stand to benefit. Now, when it comes to the auto ancillary space, it is a bit complicated. Companies like Samvardhana Motherson, Bharat Forge, Sona BLW, JK Tyre, Balkrishna Industries, Sundaram Fasteners and Timken India. All these companies have direct exposure to US, but the impact could be limited because most of them also have plants in US. But given the complex auto supply scenario that is there, an auto supply chain there could be an indirect impact on all these auto ancillary companies because auto ancillary companies customers, that is the OEMs, have a high dependent on Mexico and China for manufacturing to serve the US market. All these companies, that is Ford, GM, Volkswagen Group, BMW, Mercedes, have manufacturing units in Mexico and Canada which serve the US market. So any tariff could lead to pricing pressure for this auto ancillaries as well. Now, when it comes to metal companies like Vedanta, Hindalco, Nalco, SAIL, JSW Steel and Tata Steel, no direct impact because we hardly import metals to the US market, so no direct impact. But again, this tariff imposition may have an impact on the steel and aluminum prices because of the changing demand supply scenario, so that could impact these companies. Also, the indirect impact could be on steel dumping coming in from China, South Korea and Vietnam in the Indian market, so that could impact the steel players as well. Now, apart from that, two companies that stand to benefit directly, JSW Steel, they have a 1.5 million ton capacity in Ohio, which contributes only 4.5% to the total revenue, and this stands to benefit if prices move higher. Then there is Hindalco. Now, for the Novelis unit, the impact is still not sure, given the fact that the company could benefit from higher aluminum prices, but on the flip side, the raw material prices could also move higher for the company. However, the company believes that they can be exempted, like something similar that happened last time as well. So currently, we do not have a clear view about what happens to Hindalco as a subsidiary, that is Novelis. Then there is one company, Cummins, that could stand to benefit because higher tariffs on Mexico may open up higher prospects of exports for Cummins India. Currently, exports is a very small portion for the company, but Cummins Mexico unit exports nearly $1.5 billion of components and diesel engines to the US market. And if there are tariffs, this or part of this exports could move to the Indian unit going forward. And lastly, it comes to the IT sector. Now, the direct impact is very limited via nearshoring from Mexico and Canada, less than 5% of the supply, so not much of an impact, but still a list of companies that have direct exposure to the US market are Infosys, LTIMindtree and HCL, which have a highest exposure, and companies that have the least exposure are KPIT Tech, Tata Tech and Tata Elxsi. So keep an eye out for these companies, given the fact that tariffs could come in the next couple of weeks.
Okay, well, thank you for all those details, Somit. Prashant, I'll come directly to you. Somit had talked about a couple of sectors. Firstly, the auto pack, the chemicals, even something like metals. Any of these where you see a deeper impact on any particular names that you would like to highlight in terms of the Trump tariff impact coming to picture now?
I think yes, auto sector would be the most affected sector because it has a very global impact. So Tata Motors, obviously it has plants in China as well as in other part of the country. So I think any tariff implication on China will also impact the Tata Motors JLR unit, which is selling to the world. So I think that would be the one major concern for Tata Motors as well as any other auto ancillary stocks which have direct exposures to the US in terms of export from India to their own countries. So obviously, what goes negative to China can be positive for Indian markets with respect to the specialty chemicals. I think that would be one sector which I am very much positive at this point of time. A lot of business can go and come to India with respect to making and making for this world. Obviously, any plant which they have in their own country, like a company like JSW Steel in the steel segment has a own unit in US, that will have a very major positive impact. But overall, I think auto will be the sector which will see a lot of negative impact going forward.
Okay, so that's the impact that we're looking for the auto sector. Just a quick follow-up on this. Any of the names that you prefer in auto sector currently?
So I think on the negative side, again, Tata Motors will be very much negatively impacted. I think to be on a positive side, I think Mahindra can be on a positive side where it has a lesser exposure to US market and a lot of demand is coming from Indian markets only.
Okay, well, that's the view on the auto sector, but let's shift our focus to Gensol Engineering. Now, the stock has hit lower circuit and trade today, and this is on the back of a rating downgrade. Let's bring in Mika with more details on this one.
The stock's under pressure because Carriage Rating has downgraded its long-term bank facilities from a Care BB plus to a Care D, and as well as its long and short-term bank facilities to a Care BB plus to Care D. Now, why were the ratings downgraded? But as per the rating agencies, the ratings were revised because of ongoing delays in the servicing of term loan obligations, and the rating actions are now in line with the agency's policy on default recognition. The rating agencies also stated that the company's liquidity remains poor, and when you talk about the ratings that have been downgraded, they are pertaining to 4 main instruments as per the report, and the total issue size of these instruments stands at 716 crores.
Okay, well, thanks for that, Mika. Prashant, your view on Gensol Engineering, also with something like IRIDA, which has IRIDA and PFC, which has a little bit of exposure, not quite significant, but there is still some exposure to this company. What's your view on these counters?
Overall, Gensol is not part of our research universe. But when I just went through the news, so obviously whenever there is a concern with respect to a financial health concern in the companies with respect to delaying the loan payments and all, that would raise a lot of corporate governance as well as the financial stability of the company. So that will be a very negative for the company. Obviously, the stock is down by 20%, and the stock has really underperformed from last 1.5 months. So I would like to have a very avoiding kind of recommendation to the investors who hold Gensol. With respect to again IRIDA, again obviously yes, I think IRIDA can be a very good long-term portfolio stock, but obviously more downside should be seen. Again, 120, 130 can be a level as the investor should wait for a very short period of time. Again, it should be a PMS stock. It should be a portfolio stock for a longer period of time, at least for 2 to 3 years. Then only this sector may deliver a good return for a long-term investor.
Okay, Gensol Engineering currently locked in the 20% lower circuit. But another stock in focus is India Cements, which is buzzing on the back of a large trade. We still have Mika with us who will share more details on the same.
Two triggers for something like an India Cement. The stock is up 14% on an intraday basis. Trading volumes of the company today stand double than the 20-day average as well. Now, we did have two large trades which are in focus. One was 26,062 shares that were traded for a price of 287.1 per share, and another 39,851 shares were traded for a price of 278.15 per share. And we also saw Nomura note coming up where they talked about cement prices picking up in the month of March. Pan-India trade prices have increased by rupees 3 per bag month on month, and they are up 2% on a quarter-on-quarter basis in Q4 FY25 so far, which is a good trigger. Even if you look at the region-wise uptick, North there's a 7 rupees per bag uptick, East rupees 11, South rupees 5 per bag uptick, West at rupees 4, and Central has seen no change. And when you look at India Cement's market share, well, the company majorly has presence in the southern market with 14.5 MTPA out of a 15.6 MTPA capacity in the region. Their FY25 South region market share stood at 8% as per ICRA ratings, and their FY24 all India market share as per capacity stood at 3% based on Prabhudas Lilladher data calculations.
Okay, Mika, thanks for all those details. Prashant, your view on India Cements?
We are very positive on the stock as well as the sector. I think the rise in the prices of pan India is mainly because of the rise in the soda ash prices from last 1.5 months. So that has been carry forward to the retail prices. That would be one positive impact for the stock. Overall, I think coming down the line for next 3 to 4 months, there will be good volume growth expected in the cement as a sector, because housing as a sector has expected to have a double-digit growth going forward for next 3 to 6 months from current levels. So cement would be the immediate major impacting in terms of business volume. So I think very much positive for the sector. With respect to India Cement, again, very much again, I think it's a part of Unitech Ultratech stock right now, group. So I think there will be a lot of plans to convert this company into a very profit-making company going forward. So I think with a promoter like Ultratech, again, India Cement would be a great stock. It can again give good returns for the long-term investors.
Any other players that you're looking in the cement industry in particular, which you're constructive about?
I think again, Ambuja Cement looks with respect to valuation, very much comfortable to buy at this point of time. The rationales remain same again. 3 to 6 months, there will be huge volume growth expected from the cement sector. Again, even the pass on of the prices because of the soda ash prices is very much visible in the market right now. So valuation very much comfortable, and demand is going forward for next 1 or 2 quarters very positive. So we are recommending Ambuja Cement at this point of time.
Okay, Ambuja Cement's a preferred play in the cement sector. But now let's take a look at the food delivery and quick commerce space, where ICICI Securities has released a note strengthening their bullish call on both Zomato and Swiggy. Mahima is here with more details on the same.
Right. So, interesting note out there, and both of these stocks are buzzing on the back of that. For Swiggy, they've reiterated buy with the target price of 740, and for Zomato, the target price is 310. Both they've reiterated buy. Now, in terms of what they're saying that concerns of cash burn are overbaked into the stock performance. Swiggy is now trading at a 30% discount to par value with respect to the food delivery business, and Zomato, on the other hand, is trading at a value that ascribes nothing to the quick commerce space. Now, in terms of the anomaly, it is unlikely to sustain long, especially given the robust outlook in the discretionary consumption. For food delivery, they are saying that food delivery is being ignored in the panic of the overall quick commerce space. They do not think that there is a reason to be worried about structural growth drivers in the food delivery space, and they believe that the income tax cut are likely to trigger strong consumption growth, and this sector could be the key beneficiary of the consumption boost from FY26 onwards. In terms of quick commerce, the item level discounting is past the peak level seen between November 24 to January 25 is what the note is saying, and that is what the channel checks also suggest. And they are saying that the noticeable pullback in performance marketing spends will also kind of going forward improve the EBITDA levels. And valuation lastly for quick commerce business is compelling right now for investors as per ICICI Securities. So this is the overall view on the entire space as well as on Swiggy and Zomato.
Well, that's a view for Zomato and Swiggy. In fact, if you pull out the year-to-date performance of both these stocks, they've seen a significant correction this year. Zomato down about 18%, and if you pull out something like Swiggy, we're looking at correction of over more than 20% in trade. So that's where Swiggy and Zomato is there. Prashant, I want to take it up to you. Do you think that correction that we've seen in these two counters over this year, are the concerns overbaked is what the street is expecting, or are you constructive on the space?
I think we are very much positive on this space, but with respect to valuation, obviously it was expensive pre this sell-off. I think 2-3 months back, even at this point of time, these both stocks remain expensive with respect to valuations, because I think for a very medium term to short term, there will be a lot of cash burn still going on both of the books. But with respect to the industry growth, which is growing at almost 40 to 50% month on month, quarter on quarter, that will bring a lot of volume growth, lot of habitual impact in terms of a lot of new customers joining this sector, this stock. I think that would be the only one reason why one should remain very positive in this sector as a long-term investor. There may be some kind of volatility with respect to earnings because a lot of cash burn will be in terms of high competition, and there are 2-3 new inherents which are coming into this sector, like even Jio is trying to do something in quick commerce. Even Amazon is doing something in the quick commerce. So I think those things will only disturb or in the current players like Swiggy and Zomato, but obviously they are already established, 90 plus market share they have. So as a long-term investor, buy more on dips, very positive on the sector.
Well, you're positive on this sector. Are you also positive on the FMCG sector? Because now the outlook is that demand is expected to improve with the tax cuts that have taken place, improving signs of demand that are there. Your view on the FMCG space?
Currently, obviously, we need to wait and watch for Q4 earnings because there are a lot of concern with respect to volume growth because unorganized market share is growing very faster. Organized is saying very difficult to get these kind of like 1 to 5% growth in the top line. So I think that would be very difficult to take comment at this point of time. But I need to wait for Q4 earnings. If there are some kind of stability in terms of volume growth as well as EBITDA margin in the organized sectors which are being serviced by HUL, TCA, ITC, Godrej Consumer, Tata Consumers. So then only we can be more positive. But market is trying to rate them with respect to the consumption story, which will be delivering in the first quarter of next financial year. So I'll be on a wait and watch Q4 earnings, then take a call in the Q1 earnings.
Okay, now shifting focus to some key promoter buying action that was witnessed across markets. Varsha joins us with a detailed report on which are the stocks in focus here.
So significant promoter buying activity has seen across several sectors. Notable transactions include in the agrochemical space, wherein Agrotech Foods saw promoters add over 25,000 shares, while Best Agro Life saw nearly 40,000 shares bought. BCL Industries witnessed a substantial increase with promoters acquiring over 1,50,000 shares. While if you see the real estate sectors, Brokerage Property saw a significant purchase, while Sobha also added 20,000 shares. La Opala RG in the consumer space had promoters pick up almost 51,000 shares, while in the infrastructure and engineering sector, NCC saw 4,000 shares added. D Development Engineers saw around 24,000 shares purchased. Jindal Drilling saw over 23,000 shares added by the promoters. And in the manufacturing sector, if you see Shakti Pumps, TD Power Systems and Usha Martin also seen the promoters of these companies have added shares, while Sesha C Paper saw almost 10,000 shares purchased by the promoter. Lastly, if you see these broad-based promoter buying activities suggest confidence of the promoters in the respective companies.
Thank you, Varsha, for bringing in those details. Prashant, two of the interesting names which stood out on what Varsha was talking about, where there's more promoter buying seen, is something like a Sobha and Godrej Properties. Now, we've seen real estate industry in pressure over the last couple of months now. Last year, there was a strong rally. Want to get your outlook on these two?
Outlook would be very much neutral to positive. Obviously, promoters are the one who knows the value of the company. So I think they are using this sell-off as a best opportunity to take some kind of advantage by buying some shares from the markets. So obviously, they are holding the rates. I think there are no downside in terms of rate sell as of now. Obviously, next 2 to 3 months, I think there will be a lot of stabilization in the market as well as in the business model. So obviously, that will give a lot of good advantage for the promoters to add something in the market. With respect to sector, obviously, we are very much positive in the market. I think with respect to best-in-class business model, Brokerage Property has a pan-India presence with respect to good corporate governance, with respect to good, again, investor-friendly relationship with all the clients and investors. So I think with that, I think Shobha as well as Godrej will act very positive in this market, and we are very much bullish on the real estate sector.
Now, two of the other counters which are buzzing from the list that Varsha was talking about is something like a BCL Industries and TD Power Systems. Both of them have seen gains of over 4% in today's trade. Do you cover any of these stocks?
No, we don't cover these stocks, but overall, whenever there is a buying of promoters in the market, obviously that gives a lot of investor confidence, and that is keeping the stocking buzzing on the upside.
Okay, well, that's the view for these counters. But in a weak session where we are seeing another sharp correction, SBI shines brightly and is trading with some solid gains. What's driving this up move? We have Harsh joining with more details on the same.
Well, the management met with the analysts at Citi, and it's followed by Citi giving SBI a big thumbs up and a double upgrade. So first off, on the target price, they've hiked the target price from 720 to 830, offering nearly a 19% upside to yesterday's close. In terms of what really stood out in terms of management commentary, one, you've got growth visibility backed by express credit corporate pipeline being healthy, as well as home loan rollout across the board. Those four levers likely to keep growth within the 13 to 14% band. That's the confidence which SBI has essentially expressed. Second one is with regard to asset quality. Unsecured retail slippages expected to be contained at just about 50 bips. Restoration of risk weights has helped, of course, capital adequacy by around 25 to 30 bips. Both of those levers to further aid numbers going forward, because lowering of risk weights means that SBI will also be able to continue to lend to NBFCs. And that's the other piece. The last piece, and most importantly, is margins. SBI now focusing on margins. What they're calibrating is liability cost, and they're basically undertaking several optimization measures and initiatives. One, they're pushing with regard to current account deposits. How are they doing that? Commercial and corporate banking group, which earlier never used to look after current account, is now going to, there's going to be responsibility placed on that team to do current account and to grow the current account balances in meaningful fashion. They're going to reduce reliance on bulk deposits, and they are pushing their treasury and overseas business team to work on optimizing borrowing cost, and all of those measures likely to impact margins. That's why Citi is constructive. Again, 830 being the target price.
Well, it's a big upgrade that we're looking for SBI, and thank you, Harsh, for bringing those details. In fact, let's pull out the stock performance today. We are seeing gains of around 3%, and in fact what we've seen this in the last 5 days of session, the stock has mainly remained flat as compared to what has been happening in the Nifty 50 index, which was in red. If you look at Nifty 50 in the last 5 days, it's seen a drop of around 2%. Year to date return, if you look for SBI, it is in red. The stock has seen cuts of around 9%, in fact 10% if we take that into consideration. Prashant, I'll come to you. For SBI now, it's a significant brokerage note that we are looking at. It's a double upgrade that we are seeing. What's your view? And one of the key highlights that Harsh was talking about was the margin expansion, the focus remaining on that side. Share your details on the same.
Overall, we continue to remain very positive in the PSU banking space, and that we are also very positive on the SBI. So I think 2 reasons why we are very much positive. One would be the growth in the housing sector, housing loan sector next 2-3 years. So I think that will bring a lot of businesses to SBI, because again, a major market share in terms of giving home loans comes from the SBI, and second comes from the HDFC Bank. So overall, the sector is growing very faster, and that will have a major impact in terms of a good business going forward. Second, again, the management has started focusing more on the NIM margin improvement. So that is the first time why a bank is focusing more on the NIM margin. Obviously, the improvement would come from the reduction of the cost, their liability cost. That will help them to improve their NIM margins. Plus, again, the asset quality measures, best-in-class asset quality measures. I think we have better target from in the markets right now. I think for 1 or 2 years from the current levels, the stock can deliver 30 to 40% return from the current level. So huge positive on SBI right now.
Okay, and a quick question, Prashant. Your preferred play, is it on the private banks or public banks?
I think with respect to current market valuations, I think PSU should be the best-in-class sector one should focus on, SBI as well as Bank of Baroda.
Okay, well, thank you, Prashant, for joining 20TV Profit and sharing your perspective on various of these counters that we've discussed about. But with that, it's a wrap on this edition of Top Trade. Stay tuned for IMC coming up next.
Very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breathing also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers, and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Very
Hello and welcome. You're watching India Market Close NDTV Profit. I'm Harsh Saita. With me is Neeraj Shah, and we'll take you through the next hour and a half of trade. We're looking at the Nifty, which is down around 1/5%. The bright side here is we've bounced back well from the lows. So you look at the intraday, and of course after that initial blip, we've really done fairly decently for ourselves. But we've given up 22k for that brief period of time. We've bounced back nearly 100 points thereafter, and we've stayed steady pretty much through the day. So we've seen a range-bound kind of day of trade post that little bit of blip at the start of the day. That's how it's shaping up. Let's look at the Nifty 50 heat map as well, and this time it's looking slightly less positive than yesterday, but nothing major to complain about. SBI, after management commentary coming through and that Citi double upgrade, sitting pretty 3% higher. BEL also nearly up odd 3% odd, and BEL has been one of those outperformers in this market over the last couple of days, so you may want to keep your eye out on that one. BPCL also doing fairly well for itself, and then it's kind of a mixed bag with a couple of banking heavyweights, ICICI and HDFC also doing fairly well, and Trent looking good in green as well. So that's the texture. Let's look at also the sectors very quickly before I hand it over to Neeraj with regard to broader markets. PSU banking index doing well, likely because of the heavyweight SBI obviously leading the charge. Private banking flat. The Nifty Bank is doing well because some of the heavyweights are doing well along with the PSU pack. What's not doing well is auto and IT. 1% lower on IT, 1.5% lower on auto. And it's been that kind of last 3-4 sessions for IT where it stood out in a couple of sessions. Friday was 4% lower. Monday did okayish in trade yesterday. Today again it's down 1% thereabouts. FMCG is the other one which is seeing pain, and pharma 0.5% lower. So those are some pockets of pain. But you know what's really stood out is, let's pull up the advanced decline as well, pretty much through the day. The advanced decline has been in favor of the advances, even though it was choppy at the start of the day, and thereafter we've kind of tapered off. But it's not a bad graph that we're seeing, and that's because the mid-cap and small-cap indices have seen a bit of a bounce back. Neeraj, that's clearly the story of the day. We've seen a bit of a bounce back from those lows. The negative sentiment somewhat eroding.
Yes, indeed. But you have to admit that I think the breadth might have just constricted a little bit, as you said, also because the small cap index has given way, right? Now, I was looking at pockets. So pipe companies, Astral, Supreme Industries, some of the others might all be corrective in trade. So I think that bucket has come off in the session today. So as a pocket, things which are coming off, pipe companies right out there. Two-wheeler companies, of course, we've marked as to what a Bajaj Auto or a Hero Moto have done. But Paytm has had a slightly iffy day in the session today. So that's the other thing to keep in mind as well, that stock is amongst the top losers on the Nifty 500 in trade, as also Welspun Living in Adani Green. On the gaining side, strength in India Cements, amongst others, Vijaya Diagnostics, and good report there. Maybe that is probably one of the reasons. But selectively, pharma with Concord Bio, AstraZeneca, Akums Drugs, etc., have not done too badly for itself. And last but not the least, a bucket that you really need to monitor, oil marketing companies. PP, HP, IOC. We spoke about this, Somin spoke about this in the morning, and we were doubting it because it somehow doesn't happen that these guys move up. But HPCL is up 5% in trade. Really strong show by the OMC pack in the session today. Let's take forward those questions, and then we'll of course have some more. Kush Bora, founder of kushbora.com on the technicals. And after a long time, Ambrish Baliga, independent market analyst, joins in right now, and great having both of you. Ambrish, good to see you after a while, so thank you for joining in. But Kush, let me start with you, because the markets, in the morning, the guests who were there on air said that 22,000 was not necessarily a really important level. Maybe 21,800 was the more important level, but we seem to be defending that 22,000. Is it of any significance?
Hi, Ambrish. Not really, except for the fact that market is making it to be right now. We've spoken in the past on the channel where I am of the belief that the bottom, or at least the near-term bottom, could well be formed within a broad range of 21,500 to 22,500. It just so happens that bang in the middle of the range, that range, the Nifty seems to be taking support at the moment. But what's happening is that you've got this downward momentum, this fair downward momentum that is taking the markets lower, especially the index Nifty to some degree, without any favorable risk reward ratio on the short side. And this could well extend to those levels of 21,800 that you mentioned, perhaps even 21,500. But Nifty is now starting to get oversold. On RSI, it's coming very close to those 20 marks that we discussed, 20 level that we discussed yesterday. So the risk reward ratio on the short side from here on is extremely unfavorable, right? Now from here on, what could happen is that you could well see a rebound rally, something that we've been discussing but has been elusive. So shorts don't make sense. In fact, I am actually now seeing signs where this could very well be a reversal rally whenever it comes about, and no longer a rebound rally. If it would have been a rebound rally, it would have come from higher levels, and then we would have sunk lower to these levels or below. But I think from here on, there is a very strong case to be made for a proper reversal rally. As I said, it could be from here, it could be from 300 to 500 points lower. But now the case is starting to look like a more of a reversal rally. So if you've got a position, or if you've got a view of a medium to a long-term perspective, I think these are the levels where you start accumulating. Even if you want a positional long on the Nifty, it might not be a bad idea. It's just that its volatility and the downward momentum that's not making it look as attractive at the moment.
Kush, your picks in this market?
So after that positive comment, dare I give a short call? So both my calls today are on the long side. One is Abbott India, one stock that we've discussed in the recent past, around the levels of about 28,500, or 28,500, 29,000. It's been gaining grounds for the last few sessions. Today also back on track, on the way up on the back of good volumes. So this is one trade that you could still continue to hold or build afresh. 32,000, 32,800 are your targets. 30,600 is your stop loss. On the long side, from the financial space today is Shriram Finance. Again, here we've seen a golden crossover of the 20 and the 50-day moving average. Recently, we saw this stock break past the 200-day moving average, but more importantly, sustain above that for the last 3 to 4 sessions. So this positive momentum could continue for levels of 643 and 663. 603 is where you place that stop loss.
Okay, as news stands, Australia has chosen to bat first against India. It's an important update, I must tell you. It's the Champions Trophy semi-final, and people are wondering what will happen there too. But any case, Ambrish Baliga, like I said, good talking to you after a while. Ambrish, what are you doing currently? Are you fishing in the pond, or are you sitting by the sidelines?
Thanks, Dheeraj. In fact, since the last, I think 6 to 8 months, I've been saying that the markets are overvalued, and we had got into cash to the extent of about 40%. That was the amount of liquidity we were sitting on. And till about September, October, we were proven wrong. And it was quite tough sitting on liquidity when you have the markets going up. But then this is the time we are actually waiting for, and it's happened. In fact, we had a price target, like a Nifty target of about 22,000, 22,500 to really start buying in a major way. Although, all the way down, we were buying in small bits and pieces. But then at this point of time, from that 40%, we have come down to about 10% liquidity. So 30% is something which we have invested in the past couple of days, mostly in the past couple of days. And I believe at these levels, the valuations are very decent. And I think if you are waiting to buy, then this is the time to buy. Because the way I see it is there are two sets of people in this market. I mean, there are those who don't have liquidity. They had invested earlier. They're sitting on losses. So either they are sitting out of the market or they are panicking and selling. And there is another set of people who have decent amount of liquidity, but are still waiting for lower levels. So if you don't invest or start investing at these levels, you'll never invest. You'll always keep waiting for lower levels. You'll see those lower levels, markets will bounce back, and then we'll say that, okay, that was the bottom. We didn't buy, we have missed out. And then the FOMO comes in. So I think that FOMO is going to help us. I mean, those who have bought now, I think that FOMO by others is going to help us going ahead. But as of now, I'm investing. I really don't know where the bottom could be. We could see another 500 points fall from here, another possibly 800,000 points fall from here. Because whenever there's panic in the market, I mean, although right now I won't say it's a huge amount of panic, but yes, there is a bit of panic. But whenever there's panic in the market, you really don't know as to till where it can go. I mean, just like the way euphoria took it to 26,000 levels. Here, it can take it to 21,000 levels or maybe below. But I'm comfortable buying at these levels.
Ambrish, before I get to what you are buying, and that's also equally relevant, let me quickly ask you, how much of that cash have you deployed already and how much are you still sitting on? So just wanting a perspective on how quickly you're deploying that.
Like I said, out of the 100%, which was in equity, 60% was invested, 40% was in cash. Today, at this point of time, we are more or less 90% invested, 10% in cash.
What are you buying, if I can ask? What are you liking? Spaces, pockets, names?
See, I mean, we are buying across. We are buying into FMCG, consumer durables. We are buying into auto. In fact, the numbers which came for Tata Motors were negative, and that's exactly what we are waiting for. To get a stock like that closer to levels of about 600. So yesterday we picked it up at about levels of 615. We are not really buying majorly into IT at this point of time. We are not really buying into pharma at this point of time. But then, most of the other sectors like specialty chemicals, we've been buying, light engineering, we've been buying. So it's been across.
Ambrish, we do this special segment every afternoon on our YouTube live, and we had a question today. And a viewer had asked this, and we found it interesting. Sell Tata Motors at a 30% loss, book that loss from a tax perspective, and buy M&M, which has also fallen. Would you, at this point, you seem to be more skewed towards Tata Motors, but wanting your take on M&M as well, would that be an interesting one to make, or would you avoid it?
If you have funds, then you buy both. I'm not negative on M&M. In fact, I'm positive on M&M, looking at the sort of launches they have done. I mean, the latest launch, which is of those XCVs, and the sort of bookings they have got. I think, M&M should, in fact, do extremely well going ahead. Even if you look at the Feb numbers, they were decent. So it's not that I'm negative on M&M. I spoke about Tata Motors because that's one stock which had fallen heavily from the recent highs. So that was a good opportunity. But one thing is, in case the person doesn't have funds, then if it's a choice between Tata Motors and M&M, yes, I think M&M should do better. So he can exit Tata Motors and buy M&M. But if he has funds, buy both.
If you have funds, buy both. So, that's a constructive Ambrish Baliga and a reasonably optimistic Kush Bora on selective parameters, by the way. Keep that in mind. I think going balanced with one long, one short has largely, maybe slightly different today, slightly different end of the day today, but largely that's been the thing. And we're talking about stocks which are doing well. One of the key stocks of the day today is Vijaya Diagnostic. Let's pull up the chart. It's up about 9%, was up about maybe 13-14% at a point of time. One, MK has reiterated their stance on the stock and placed the target at 1200. So that is one thing. And two, I think people are generally constructive around this space, diagnostics / hospitals. First, Varsha Johnson, to tell us more about the curious case of Vijaya Diagnostics rally today? Varsha.
Thank you for that. So yes, as you rightly said, people are actually few analysts are bullish when it comes to hospitals and diagnostic, considering the double-digit growth that one is expecting in diagnostics. But let's just move on to what MK has to say when it comes to Vijaya Diagnostics. The one thing is that MK did a market or rather channel check wherein all the diagnostic players, including the online players, have increased their price. Normally they do every year, but MK has reiterated buy on Vijaya Diagnostics at target price of rupees 1200. Now what are they saying? That Vijaya Diagnostic maintains stable pricing, is benefiting from a firm market, and the market is actually shifting towards organized diagnostic players versus in unorganized. So we all know there's a shift happening when it comes to diagnostics from unorganized to organized, especially after COVID, and this is the reason, one of the reasons why every analyst is actually bullish on the diagnostic players. What they are also saying that the rising demand for preventive testing will boost Vijaya's growth potential, and also Vijaya's current stock valuation is considered attractive as per NK, and the network expansion and operating leverage will actually help Vijaya to drive growth ahead. And we all know that Vijaya is actually more towards South India, but Vijaya is expanding into the other markets as well, which will also lead to the growth prospects that the company has. And the Vijaya has been able to maintain pricing while online and hospital chains are competitive. One of the key interesting areas that I found on the node. And lastly, what they're saying is the market analysis shows a stabilizing competitive landscape, which will actually help Vijaya going forward.
Very interesting. Ambrish, so first off, thank you, Varsha. Ambrish, how would you play this? Would you play this through diagnostics? Would you play it through hospitals? Would you play it through core pharma? Is this at all on your mind?
No, see, in the hospital or the healthcare space, I can divide that into three parts. One is the pure pharma companies, then you have the hospitals, and then you have the diagnostic chains. Pharma, as of now, I think is decently priced. I mean, compared to the rest of the market, it is. I mean, I would say there's not much of an opportunity in pharma. I think there's much more of an opportunity in the rest of the sectors. When it comes to the hospital chains, yes, I think one can still look at buying that because there's something called healthcare inflation. Not many people talk about it, but healthcare inflation in India is about 14%. I mean, that really shows that the way the top line can grow for most of these companies. If you're talking of the diagnostic chains, I mean, there we see increase in demand. By the same time, there are a number of chains which were smaller, which were regional. They have become national chains, and because of which we see that there is a decent amount of pricing pressure across. So diagnostic chains, I won't really buy at this point of time, although the stock has moved up Vijaya Diagnostic, but still, I will not be a buyer in that.
Okay. Kush, your quick take with regard to Vijaya Diagnostic at this level, 8% higher, 1,000 odd in terms of the price?
So good move, no doubt about it. And it is coming after a good base formation. So I wouldn't call this a sporadic one because it was in the offing. In fact, 3 to 5 sessions ago, there was a very similar move, on the stock, again on the back of good volume. So there was a good base formation around the 900 mark, after which this move has come about. But if I draw, a falling trend line from, let's say, mid-January, there's a very clear resistance from the 1080 mark. The high for the day, for the stock is also around the 1072 mark. So that falling trend line resistance has been acting up for it over the last 2.5 months. So for me, a meaningful buy from here on would come in once the 1080 level is crossed. So given the kind of resistance that the stock is facing at the moment, if you have an existing position, my suggestion would be to rather book it and move out. Any fresh positions should be considered once the stock crosses 1080.
Okay, on that note, Amrish Baliga, great having you. Looking forward to more conversations. Thanks for taking the time out today. Kush, stay on. Time to focus a bit on the global picture as well. Manish Singh, Chief Investment Officer at Crossbridge, joins in right now with his thoughts on how does he see this whole tariff issue, trade war and the resultant impact on risk assets. Manish, great having you. Thank you for taking the time out. The tariffs go into effect in a few hours from now, if not already, right? What do you reckon is the impact on various measures like inflation, discounting rates, risk assets, and the whole question of flows?
If you see what we have got so far by way of announcement from President Trump, this is going to have a negative impact straight away. It also depends on what the reaction functions are going to be. So if you take one by one, if you look at Canada or China, if Canada does a retaliatory tariff, which is what they're saying that they may do, then that may have some negative impact on the US, but far more negative impact on on Canada. Same thing happens with China as well. Last time China didn't do as big a retaliatory measure if you compare to what US had announced on China. So we have to look at what the reaction function is going to be. My view is that overall, if you take a slightly medium-term view, the tariffs are going to come down across the board, across the country, because that's exactly what President Trump is trying to achieve. Because his keyword is reciprocity. So if you're going to put tariffs on my product, I'm going to put tariff on your product. If you bring the tariff down, I'm going to bring the tariff down too. So that's what he's trying to achieve. So people may not like it, but he's doing what he has said. Now, you would expect that a rational person would think that why am I putting tariff on American products if I don't want my products to be tariffed? And therefore, I should be bringing tariff down on my exports to the US. And that's where I think we are going to head eventually. Now, will that be in a week time, a month's time? It's difficult to get. So if you have a short-term position, and if you're doing a short-term trade with leverage, then you are in trouble. But if you're taking a more considered view of medium term, then you will have plenty of opportunities to put your long trade.
So how would you play it, Manish? Sorry, this is Harsh also joining in. What is your perspective on... Hi. How would you therefore see this play out, and how would you play this in terms of a trade?
Sure. So for me, I mean, I'm going to put some US trade today as well when I get into office, because it has again opened up a nice opportunity to go long. My view is that things are moving very, very fast. You will see it's quite likely that, Zelensky goes to White House this week and signs a deal. Who knows? If you see that happening, then suddenly there'll be a risk down. On tariffs, Canada has said that, but let's see what they do. If you look at Peterson Institute, they have published a chart last night, or I think they had done a study last month. It's very clear that the impact on US is going to be very small compared to the impact on other nations who are going to retaliate to the tariff that the US is going to impose. And those things are going to be talked about and discussed. So my view is that tariffs are going to come down. And whenever I put a trade, and we've had this discussion many times with Neeraj, is that I look at 6 months, 12 months horizon when I put the trade. So if something has sold off 10%, I'm very happy to take and add to the position on those things. So yes, you will have mark-to-market pain, as I'm sure people would be having this morning, given what we saw the sell-off in the market yesterday. But, that comes with investing. You have to bear your mark-to-market. If you think that your stocks are good, you should keep buying it at whatever level is good for you. But for me, I'm going to put some long trades today, yeah.
Manish, the final question is the result, the impact, and maybe you dwelled upon it briefly, but the impact on the DXY, because one would have anticipated that with this happening, the DXY would strengthen, but yesterday, DXY really took a pounding, if you will, relative terms. What do you reckon is the natural course for the DXY over the course of the next 1 month if tariffs go into effect the way they are and there are counter tariffs?
Yeah. So if you look at President Trump's announced goal, one of his goals is to get dollar weaker. Now, I'm not saying that, if you showed this chart to Trump, he would be happy that it's a tariff, and I hope nobody shows that chart to him, because then he'll double down. I think the dollar getting weaker, if you look at just one-day measure, it just doesn't tell you anything. I mean, FX is a very very, very volatile market. You can't just base your views on just one-day movement. If you, again, dollar is very strong. We all know that dollar has been strong, and it has been strong for the reasons we know, because there is no other currency or economy that is doing as well, at least not an open economy, because China is doing well and its currency is doing fine, but not an open economy where capital flow can go in. So dollar takes all the capital flow, and that has been the one reason why you are going to see weakness in dollar is of what's happening in Europe. So you saw equities rally in Europe yesterday on the basis that Europe is going to do more defense spending, Europe is going to basically engage more in the global economy, and they will look after themselves. And then you got an announcement from Frederick Merz, the incoming chancellor in Germany, that they're going to, I don't know exactly what he has said, but I saw some news about he's going to get past his debt rule and the government is going to spend 200 billion euros or something of big money. You saw bounce in all the UK stocks because UK has come out really well, if I may say that. If you look at the announcement on the weekend, UK has repositioned itself at the center of Europe once again after Brexit, and that's going to play well with them. So if the capital flow moves into Europe, moves into UK, then there will be some weakness in dollar, but I do not see how dollar can continue to weaken given the strength of the US economy and given how well the US is doing, and there's little by way of competition. Eventually, when dust settles and the risk goes off, and we don't know when that will be, then you would expect people to use dollar and go into risk assets, and then you would have some weakness in dollar, or there are rate cuts and that brings weakness in dollar. But I don't see that as a trend. Not now. At least I don't see that for next 6 months at least, that you'll have a weak dollar.
Okay, Manish, we'll leave it at that. Thanks much for taking the time out and being with us and giving us your thoughts. That's Manish Singh of Crossbridge with his thoughts on this tariff war. And well, interesting thoughts. I mean, this is just the reactions that have been interesting, wherein the DXY actually down 1% yesterday. Yields have come off too, which was fine, anticipated, because the flight to safety because of the treasury. But the DXY move was a bit perplexing, to be honest. But interesting times for sure.
Yeah, absolutely. And volatile too. I think uncertainty is I think the word at this point. But as we talk about what the future of global trade would really look like and how these tariffs will affect oil marketing companies, we have Somit here who joins us with an analysis.
Well, yes, oil marketing companies remain in focus. There's a potential double dhamaka for them, given the fact that oil prices have come down to around $71 per barrel level, which is the lowest that we are seeing in 2025, while gross refining margin, or the Singapore gross refining margin, which is the Asian benchmark, have climbed to nearly $5.4 per barrel, again the highest level that we are seeing since 2025. Now, higher GRMs and lower crude prices benefit oil marketing companies on earnings point of view, but do remember that actual financial benefit will only be realized if current prices remain at the current level for a longer period of time. Now, for refining margin, on the refining side, if you look at every $1 per barrel rise in the gross refining margin benefits MRPL's EBITDA by nearly 1,000 odd crore rupees. It increases Chennai Petroleum's EPS by around 30%. For Indian Oil Corporation, BPCL and HPCL, their EPS goes up by nearly 14 to 16%, and for Reliance Industries, their consolidated earnings increases by around 4 to 5%. But then again, for actual benefits to realize, Singapore gross refining margins need to remain at the current levels for a longish period of time. Now, when it comes to a marketing side, lower oil prices boost the gross marketing margin that the oil marketing company earns on selling every liter of petrol and diesel. Now, current fuel refining marketing margins, if you look at, is at around 9 rupees per liter for petrol and 7 rupees per liter at diesel, which is at a multi-quarter high for both the retail fuels. Now, every 0.5 rupees per liter increase in the gross marketing margin benefits Indian Oil Corporation's EBITDA by nearly 7%. For BPCL, it increases their EBITDA by nearly 8%, and for HPCL, the delta is much higher at around 11%. So keep an eye out for oil marketing companies, given the fact that GRMs have risen to 2025 high levels and crude prices are at 2025 low, and both these factors could boost their earnings if the prices remain at current level for a longish period of time.
Thanks so much for that, Somit. Kush, let me come to you. Take a quick view, because all of these are buzzing in trade today. HPCL now up nearly 6%, IOCL up 3%, BPCL up nearly 3% as well. Is there a trade here?
Avoid all three of them. The price action is far more attractive than the volume action. even on the way down, after being beaten down for such a big magnitude and for such a long time. Day before yesterday, when these stocks were down, the volumes were significantly higher than they are today on the way up. I don't think averages matter right now. Even then, all of these are trading below their key averages. But as I said, it's not a volume back move. The price move right now is just more glaring than the volume action move. As in when the volume picks up, perhaps it might turn attractive. At the moment, I wouldn't really go long on any of these things.
Cautious, at least on this trade. That's Kush's view, but we slipped into a very short break. Of course, much more on the other side to talk about because there are plenty of moving parts in the market. We'd like to cover some of those, so stay tuned.
Very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction and healthy correction is a very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers, and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction and healthy correction is a very integral part of the market.
All right, back with India Market Close right here on NDTV Profit. It's that time of the show wherein we talk about what is being heard on the street. Samit Zarkar joins in with all the chatter from the dealing room. Samit, what are you picking up?
Well, firstly, it's Paytm. The stock is down 4%, and what I'm listening is that potential block deal by the FI investor is likely to happen this week. and that's the reason we are seeing such kind of a downtick when it comes to Paytm. The second stock is Lind India in focus, and dealers are indicating that there is a potential order win that could come in for the company from Tata Electronics, a semiconductor plant in Dholera, so watch out for Lind India as well. Titan is the third stock in focus. What I understand, what I'm picking up from dealers is that large HNIs have started to accumulate this counter at lower levels. The stock is near 2 years low, and when you compare it with the valuations, it's at a sharp 17% discount compared to the historical valuations, and hence large HNIs have started to accumulate this counter. Then there's Marico in focus. Now dealers are indicating that there are multiple sell block deals coming in from FI desk on Marico. And lastly, it's Astral and Supreme Industries. Now both these counters are down 4% in trade, and what I'm picking up is the fact that PVC prices, there's a potential price cut that is expected, and if that happens, then there could be a sharp impact on their inventory. There could be huge inventory losses for companies like Astral and Supreme Industries because of this price cut that is expected to come in. So keep an eye out for Astral and Supreme Industries as well.
Well, very interesting. By the way, we should get not Marico but Astral and Supreme as a stock out there. And it's very interesting because these stocks are down in the session today. 2.5-3% down for Astral. Supreme, in fact, down 4% as well. So clearly some stress onto some of those names. So Amit, any conversation around Interglobe Aviation? That stock has been in news for a number of days now. Any conversation on Interglobe Aviation flows, etc.?
Well, flows are obviously there in Interglobe Aviation, given the fact that it has a large market share in the aviation industry, and Feb and Jan numbers, if you look at, the air traffic growth was pretty much strong, and March most likely could be decent enough. So good numbers are expected from fourth quarter. Yes, a block deal is around the corner from the promoter side, but what I understand is that promoter most likely will settle when the prices are around the 4,600 to 4,700 band. So not much at a discount, and most likely it will happen at a block window, which means that even if there's a discount, it won't be more than 1%. And in past also we have seen that there has been very strong demand for Indigo's block whenever it has come in. So yeah.
Interesting. Interesting. So we'll have to keep our eye out on some of those. But let's quickly welcome on board our other guests for this afternoon. Of course, joining Kush is Aditya Shah, Hercules Advisors, and Aditya Agarwala, Invest for EDO. Both the Adityas, good afternoon. Welcome. And it's good having you guys here. Let me first start off with you, Aditya Agarwala. What are you sensing with regard to how should you play the trade at this point with regard to the index, and what are the levels that you're looking out for?
Hi, afternoon, Harsh. Afternoon, Neeraj. Thanks for having the show. I think markets are trying to find its feet, even though prices are yet to confirm that. Indicators are suggesting that an up move may be on the cards. Very difficult to call out an up move when the markets are correcting on a regular basis, and there is no respite if you are a bull here. So, but having said that, I do feel that a short covering rally might be there. But before I take a long trade, I'll wait for some of the levels to be taken out decisively. 22,200 for me is one such level, which I think if that is taken out decisively, then there is more room on the upside, and I could be in for a more short covering rally then. If till the time Nifty takes out 22,200, I'm not going extremely long on the index. Maybe one or two long trades can be taken. But as far as short trades are concerned, I'm not going for any fresh shorts on the index because clearly markets are sitting at extreme oversold zone. Back is completely against the wall for the bulls. I don't think so. From here, I see too much of a short covering selling pressure going ahead. Talking of Bank Nifty, 48,400, 48,600 is something that I'm eyeing. If again 48,600 is taken out on the Bank Nifty decisively, I would look to go long on the Bank Nifty as well for a target of 49,000 on the upside.
Okay. And Aditya, picks for this afternoon? Aditya Agarwala, your picks for this afternoon?
So I've got a couple of buy recommendations, Harsh. The first one is SRF. I think this is one stock which has clearly bucked the trend and it's constantly making higher highs, higher lows. So at current levels, I'll be a buyer in the stock. Look for a target of at least 3150 on the upside. The stop loss at 2730 on the downside. Indigo is the second buy, which we've been talking about sometime now, and Neeraj also mentioned sometime back what's happening in Indigo. So that's looking very healthy on the chart setup. I think 5,000 can be seen here with a stop loss at 4,400 on the downside. I'll be a buyer in Indigo.
Very interesting. Aditya Shah, what are you doing at this point? We're seeing markets fall from 26,200 to 22. Now we're close to that 22,200 kind of mark. What are you doing at this point? What are you advising your clients?
Hi, good afternoon, Harsh. So I'm pretty happy with what is happening in the market. That irrational valuation and the irrational froth is moving out. We are advising clients to go ahead and buy into the market. We feel that valuations across many of the stocks have corrected decent enough that you can start to take positions in them slowly and steadily. In fact, the valuation of the Nifty itself is also corrected. That for a long-term investor, it is a good proposition to invest in. So as they say, when everybody's scared, that's a great time to buy. And we are already buying across banks, across micro lenders, across chemicals, across FMCG now as well. Slowly and steadily, we are looking to buy. So if you have a long-term view, it's a great opportunity over the last 3 to 4 years to invest in the given.
Aditya, I also want your quick take with regard to Titan. Somi just broke that there are certain HNIs which are finding Titan interesting, and there's some buying interest there. Valuations looking okay to you, or do you still believe that it's an avoid?
In the last 1 year, we've learned this. If you buy at irrational and crazy valuation and the growth slows down, the stock will get butchered. Of course, Titan is a great brand. Tanishq people will trust way too much than any other brand. The valuation is extremely expensive per se at this stage. If people are wanting to buy, that is only because flight to safety and flight to quality branded players is going on. But I would tend to avoid the entire space per se for the time being. The valuation across the most trusted players is really very expensive, and the other players are having their own set of problems per se. So tend to avoid the entire space, the gold, gems and jewelry space for the time being.
What point would you buy? Very quickly, Aditya.
So if Titan comes at a P multiple 40 to 50, that could be an interesting space to buy Titan.
1 year forward.
Yes.
Understood. Kush, your take with regard to Titan on technicals?
Harsh, the good thing is that the volumes are now starting to thin, right on the way down. So, there could be a possibility that the stock might take support near the historical support zones of 2950, 3000 odd. But don't preempt that. There's a possibility that the stock might consolidate for a while before moving higher. So, any kind of support near the 2950, 3000 mark should be taken as an opportunity to accumulate the stock. I wouldn't start just yet because the price momentum is still there. But as I said, the heartening fact is that the volumes on the way down have started to thin.
Okay, interesting. The other one is the big boy, Reliance Industries, in focus because they have received a tax demand for $2.81 billion from the Petroleum Ministry in the gas migration dispute case. I stand corrected, it's not a tax demand. Mika joins in with more details on this one.
So Reliance has received a $2.81 billion demand from the Ministry of Petroleum and Natural Gas. Now this demand notice is following a recent division bench ruling of the Delhi High Court, and this is regarding a dispute that started long back in 2014 between RIL and ONGC. These both companies had adjacent blocks, and ONGC claimed that Reliance migrated gas from ONGC's blocks, and hence Reliance was liable to pay. Now when you look at the timeline, 2014, the dispute began when the government demanded $1.55 billion from RIL. In 2016, the government sent a notice to RIL and its partners British Petroleum and NECO. In 2018, an international arbitration tribunal ruled in favor of RIL. But in 2023, a single judge of the Delhi High Court dismissed the government's appeal. And now in 2025, the division bench of the Delhi High Court has overturned the single judge's ruling, requiring RIL and its partners to pay $1.55 billion. And yesterday, Reliance has received a demand of $2.81 billion from the government, and the higher amount that has been demanded could be because of interest and penalties. Now, if liable to pay, then the $2.18 billion, which is roughly around 24,550 crores, translates to 31% of the last 12-month profitability that Reliance has seen. But Reliance has clarified, they say that the provisional demand is unsustainable. They're taking steps to challenge the judgment and do not expect any liability on this account. Separately, as per Bloomberg, RIL has also been penalized by the government after failing to set up a battery cell plant. Reliance New Energy Limited, which is a wholly owned subsidiary of RIL, was fined 125 crores back in 2022, and Reliance New Energy had won a bid for the battery cell manufacturing under the PLI schemes.
Thanks so much for that, Mika. Kush, your quick take, very quick, with regard to Reliance, what's the sense?
Not too encouraging. It's broken all the key support zones. 1200 was a very stiff support zone that is broken below and sustaining, below that. So for now, this downturn could perhaps accentuate a little more. 1145, 1120 are the zones to watch for on the downside. If it regains the 1200 mark, that's when some kind of a reversal perhaps could be on the cards. But up until then, the stock could remain under pressure.
Okay, Aditya Shah, your sense with regard to Reliance from a fundamental perspective, stock has fallen and it has fallen across time periods. 3% down in the last 5 days, 9% in the last 1 month, 23% in the last 6 months and 12 months, and from the top nearly down 30%. For the size that it is, what's the sense at this point? How should you look at this stock?
India moves Reliance. That's the only thing that I would say. The stock has moved to a 52-week low on the back of all of these news. But the business continues to deliver very strong results and very strong numbers from my perspective. The delisting of Jio and the Reliance Retail is going to be the next trigger for the company per se. So in my opinion, as I've been saying over the last 6 to 12 months, this derating of Reliance is something that is beyond my understanding, and I would be a buyer in Reliance at this price. Even though the stock may fall further, I'm pretty okay with it. The prospects of the company over the next 2 to 3 years continue to be really very strong.
And this $2.81 billion liability, not a concern for you?
Of course, but it's Reliance and they work it out with the government per se. So I'm not too much fussed about the tax notice that the company has really filed.
Okay, point taken. Let's though switch focus because Mika continues to wait by. She is also listed down our top 3 stocks for the day. Mika, what's on your list?
Yeah. First, we have Gensol Engineering. It's hit a lower circuit of 20%. This was after the long-term and short-term bank facilities were downgraded by CareEdge ratings from a Care BB Plus to a Care D rating, which is default. The ratings were revised because of ongoing delays in servicing term loan obligations and is in line with the company's default recognition. The CareEdge has also stated that the company's liquidity remains poor and the ratings are pertaining to 4 instruments with a totaling 716 crores, which were downgraded. Then you have India Cement. Stock is up almost 14% on an intraday basis. The volumes were almost double than the 20-day average. We had 2 large trades in focus. 26,062 shares were traded for a price of 287 per share and 39,851 shares traded for a price of 278.15 per share. We also had a Nomura note come out this morning talking about cement prices picking up. The pan-India prices are up 3 rupees per bag month on month in March. They're up 2% on a quarter-on-quarter basis in Q4 so far. We've seen all the regions see a 4 to 11 per bag increase in March, highest seen in the north. Central has been flat. And India Cements, as of FY24, their south region market share was 8% and their pan-India market share as per capacity was 3%. And lastly, we have Hindustan Petroleum. Stock is up around 5%, and this is because OMCs could see dual earnings trigger. One is the Singapore gross refining margin, which is the benchmark, has spiked again above $5.4 per barrel levels, which is the highest in 2025. Brent crude also subsequently has fallen to $71 per barrel, the lowest level in 2025. And both of these factors are a boost for earnings for oil marketing companies like HPCL. From the refining side, HPCL could see an increase in earnings by 14%. And from the marketing benefit side, lower crudes helps their marketing margins, and every 0.5 per litre change in their fuel margin usually impacts HPCL's EBITDA by 11% on a positive side.
Okay. Thanks a lot for that, Mika. This is the problem with some of these businesses. Gensol is a case in point, right? That stock is just down 20%. And if you look at, let's say, the last 1 year, right, a mid-cap, small-cap name, which largely, I believe, has corrected. I may be wrong here, but I think I'm not. Let's pull up that stock price over the last 1 year. Look at that crack, and then these things happen, and investors don't get an exit. That's the problem. But let's talk about the good part, and which is what's happening to HPBP IOC. Aditya Agarwala, HPCL nearly 5.5 or nearly 6 rather. The other 2 not so much. Is there a trade in either of them, in any of them, any one of the 3 of them?
2 stocks, Neeraj, both HPCL, BPCL are good to trade at current levels. If we talk about BPCL at current levels, Definitely one can look at a short covering rally from here on, look for a target of 265 to about 280 on the upside with a stop loss at 240 on the downside. If I talk about Hind Petro, that also is looking good at current levels. Can be bought at current levels or maybe on a slight decline to 310 on the downside. Look for a target of 350 on the upside with a stop loss just below 300, I think. So both the stocks should see good short covering rally in the coming few trading sessions.
The other interesting one, Neeraj, in fact, when we spoke about, or what Mihika spoke about, was Gensol, the credit rating downgrade. Aditya Shah, I'm curious to know your take, because you have lenders like PFC, you have lenders like IREDA, who have lent to a Gensol. IREDA, of course, in terms of percentage of AUM, the exposure is large. PFC is negligible, frankly. And IREDA has always come out and suggested that, you know, they've got a good book. Trading at roughly 4.5, 5 times now, was trading at 9 times at one point, price to book. The correction plus this, would it at all encourage you to probably dip in, and if so, at what level?
Harsh, so in 2021, 2022, green energy was the theme. Gensol got into it, the EPC contracts and manufacturing of car. But sadly, delivery of the promises have not been kept. They kept on diluting, they kept on taking more and more debt. And the eventual outcome is the companies fail to deliver. They're defaulting on their loan obligations. And on top of it, there was a promoter press which they spinned it off as saying that promoter is selling shares to reduce the pledge. So Gensol, all the signs were already there 1.5, 2 years ago that something suspicious here is going on and investors need to be really very careful. Investors really did not care because the stock price was moving up. So the situation for Gensol is now really very difficult. They need money, but they don't have any access to money any longer because of whatever the credit default credit default, not default per se, but the loan the credit derating that has really happened. Specifically on the lenders per se, on IREDA per se, again they have spinned off a story saying that they will continue to keep on lending to green energy players. My concern on the green energy players is over the next 3 to 5 years, so much of capacity is coming on board that many of these players will not find it viable enough to run these projects per se because of so much capacity coming on board. So I would be very careful on IREDA solely on the purpose of the valuation that they are trading at. It's extremely expensive, and one needs to be really very careful on this stock. Rather than this, you can look at micro lenders where opportunity is huge and the valuations are really very cheap. You should be cautious on all EPC lenders. You should be EPC players within the green energy space. You should be very cautious on companies like Variant Premier Energies also, and you should be also cautious on the lenders per se, because they are also going to face a lot of rot when these stories start to get on. So be very careful on the entire space and don't bet on irrational valuations per se.
Yep, valuation is certainly expensive for this one, but you know, not all expensive valuation stocks are being disliked by the market. In fact, on our bull versus bear segment, Varun Beverages is a stock in focus. It's in fact buzzing in trade today after CLSA upgraded the stock to a high conviction outperform and believes shares can rally 70%. Mahima Johnson to dissect what is working and what is not for the stock. Mahima, good afternoon.
Good afternoon. So, in terms of the bull versus bear case for Varun Beverages, the first parameter that I've taken is the financial performance, of course, in Q3. Gross margins did improve, and this was on account of their strategic procurement that they'd done in terms of PET chips, and they'd stored them, and that helped them avail the price benefits, which is why gross margins did uptick. But EBITDA margins were flat due to consolidations overall in the South Africa market. So that's the first parameter. The second one is there is increasing competition coming in from Campa Cola as well as Coca-Cola also ramping up things in India after Jubilant Bhartiya Group acquiring Coca-Cola, competition is definitely increasing for Varun Beverages. But in Q3 con call commentary, management did mention that so far they have not seen any dent on growth coming in from competition. In terms of competition, again, the total addressable market, as mentioned in the report today of CLSA, that the total addressable market of soft drinks is very large. Plus, Varun Beverages also has an upper hand when it comes to the snacking industry. They've also recently forayed into the Pepsi's snacking portfolio. That definitely calls for a bull case. But Jubilant Bhartiya Group has recently acquired stake in Coca-Cola, as I mentioned earlier. And this could possibly mean that all Jubilant Foodworks stores, that is all Domino stores, which were till now selling Pepsi bottles, might shift to Coca-Cola bottles going ahead. So that might be a huge market share loss if and when implemented, of course. Next, the bull versus bear cases with respect to the stock performance. The stock is down almost 27% YTD despite the uptick in stock today. But overall, again, as mentioned in the report, the stock currently is trading below its average multiple. Although still it is looking expensive at around 43 times multiple, but it's still trading so according to CLSA, it's trading below its average multiple, which is why it is looking attractive to them. Lastly, they've upgraded it to high conviction outperform with a target price of around 770, which they've slightly cut the target price by some points from 802 to 770, but they've also made a 4 to 5% cut in their earnings estimates, and this is because they've mentioned that we're making this earnings cut with respect to the heightened competition that is coming in, which might take away some market share from Varun Beverages. So this is the overall bull versus bear case for Varun Beverages.
Well noted. Thanks a lot for that, Mahima. I wonder, Kush Bora, if you find a trade possible in Varun Beverages at these levels. Okay, I think we've got a bit of a glitch out there in Kush's feed. Aditya, can you tell us if you will trade it now? Aditya Agarwala, traded now at 470, 778.
Oh, absolutely. As a disclosure, this is one stock that we have recommended to our clients, Neeraj, day before, yesterday rather. We have recommended this client to our stock to our clients. I would trade the stock for a target of 540 on the upside. Stop loss now comes to around 450 on the downside. So with a 20-25 rupee downside, I definitely see there is an bull case here and can easily see levels of 540, and if 540 is taken out, then maybe 560 is also something which is possible. So a thumbs up, and I would like to trade the stock even at current levels. Yes.
Okay. Aditya Shah, I mean, summer play, if you will. So Varun, there could be something else. Would you either consumption or a summer play or a combination of both? Is Varun a good bet, or would you look at something else?
An okay bet. Just from a valuation perspective, the valuation continues to be extremely expensive. With Reliance coming in with Coca-Cola and now Jubilant buying into Coca-Cola, the competition is set to increase per se. But having said that, the execution capabilities of the management of Varun Beverages is excellent. It's an excellent company that will continue to keep compound over a period of next 5 to 10 years per se. So from a valuation perspective, I will want the stock to cool down a little bit and then make an entry. However, long-term story continues to be still very, very strong, and it will continue to remain a long-term compounder.
The other one which is zooming in trade, and Neeraj and we were just talking about it, is India Cements. Aditya Agarwala, view here 16% up now. Know that there is some trigger with regard to cement prices pan India, which have gone up by ₹3, and then certain geographies seen a higher increase, but outside of that, no real trigger, and therefore, what's your take?
I think stock is poised to test 320 levels on the upside. Harsh, the kind of volume that we are witnessing today is something to notice, take a notice of, and it's very encouraging to see this kind of volume in the stock after that big fall from 380 odd levels to about 240. So yes, I still believe that one should continue to hold on to the stock. If you're looking at a fresh entry, even after a 6% upside, I wouldn't shy away from taking a fresh long in India Cements at current levels. Maybe with a stop somewhere around 280 types and look for a target of 320 at least. That is where the 200 DMA is. And I think stock will go to that levels at least in next 2 trading sessions.
Okay. Well, I think we need to slip into a break. As we take that break though, the match which is everybody's eye of interest in Australia facing India in this semi-final of the Champions Trophy. 23 for 1. Currently is Australia. Travis Head seems to be playing well, but, well, are you bleeding blue, Harsh?
Absolutely.
You win.
Bleeding
you think India
blue.
will win?
Post 3:30 p.m. bleeding blue.
You think India will win?
I believe so, yes.
You believe so.
But statistically, and we're talking about this, only 4 times India has won in ICC tournaments, 3 of which man of the match was won by Yuvraj Singh. We don't have him, of course. We'll miss him, but
you mean against Australia?
Against Australia in ICC tournaments. So yeah, 2007, 2011, 2003, if I recall right, and
the last 2020 World Cup also.
Yes.
But yeah, point well noted.
So, yeah.
Okay. I wonder if our guests are as enthusiastic. Either of you, a big fan of this match? Any thoughts?
Absolutely, Neeraj.
Okay. Aditya Agarwala said piped up. Okay. So, Aditya, betting on
Absolutely.
India, betting on Australia?
Has to be India, always.
Has to be India. Okay. Wonder if that's
you can make out from the color of my jacket today, I guess. This is the closest I could get to bleed blue.
Okay, fair call. Let's take the break. We come back and talk more about the markets. Stay tuned.
Very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breathing also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers, and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breathing also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
Welcome back. You're watching India Market Close here on NDTV Profit. Now, we have the India-Australia match. Couple of triggers here about what we're going to talk about. We have the India-Australia match. We have Kush and we have Aditya Shah. And therefore, it makes for a good understanding of what's happening in food delivery and Zomato especially. So ISEC has released a report and we have both of those, Zomato and Swiggy, buzzing in trade today. We have Mahima here to break down the details of what that report says, and then we'll quickly take views. Mahima.
Right, so they've reiterated buy for both of these counters, that is Zomato and Swiggy. For Swiggy, the target price is 740 and for Zomato it is 310. What they're saying is that the concerns of cash burn for quick commerce has been overbaked into the price of Swiggy, and Swiggy is now trading at a 30% discount to par value for the food delivery business. For Zomato, they're saying that the trading is at a value that ascribes nothing to the quick commerce space. Now, in terms of the food delivery breakdown, what they've said is that food delivery is being ignored amidst the panic that has been created over quick commerce. They do not think that there's a reason to be worried about structural growth drivers in the food delivery space, and they believe that the income tax cuts are likely to trigger strong consumption growth, and the sector overall could be the key beneficiary of this tax cut. Now, in terms of quick commerce, they're saying that the item level discounting in the past has kind of passed the peak levels that have been seen between November 24 to Jan 25, and there's a noticeable pullback in the performance marketing spends as well, which is going to aid the EBITDA growth going forward. And lastly, valuation for quick commerce business is compelling for investors right now, is what the report is saying. So these are the arguments that it is given with respect to both Zomato and Swiggy, and why they're bullish on both of these counters.
Okay, well, certainly some upticks. Harsh, we have some interesting sound bites from the past.
We do, and I'm not sure if Aditya Shah actually bought into Zomato when it was nearing that 200 mark. Did you, Aditya? You're waiting for 215. You are waiting for 200, is it, Aditya? Because at 215 also didn't look too bad, right? I mean, so give us your.
Yeah. So support is one thing, but if you analyze the businesses correctly, you will find that the food delivery business is indeed slowing down both for Zomato and Swiggy. First point. Second point is we've seen today a comment from Dipinder Goyal saying that 5,000 crores of quarterly cash burn every quick commerce player is doing, and he justified it by saying that Blinkit's cash burn is lower. I fail to understand with Flipkart coming in, with Big Basket coming in, with Swiggy coming in, with Zomato coming, who eventually is going to win up and who eventually is going to shut shop, is not very clear in the food delivery, in the quick commerce business per se. So my perspective to investors clearly is the quick commerce business. It is very unclear who is going to win. In the food delivery business, we are very clear that Zomato and Swiggy are going to win. But it is not so clear in the quick commerce business per se. So long-term investors can look at Zomato at about 200 levels per se. But this is a concern for me going forward on both these stocks, that who is going to clear out on the food delivery business, on the quick commerce business per se. And now, mind you, I will also put this in. Maybe Harsh and Neeraj, you must have got it. All of these players are discounting very, very heavily on the quick commerce space. They credit 50, 75, 100 rupees to all users in order to get them to order per se. So that's a concern for me, that if this discount really vanishes out, how are they going to sustain themselves if orders drive? So that is something to be thought about per se before you go and invest in Zomato or Swiggy per se.
Okay. And this remains now an industry wherein usually the things were that if this product is being used, then you go out and buy the stock of that company. I don't think that is true for the quick commerce space, because everybody will be using maybe one or two or all three. And right now, with the way they are burning money, it's great for the investors, maybe not as good for the companies themselves. But yeah, beaten down so badly today with the bounce. I mean, 1.25% up for the small cap space. Surely some of these stocks could see a beating. I don't know if it's also got to do with the fact that yields have come off in the US, and typically a lower interest rate regime, if rates were to be believed to be lower, augurs well for some of the tech businesses. But Aditya Shah, in the same vein, and I think we've got Kush Bora back as well, so we'll talk to Kush too about this. But Aditya Shah, in the same vein, Indian IT, tech outsourcing. Now there is IT services, there is ERD, right? IT services certainly gets disrupted with AI, right? One would presume so. Maybe not ERD as much. Now, I'd love to understand, are you invested in any of the tech names? If so, why? If not, why not?
We've got within the ER&D space a sort of player L&D technology services. We've also got a pure play IT company L&D Infotech Mindtree. I believe that a lot of negative sentiment is already being built into a lot of IT stocks. I am a believer that the near term looks really very negative for the IT companies, but longer term it really looks positive. So I am starting to keep my eyes wide open on the IT companies. IT companies will come at a valuation at which you could start to decently invest in these companies. And as Neeraj you already pointed out, ER&D continues to be really very favored in this. Look at Tata Technologies, the stock that recently got listed. That stock is around about 50% from the peak. It got listed at about 12,1300 and it's just got butchered down in the entire IT melee that has gone in. So the IT sector looks really very interesting as a contra pick. We've got this as a top sector that you could invest in 2025. The returns would come only in 2026 or 2027, but this is a sector to invest in 2020.
Let's be careful with the trade though in IT, and Kush Bora come in here, but be careful with the trade in IT viewers, simply because overnight moves on the NASDAQ these days are very, very large, and in those swings, even if you're on the right side of the trade normally, but if the NASDAQ is doing the other thing, then your trade might get nullified. Okay, I think I've got a problem with Kush's feed, but Aditya Agarwala, would you, even if the chart is looking like trending, would you avoid trading the IT because of all these moves that we recently see, or are you happy to trade tech stocks?
Not be trading the tech stocks, but rather I would be looking at buying them for more of a longer term time horizon. And I completely agree with Aditya Shah that IT, I think so, is one sector which you should look to buy and hold at least for a year or so. And you can start with large caps and then you can add mid caps to it as well. Names like Infosys, TCS, I think so after this correction, they offer an excellent risk to reward ratio. I can add a persistent system Coforge to it as well. And I think so one should clearly look at creating an IT basket and invest in that IT basket for at least a year or so. And you will see sizable returns from here on. I think so a lot of negativity is already played out in the IT stocks. And from here on, I don't see too much of a correction in most of these IT companies.
Okay, 3% lower though for LTI Mindtree today and some others too. So keep that pocket in focus. This India Cements is the curious one. Simply because it's not that the rest of the southern cement companies also are moving higher,
yes,
and some of the others are not too. So it's a very large move that the stock has made today, 14% higher. Wonder why? I couldn't find a reason why the stock could be doing what it is doing.
Let's ask Aditya Shah if cement maybe interests him at this point. Aditya, would it and would the fact that there is an upside bias, if I can call it, to cement prices, would that interest you at all?
Not particularly, Harsh. Although I don't have any coverage on India cements per se, but cement is a really very commodity kind of product, and I would like to look at players who are dominant within their localities. For example, Dalmia Bharat is very prominent in the eastern side of the market. India Cements is very prominent down south. So that is where you should be looking at. Anyway, Ultratech is the one which my investment really was in. But then Ultratech chose to go into the cables and the wire spaces, which I think is not warranted per se. So right now, I don't have a pick per se within the cement space. I would tend to avoid the space.
What about SBI? Because some good commentary coming there as well, Aditya.
Was that for me?
Yes, please, Aditya Shah.
Yeah, so within the banking space, as I said, the larger banks will continue to do well. The larger banks would include HDFC, ICICI, Kotak, Axis, and SBI. they will hold on to the market. The market will not go down because these lenders will continue to do well. Whereas the smaller lenders will continue to face the wrath of the NPA cycle that we are currently seeing. You could see stocks like IDFC, which have just down 30 to 40%. Those are the lenders who are facing the wrath. The larger lenders will continue to remain very, very stable and are the stocks of 2025 from a return perspective. Their returns will outperform all other lender returns in this year.
Okay, let's talk more or hear out more voices as well. Earlier in the day, we spoke to a number of people. Let's hear out first from Dinshaw Irani, Helios Capital Management, about his top ideas in the volatile market and why he is severely underweight IT.
Our feel is that it's more of, the domestic plays like, say, healthcare, not pharma particularly, but say hospital space. I think that has done fairly well going forward. IT we were fairly okay with, but after the NESCOM meeting, I think what we did underestimate in IT was AI. I think AI is going to be a major disruptor for IT. In fact, one of our rejection criteria is disruption. And I think AI is a big disruptor in the IT space. In fact, hearing all these leaders of large caps talking, we realize that they are also floating around right now. They're not even aware how this AI is going to impact. But what we're clear about is that the contract tenors are going to shrink. Obviously, the manpower requirement is going to shrink. And this is what the model used to be earlier. And so there's a total reset in the model in IT. So I think that's one space which is avoidable according to us. In fact, today, if you ask me, we are heavily underweight IT as such, and haven't been increasing the weight also going forward. So as I said, the pockets of, and by the way, the domestic capex plays, they are looking very attractive to us. Discretionary plays, not autos, by the way, are looking fairly okay to us. So these are the few spaces that, and obviously financials. I think, unfortunately, in the bank space, you don't have many mid caps, but at least and by the way, the ones in the mid caps we don't like anyways. But in the NBFC space and the services space, there are quite a few mid cap plays which we like as such. So these are the few sectors that we like and a few that we don't.
I think on the bank side, HDFC and ICICI, which are two of my favorites, really one of my largest favorites is ICICI. Again, really good earnings. And on the private bank side within India, you've seen a lot of resiliency, the ability to help greenfield projects once they get in place, and also looking at the asset management, private banking, wealth management side of the business, which provides diversification. And finally, 197 Paytm. Financial services are doing well globally. This is a stock that has come off of its all-time highs fairly meaningfully, but hasn't totally technically broken down. So that's another name that I think if we start to see some bottoming behavior, I'd be looking to start to add positioning.
So it's a chess game, Neeraj. It has long, short implications. The man he is a lot more ideological today than he was in the first term. He is more determined. He has less worry of its impact, the first order impact on equity markets, almost certainly. Trump 1 was obsessed with equity markets. This time, one wonders whether he and Besant are actually obsessed with bonds instead of equity, So the primary objective seems to be sort of bringing down the sort of a bond. Now, tariff, as such, of course, it at margin in US for the first order is going to be inflationary, but eventually the growth actually takes a bigger hit. And which is why typically when, big tariffs sort of are imposed, eventually, paradoxically, rates actually come down. They don't go up in the US, So that's one implication that I kind of think which could be somewhat different to what a lot of people argue, So empirically, tariffs could drive rates lower. Tariffs almost certainly are bad for profit pools, Neeraj, and therefore, I kind of think that US markets are extraordinarily expensive and somewhat extremely dismissive to the impact that they will have, both in terms of economic impact and also the profit impact.
Okay, so those are some views coming both on the global front as well as in IT. But let's move across to Puneet. He has a set of views that Investec has put out on EMS companies. Interesting one is what he called it. Puneet, give us those views.
Well, definitely, it's an interesting report because it has a two-pronged approach, to be honest. The first one, they've upgraded stocks, Keynes Technologies, as well as Sirma. They were a sell rating earlier, now they are a hold. Target prices on your screen right now, while they maintain their positive view on Dixon Technologies as well as Amber Enterprises. And it's a very interesting report because they take forward a very strong view on some of the investments that these companies have done. So first, why are they upgrading Sirma as well as Keynes? Keynes as well as Sirma has seen a stock price correction of about 45% for Keynes, 34% for Sirma respectively in just the last 2 months because of the broader market correction, of course. But valuations were at premium for these, and now these stocks have turned favorable versus a comparison of just a 7% fall in the Nifty 50 as well as a 17% fall in the Nifty mid cap. So definitely it has fallen more than the benchmarks. But there is a key question here. Why is Investec still preferring the likes of Dixon and Amber? Because despite the premium valuations. Now they mentioned Dixon's capital efficiency, cost competitiveness as well as management's opportunistic approach is something that's standing out for them, and they're still maintaining their target price of about 19,000 versus the current target price of Dixon, which is around 13,000. For Amber Enterprises, they are positive on the electronics as well as the railway division specifically. They call out that it's an impressive return on investment capital ratios for these businesses. While the consumer business might face some headwinds going into Q4, they're positive on these aspects, and hence they prefer performance of Dixon and Amber because of a stronger performance versus the PCBA business of the other companies. And that's what my next point is, because they mentioned that they are concerned about the printed circuit board assembly business, something that Sirma and Keynes both are a part of. It's interesting. I want to give a note that Amber's subsidiary Ilgin and Ever are both into the PCBA business, but the main parent business isn't under this. But they are concerned about the cost competitiveness of this business and the profit margin shrinking in the PCBA assembly business. We've seen a lot of new auto companies also enter this because of joint ventures and the use of PCBAs in the new automotive side. So they are more concerned on that aspect. And another one is the chart that I can pull up, because what's driving them bullish on something like a distance, the return of invested capital on newer business specifically. So if you see the display fab business, that's something that Dixon got really hammered on post the Q3 earnings. It has a return on capital of about 30% going into the next few years. Whereas the other opportunities that Keynes is pursuing, such as the OSAT business, that has a lower return of investment capital, and PCBAs, as mentioned, has the lowest, where guys like Keynes as well as Sirma are present. Finally, why it remains the top picks is in the last table, if I can highlight, which is the post-tax EBITDA to operating cash flow conversion. And over the last 5 years, Dixon has had 117% of that. So whatever they've made in EBITDA, it's actually more than that they've been able to convert in terms of cash flow. For Amber, it's 145%. And now the list thins out after that. For Keynes, it's just 8%. For Sirma, it's actually negative 85%. And for Avalon Tech, another negative 10%. So we're seeing the change in the industry that's happening. And hence, Investec is preferring Dixon and Amber for all these particular reasons that I just mentioned.
Post-tax EBITDA to OCF conversion, something that Pankaj Tibrewal in a recent conversation also mentioned, becomes very, very important as a yardstick for some of the businesses. But tell you what, I mean, these businesses per se have done well. Keynes may have a lower 5-year average, but as a stock, it's been doing very well. Some names are expensive for sure. Aditya Shah, do you like any of these?
It is a story of expensive becoming less expensive. Let me quote the example of Zen Technologies here. Zen Technologies, the growth slowed down little bit, and the stock was butchered from about 2,500 to about 1,000 rupees, and everybody was shocked. Similarly, within the EMS space, while the growth is really very fast, the valuation that these stocks are really trading is obnoxious, to say the least. And in my opinion, does not warrant any long-term investment as of now. If the valuations come to a decent level where the growth slows down, then you can think about entering these companies. And look at the cash flow, operating cash flow of Keynes Technologies. It's 8% conversion, and the stock is trading at that obnoxious valuation. I wonder what investors are seeing and investing. The stock and might as well correct at about 50% and still not be cheap per se. So my advice has been with the defense sector. The EMS sector is also a clear avoid right now at this stage. The valuations do not warrant any investment here.
Okay, Kush Bora, do any of these stocks stand out for you as a trading play? And of course, couple that up with your trading ideas for the afternoon.
That, and I've missed out on so many conversations, including the one on cricket. But the big update is the headache for India is gone. Travis Head is out. So if anyone's looking for something to cheer, that's one piece of news. Incidentally, Dixon and Amber stand out for me as well, technically, in the sense that, compared to Keynes and Sirma, these are the two stocks that are still holding above their 200-day moving average. And if the markets do tend to, if the markets rather, recover from here on, I won't be surprised to see, these obnoxious valuations, as, Aditya's calling them, perhaps sustain for a little longer. So these are the two that I would still prefer, Dixon and Amber. Now, as far as the BTSC trade for the day goes, it is a BTSC and not an STBT. Castrol has been doing well for some time. Today it's holding above the 200-day moving average, and going by the looks of it, in all likelihood will close above the 200-day moving average after a goodish 4 to 5 months. So from a near-term perspective, you're looking at targets of 229 and 236 with a stop loss around the 215 mark.
Agarwala, your BTSC strategy?
So I've got a buy recommendation on Navin Fluorine. I think this is a good trade to take at current levels for a target of 52.50 on the 42.50 on the upside, with a stop loss at 3800 on the downside.
Okay. Quickly on to certain factors to watch out for. Neeraj, likely the largest of that will be all eyes on China tomorrow. But before I come to you on that, just cover some of the other stuff. Japan PMI data expected to come in. China PMI data, that will also have an impact on what comes through in terms of China stimulus. Corporate actions, there is Anand Rathi record date for bonus 1:1. There's also Bazaar style 50% of the total market cap expected to exit lock-in. So some share lock-in expiry also expected. Not sure how much of that will actually translate to a sale on the exchange, because the stock is down nearly 50% from list price. But the China factor, right, Neeraj, tomorrow?
A big thing. I mean, let's see what Li Qiang says. But it's really weak, I think, because Li Qiang will make a set of announcements tomorrow, and then some further news come in, I think, on March 11th or March 12th as well. So it's the next few days when it's going to be so important. And the fact that those announcements are coming in right after Trump puts his tariffs make it even more pertinent. So let's see. Could be a very interesting time for metal stocks as well. But as the two-day session begins, the much-awaited 2025 government work report is expected to be released on Wednesday morning in Beijing. My colleague Sven Wang from Beijing, China, will join us with details that, and in fact joins us about what can be expected.
Well, as China's two sessions begins, the much-awaited 2025 government work report is expected to be released on Wednesday morning in Beijing. Well, the government work report reviews the government's performance for the past years, 2024, and outlines the key economic and policy goals for the coming year, like 2025. And here's what we can expect for the 2025. And firstly, the economic growth target. And secondly, the report is set to detail a stronger fiscal stimulus to support economic growth, and with stimulus measures focused on boosting domestic demand, such as in the areas of consumer-led growth, also promoting high-quality development and developing a stronger production. Well, last month, Chinese President Xi Jinping had called for greater efforts to promote the healthy and high-quality growth of China's private sector, which is also expected to be a key focus of this year's report. Well, the report will also likely address domestic challenges, such as the stimulation of construction and infrastructure investments to drive the domestic consumption. Additionally, the report is expected to provide a response to global pressure pressures and review areas highlighted in previous reports. For example, technological innovation, green transformation, artificial intelligence development, and renewable energy. Well, the two sessions which starts this week will be a window into China's plans for 2025, with the tone and the details from the sessions reflecting the direction the country will take for its future plans.
Well, that'll all be in focus tomorrow, and of course likely be market moving not only for India but across the globe. But as we wind down to close, let me quickly take this opportunity to thank all three of our guests today, Aditya Shah, Aditya Agarwala, as well as Kush. Thanks so much for joining us this afternoon, giving us all of those views and taking us through the last hour and a half of trade. But let's quickly look at where the Nifty is settling in at. We've had another flattish kind of day, 0.25% or so down. And we've held on to 22,000 in a fairly resilient fashion. You look at the intraday graph, it's been a very, very range-bound day of trade. Outside of that initial blip that we saw, we dipped down to 21,964 and rebounded fairly quickly. And we've been in that band pretty much through the day. Let's talk about the broader markets as well, and let's pull up the Nifty Mid-Cap Index as well as the Nifty Small Cap. See where those are settling. Just about a slight positive bias on the mid-cap, very similar chart structure. We've maintained that positivity, the Nifty Small Cap too, up about 1.1%. So that's where some bit of positive momentum is being seen. Let's look at the advanced decline as well, because the breadth of the market has been crucial, at least in this calendar year. We've seen a bit of positivity on that count, even though it's off the day's highs, but nonetheless we're closing 3:2 in the green roughly. So that's the other positive angle. Let's look at sectors, because auto was one sector where there was plenty of pain, 1.3% lower. IT is the other pocket, FMCG down 0.6 odd. Let's talk about the ones which have done well. The PSU Banking Index has done well, and I'd be curious to pull out the constituents of the PSU Banking Index. But before we do that, I will just quickly mark out a few others. Nifty Metal up 0.5% thereabouts, and you had the Nifty Realty, which is also closed in the green. So some bit of positive bias there as well. Nifty Private Bank was absolutely flat despite some of the heavyweights doing decently for themselves. Let's pull up the PSU Banking Index constituents. Likely what we'll see is SBI leading the pack. Yes, you had a couple of other names as well joining SBI, but 3% higher on that heavyweight has pulled this index higher. But outside of that, you can see good momentum across the board here. You're also seeing, if we can pull up the private banking index, while that one was flat, you see some heavyweights really pulling and doing decently well for themselves in a market like this. So in terms of constituents, HDFC, ICICI did well within the private banking space, even though it's just about turned in the red at close. Let's look at the Nifty 50 heat map last off. I want to just try and look at the breadth as well as some stock names. HDFC up 0.5%, as I did mention, ICICI up 1/3. But otherwise quite a mixed bag. IT and auto dominating the bottom rung. Bajaj Auto, Hero are some of the big losers of the day. You also had a Maruti down 1.4. So some of those names really seeing some bit of pressure. Last off, the BSE 500 top gainers, top losers. If you can pull that one up as well. Those are some names which have really moved in trade. India Cements was the top gainer on the BSE 500. And really stood out in the way in which it performed today. But outside of that, you had some losers as well. You had a Paytm, a Laopala, and a Bajaj Auto within the Nifty, as well as now standing out even within the BSE 500, down 5% odd. But with that, we're out of time on this edition of India Market Close. From Neeraj, myself, everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit. More action on the other side.
Very warm welcome to you all for this NDTV Profit conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breathing also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Very, very warm welcome to you all for this NDTV Profit.
Hello and welcome. Good afternoon. You're watching Market Express and I'm Malika Mishra. Let's get straight into the show. Benchmark indices end a range-bound trade lower. The Nifty ends about 22,000 mark, whereas the Sensex ends about 73,000 mark. Broader markets outperform headline indices. Sectorial action mixed on the Lal Street. Media index gains the most, followed by PSU banks. On the other hand, auto index logs a sharp decline, followed by IT, FMCG and pharma. Rupee strengthens by 5 paise to 87.28 levels. Persistent foreign fund outflows and a prevailing liquidity deficit. Forex traders said the ongoing uncertainty surrounding tariff imposition by the US has left financial markets in a flux. Moreover, the tariff chaos has injected volatility and uncertainty into the US dollar index. US President Donald Trump's tariff targeting Canada, Mexico and China kick in today. To remind you, 25% tariffs imposed on imports from Mexico and Canada. Cumulatively, 20% tariffs imposed on China. Additionally, 25% tariffs on steel, aluminum imports will be kicking in from March 12th and the reciprocal tariffs apply from April 2nd. Let's take a look at which sectors will most likely get impacted in India on the back of Donald Trump's tariffs. Chemical stocks like PI Industries, UBL and Jubilant Ingrevia are likely to be hit. The manufacturers of top 5 chemicals are imported by US. Metals industry may feel the heat of higher tariffs on metal space. There may not be any direct impact, but indirect impact could be steel dumping in India by China, South Korea and Vietnam. Top metal stock like Hindalco's Novelis could see direct impact. Auto ancillaries may be indirectly impacted only due to the complex nature of their supply chains. Customers heavily rely on Mexico's manufacturing units to serve America. Ford, BMW, Volkswagen, General Motors are some players that manufacture in Mexico and Canada. Let's take a look at the IT sector. While KPIT Tech, Tata Tech and Tata Elxsi could be least exposed, Infosys, LTI Mindtree, HCL Tech stand most exposed to Trump tariffs. The sector may be directly impacted by a nearshoring from Mexico and Canada that account for less than 5% of the total supply. Jefferies comes out with a note on India's strategy, says the government is taking steps to improve India's long-term growth outlook. As per Jefferies, the government is focusing on issues like bilateral trade agreements, investment in electronics. Government's recent move to cut income tax aims at boosting consumption and drive savings. FII selling continues with equities worth $37 billion sold in the past 5 months alone, especially now that US yields rise to 4.5%. Global investors are shifting gears from equity to debt. Now, this makes developed markets far more attractive. Factors influencing India's sell-off include high valuations, single-digit earnings growth, lower capex, and tight liquidity. Morgan Stanley maintains an overweight stance on housing lender Canfin Homes. Morgan Stanley reiterates disbursements and loan growth targets for Q4 on FY26, says that the trend implies 2,400 crore rupees disbursements in Q4 and mid-teens loan growth in FY26. The brokerage and analyst firm hails the e-registration situation in Karnataka, believes Telangana market remains tepid and will take longer to improve. Reliance Industries received $2.81 billion or 24,522 crores demand notice from the government. The demand was following a recent division bench ruling of the Delhi High Court. The case stems from a long-standing dispute over alleged gas migration from ONGC's blocks, for which an international arbitration panel had previously awarded RIL and its consortium partners $1.55 billion in 2018. However, the division bench reversed an earlier single-judge ruling in favor of Reliance, prompting the government to issue the fresh demand. RIL, along with BP Exploration and NICO, states that the judgment and demand are legally unsustainable and will be challenged in higher courts. Citi upgrades SBI to buy from sell with a target price of 830 rupees. Citi says that the state bank has a sharp in net interest margin focus, whereas sustained growth or asset quality. SBI's valuation remains inexpensive, whereas the bank has levers available to protect net interest margin downside. Nomura says India's raw material prices of most agri-based commodities will increase sharply on an annual basis. Companies hike prices, but it will be lower than raw material inflation. Nomura says it prefers companies that show pockets of strength and improved execution. Nomura's top picks in the consumption space are Marico, HUL, and ITC. Trump's tariffs could benefit gross refining margins of oil marketing companies with an estimated rise of $1 per barrel. In fact, Singapore's gross refining margins have risen to the highest levels in 2025. Note that higher GRM and lower crude prices both boost earnings for OMCs. Companies in focus would be MRPL, Chennai Petro, IOCL, BPCL, HPCL, and RIL. CLSA cuts target for Varun Beverages. The analyst firm upgrades the company to high conviction outperform, cuts the target price to 770 rupees from 802 rupees earlier. The company has a compelling risk reward even after assuming competitive impact. The capex of Varun Beverages capex is percentage of sales peaks in CY23. Now, CLSA expects capex intensity of Varun Beverages to ease. However, total addressable market remains large and growing. Varun Beverages has a large upside for soft drink consumption as summer beckons. Elara Capital reiterates buy on Oro Pharma as it estimates the company to be attractively priced, especially the new Pen-G plant with an investment of $300 million targets catering to 80% of India's demand, as India previously relied on China for Pen-G. A 790 crore EBITDA potential could offset other losses of Elara Capital. India's cement prices pick up. Pan-India trade prices increased by 3 rupees per bag in March 2025, while cement prices recorded 2% quarterly rise in the fourth quarter so far. Gensol Engineering hits 20% lower circuit after Care Edge downgrades rating. Now, these ratings were revised due to ongoing delays in servicing term loans, which the brokerage recognizes as a default. Liquidity remains poor, with 4 instruments with an issue size of 716 crore rupees causing most amount of doubt. ICICI Securities shows faith in food deliveries. They reckon that the sector is being ignored amid panic over quick commerce. Structural growth drivers appear strong. Income tax cuts is likely to boost consumption and benefit the food delivery space. In a big breather for SEBI chief, Madhavi Puri Butch and 3 other whole-time members, Bombay High Court decides to put a stay on the FIR. The special court had directed FIR filings in the listings case of CAL's refineries. Now, the main allegations were corruption and irregularity. Bombay High Court calls special court order mechanical. Sapan Srivastava has been given 4 weeks to reply. Quick update on Poonawalla FinCorp, a NBFC operated by the Adar Poonawalla Group. The company's Pune office is being inspected by the tax department. There is no material impact on financial operation or other activities of the company on account of this inspection. Ashoka Buildcon gets provisional certificate for completion of NHAI projects. The project is executed by Ashoka Karadi Banwara Road, a wholly owned subsidiary of Ashoka Concessions. The company also announces that the said SPV has received a provisional certificate for completion of 50.205 kilometers in aggregate out of total project stretch of 56.705 kilometers. Further, the SPV is already eligible for receipt of annuity payments from the NHAI for the operation period of 15 years at the interval of every 6 months from the date of achievement of first commercial operation date. Oyo Hotels speeds up IPO plans as the founder's debt repayment deadline approaches. Creditors insist Ritesh Agarwal to pay off the dues for $383 million he borrowed, a part of a multi-billion-dollar loan package. RateGain announces a significant partnership with MEWS Muse, the industry-leading hospitality cloud and property management system PMS provider. Now, with decades of leadership in their industry, RateGain and Muse are joining forces to redefine how hoteliers manage their operations, optimize guest experiences, and unlock new revenue streams. This collaboration between two industry giants brings together RateGain's cutting-edge channel manager and Muse native cloud-based PMS. This integration will allow hotels to seamlessly manage rates, inventory, and reservations across over 400 distribution channels using RateGain's channel manager. Designed to achieve more revenue with less effort, the channel manager is easy to use, self-serve, and fully automated, saving crucial hours in product creation, mapping, and distributing rates and inventory. Zydus Life says it will develop a combination vaccine against shigellosis and typhoid for infants and children. The company said this vaccine combination is being developed for the first time in the world. The project is expected to get underway in March 2025 and is being supported by the Gates Foundation, it added. The pharma company will collaborate with a partner for research and co-development of the combination vaccine using Zydus, who prepare qualified typhoid conjugate vaccine and the Shigella vaccine from its partner. Solar Industries backs 239 crore rupees defense order for hand grenades. Now, as part of the agreement, Solar Defense and Aerospace will deliver multi-mode hand grenades within a year. The deal focuses on the supply of critical defense products, contributing to the nation's security capabilities. Solar Defense and Aerospace Limited specializes in manufacturing and supplying high-quality defense products. On February 28th, Solar Industries India announced that the company, along with its subsidiary, secured orders worth 2,150 crore rupees for the supply of defense products. Now, these orders awarded by an international entity are expected to be completed over the next 6 years. Equinox India rallies after the company's board approved a series of growth initiatives and fundraising plans. The company's board approved the appointment of Jitendra Virwani as chairman of the board and Aditya Virwani as managing director of the company. Aditya Virwani spearheads a dynamic and experienced leadership team at one of India's fastest growing real estate companies, including Sachin Shah, who continues as Chief Executive Officer and Executive Director alongside Rajesh Kaimal, appointed as Chief Financial Officer and Executive Director. Crystal Integrated surges after the company secured contracts at major airports across the country. The new agreements, which include contracts at Chennai International Airport in Tamil Nadu, Trivandrum International Airport in Kerala, and Chandigarh International Airport, will see KISL enhance its service offerings across security, hygiene, and facility management services. Tata Motors says that the company begins trial for India's first heavy-duty hydrogen trucks. The trial phase will last for 24 months with 16 high-tech trucks. The trials are along multiple busy freight routes of India. These trials were flagged off by Union Minister Nitin Gadkari and Tata Motors CV's Girish Wagh. Remember, Tata Motors had won a tender from the Ministry of Renewable Energy to conduct trials of heavy-duty hydrogen trucks. First Source announces official opening of its Australia and New Zealand headquarters in Melbourne, Victoria, alongside the launch of a dedicated AI innovation lab. This expansion aligns with the Victorian government's economic growth statement, which prioritizes digital technology as a key driver for economic and job growth. The ANZ headquarters will be a hub for specialist domain-led service operations, featuring a delivery center and an AI lab dedicated to advancing responsible AI adoption and industry innovation. This milestone strengthens First Source's commitment as an UNB 4TM company, driving a bold shift from traditional outsourcing to AI-led transformation, digital talent development, and business innovation in the region. Adani Group launches its latest film celebrating the impact of Adani Ports, a new addition to the Hum Karke Dikhate Hain stories. This narrative-driven film pays tribute to the indomitable spirit of Hum Karke Dikhate Hain of today's India and Indians, showcasing unwavering determination. The film emphasizes how Adani Ports enables businesses, both large and small, to thrive by providing seamless connectivity and world-class facilities. Adani Ports and Special Economic Zone Limited is more than just India's largest integrated ports and logistics company. BHEL files writ petition in Karnataka High Court against Raichur Power Corporation. The plea seeks declaration that Raichur Power withholding payment worth 423 crore rupees is wrongful. Prime Minister Narendra Modi said the changes in the global economy and trade could be an opportunity for Indian firms to invest more and take advantage of the world's need for alternative supply chain hubs. We have seen that when supply chains are disrupted, it affects the global economy, Modi told business leaders during an online session. The world needs a trusted partner which produces high-quality products and the supply is reliable. Maharashtra Minister Dhananjay Munde resigns amid row over Sarpanch murder. Chief Minister Devendra Fadnavis has accepted the resignation after Munde's aide Valmik Karad was arrested as one of the accused in the case. The 45-year-old Sarpanch was tortured and murdered in Bid. The assailants recorded 15 videos and clicked 8 photos to record the brutality that have been circulating on social media. A coupling of the Odisha-bound Nandan-Kanan Express splits in half, causing panic among passengers. The train broke in Uttar Pradesh's Chandauli on Monday, splitting the train into 2 parts and triggering panic among passengers. The coupling is a chain and hook mechanism to attach 2 coaches or wagons of a train. Now, no one was hurt in the incident, which took place near the Pandit Deen Dayal Upadhyay Junction. The train, which was already delayed by more than 3 hours, was headed to Puri from Delhi. President Donald Trump pauses military aid to Ukraine only days after the public clash with Ukrainian President Volodymyr Zelensky. The White House has issued a statement clarifying that the pause is to ensure a peaceful resolution. Tensions between Zelensky and Trump escalated due to differing opinions. Trump, who has prioritized a quick resolution, criticized Zelensky's remark that ending Russia's war was still very, very far away. China has swiftly retaliated against fresh US tariffs announced by President Donald Trump and announced 10 to 15% hikes to import levies covering a range of American agricultural and food products. The move places 25 US firms under export and investment restrictions. The move came as America doubled duties on Chinese goods to 20%, along with imposing new 25% tariffs on imports from Mexico and Canada, launching new trade conflicts with the top 3 US trading partners. The 20% tariff will apply to several major US consumer electronics imports from China previously untouched by prior duties, including smartphones, laptops, video game consoles, smartwatches, speakers, and Bluetooth devices. Japan deploys more than 2,000 firefighters to battle the country's biggest forest fire in 3 decades. At least one person has died in the blaze, which has tortured more than 5,200 acres around the northern Japanese city of Ofunato. Now, some 2,000 have already left the area to stay with friends or relatives, and more than 1,200 have evacuated to shelters, officials said. Now, the fires are burning in a forest area of Iwate Prefecture, which is Japan's second largest prefecture and has the country's second lowest population density. More than 80 buildings are estimated to have been damaged so far, although FDMA noted that details are still being assessed. The champion team meets again today in a knockout match as India plays Australia in the ICC Champions semi-final. Last time the two big teams faced each other was in an ICC event was the World Cup Final 2023, where Australia defeated the men in blue, winning the World Cup. Well, that's a wrap on Market Express, but do stay tuned to NDTV Profit. A lot more lined up for you on the other side.
Very warm welcome to you all for this NDTV Profit conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers, and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Very warm welcome to you all for this NDTV Profit conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Very, very warm welcome to you all for this NDTV Profit conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Very, very warm welcome to you all for this NDTV Profit conclave, which is themed on.
After days of suspense, back and forth, Donald Trump's 25% tariffs on Canada and Mexico and 10% additional tariff on China comes into effect. These tariffs on China were on top of the previous round of 10% tariff imposed on February the 4th. In the emerging trade war, countries waste no time in retaliating to Trump's tariffs. While Canada matches Trump's tariffs over 2 phases, China announces its second round on tariffs on US goods. The Nifty logs its longest losing streak in 29 years amid weak global cues and concerns around Trump's tariffs. Nifty Auto also hits 52-week low and emerges as the top sectoral laggard. Media index ends higher by over 2%. Reliance Industries receives a demand notice worth 24,522 crore rupees from the Ministry of Petroleum and Natural Gas. This is following a recent High Court ruling against Reliance and its partners over gas extraction in a deep water field located off the eastern coast. Spinner Varun Chakravarti strikes in his very first over and manages to dismiss Travis Head, who was on a costly boundary rampage. The champions teams meet again today in a knockout match as India plays Australia in the ICC Champions semi-final. Good evening, you're watching Profit 360 on NDTV Profit and I'm Sanjana. For the next half hour, we're going to bring you the latest on markets as well as national and international news. So let's dive into it. March 4th, the day that Donald Trump promised the much debated, discussed 25% tariffs on China, Mexico and Canada would kick in. While Trump argues these tariffs will pressure the US's neighbors to crack down on fentanyl trafficking and illegal immigration, he has also made it clear that the broader aim is to eliminate trade imbalances and bring manufacturing back to America. The administration remains firm in its belief that tariffs are the best way to boost US industry and attract foreign investment. But with trade tensions soaring, will this move secure economic dominance or spark deeper global disruptions? When it comes to Indian business giants such as Tata, Chairman N. Chandrasekhar said the impact of tariffs will be short-lived as India is dominant. Meanwhile, market veteran Ajay Bagga also believes that retail investors must continue to buy.
टैरिफ्स का बात चल रहा है, चलते ही रहेगा. So we have, these are all short-term things that will happen. Okay. But I feel Tata Steel in India is predominantly serving most of the domestic market. Sure. Okay. And so export का बहुत कम है हमारा, और यूरोप में थोड़ा एक्सपोर्ट है. But लेकिन स्टील का प्राइस कैसा रहेगा अभी थोड़ा स्टेबल है, देखना पड़ेगा. सो इसके लिए जो हमारा कंट्रोल पे है, लाइक प्रोडक्टिविटी एफिशिएंसी, उसमें ध्यान रखना चाहिए. ठीक है. नो पॉइंट इन टॉकिंग अबाउट व्हाट विल बी द प्राइस, व्हाट विल बी द टैरिफ. दैट जो होगा हम गवर्नमेंट के साथ बातचीत करेंगे, और व्हाट एवर हेल्प गवर्नमेंट हैज़ टू प्रोवाइड, गवर्नमेंट विल प्रोवाइड, बट वी हैव टू बी एफिशिएंट.
For me, especially the retail audience who favor your channel, Neeraj, I would say every time is a buying time, and you should regularly keep buying. Now, as far as the bottom of the market is concerned, mathematically we can prove that, okay, now the valuations are this, valuations are that. One, valuations is an art. It's not a science. We don't know if it will actually come at 9%, or as you said, it might be 7, it might be 11, it might be 15% earnings growth also. So we have to look at history. We have to then aggregate it company-wise and make a portfolio. I would say we are probably about a couple of months into the bottoming process. It will take time. It won't happen very rationally, very scientifically, that the market participants will realize that, say, the Nifty is now below its 10-year average trailing PE, and now let's start buying. That won't happen. Mostly the momentum on both sides, Neeraj, it takes the markets up or down. So there is an overshooting that happens. Right now, we might be in the overshooting. That we will know a year down the line that, yes, this was the time when the turn should have happened, but the market overshot and then it made a turn. But definitely, yes, it's not the September end market of all-time highs. Is it going down 10% more? I don't think so. I think there's a very little probability, unless there is some shooting war or some geopolitical big event comes in. I think overall, the tariffs of Trump will not have that big an impact on India. They might bring in recession in pockets of the world. So that issue remains. But overall, I think we have weathered it well, and we are near to the bottom. Now, whether it happens this week or 2 months down the line, it's an art. It's not a science. And I would say these numbers just give you an idea that now it's looking good. Is it very compelling? I think right now people are really hurting, with the 94 lakh crores of valuations that have evaporated. It's tough to tell people to bring in chunks of money. I would say regular money over the next 6 months, keep investing, because first the bottom will form. Recovery will take time again.
So first, let's see what has been announced or what could be announced in the next couple of weeks. Firstly, it's the 25% tariff on all imports coming in from Mexico and China. Then there is a 10% additional tariff on China, which will take the cumulative tariffs on China in the last 1.5 months to 20%. Then there's a possibility of 25% tariff on steel and aluminum imports from all T8 partners from March 12th. And then in April, there's a possibility of the reciprocal tariff coming in. Firstly, let's try and understand the impact of the tariffs that could come in the next couple of weeks and which Indian companies stand to either benefit or lose out of it. Firstly, coming on to the chemical companies like PI Industries, UPL and Jubilant Ingrevia. Now, these three companies stand to benefit because these three companies are manufacturers of the top 5 chemicals that are imported by US. So if there is any tariffs on China, then these three companies could stand to benefit. Now, when it comes to the auto ancillary space, it is a bit complicated. Companies like Samvardhana Motherson, Bharat Forge, Sona BLW, JK Tyre, Balkrishna Industries, Sundaram Fasteners and Timken India. All these companies have direct exposure to US, but the impact could be limited because most of them also have plants in US. But given the complex auto supply scenario that is there, an auto supply chain there could be an indirect impact on all these auto ancillary companies because auto ancillary companies customers, that is the OEMs, have a high dependent on Mexico and China for manufacturing to serve the US market. All these companies, that is Ford, GM, Volkswagen Group, BMW, Mercedes, have manufacturing units in Mexico and Canada which serve the US market. So any tariff could lead to pricing pressure for this auto ancillaries as well. Now, when it comes to metal companies like Vedanta, Hindalco, Nalco, SAIL, JSW Steel and Tata Steel, no direct impact because we hardly import metals to the US market, so no direct impact. But again, this tariff imposition may have an impact on the steel and aluminum prices because of the changing demand supply scenario, so that could impact these companies. Also, the indirect impact could be on steel dumping coming in from China, South Korea and Vietnam in the Indian market, so that could impact the steel players as well. Now, apart from that, two companies that stand to benefit directly, JSW Steel, they have a 1.5 million ton capacity in Ohio, which contributes nearly 4.5% to the total revenue, and this stands to benefit if prices move higher. Then there is Hindalco. Now, for the Novelis unit, the impact is still not sure, given the fact that the company could benefit from higher aluminum prices, but on the flip side, the raw material prices could also move higher for the company. However, the company believes that they can be exempted, like something similar that happened last time as well. So currently, we do not have a clear view of what happens to Hindalco as a subsidiary, that is Novelis. Then there is one company, Cummins, that could stand to benefit because higher tariffs on Mexico may open up higher prospects of exports for Cummins India. Currently, exports is a very small portion for the company, but Cummins Mexico unit exports nearly $1.5 billion of components and diesel engines to the US market. And if there are tariffs, this or part of this exports could move to the Indian unit going forward. And lastly, it comes to the IT sector. Now, the direct impact is very limited via nearshoring from Mexico and Canada, less than 5% of the supply, so not much of an impact, but still a list of companies that have direct exposure to the US market are Infosys, LTI Mindtree and HCL, which have a highest exposure, and companies that have the least exposure are KPIT Tech, Tata Tech and Tata Elxsi. So keep an eye out for these companies, given the fact that tariffs could come in the next couple of weeks.
Absolutely, a wait and watch approach is what we're hearing. And moving on, in a swift retaliation to these tariff hikes, China has not wasted any time in announcing additional import duties of up to 15% on a range of American agricultural and food products. Now, these new duties will take effect from March the 10th and will impact US exports like chicken, wheat, corn, soybeans and more. Now, CGTN's Siwen Wang joins us with more details.
China has announced additional tariffs on a range of agricultural imports from the United States effective March 10th, and this is in retaliation to a hike in levies imposed by the Trump administration. China has announced additional 15% tariffs on chicken, wheat, corn, and cotton from the U.S. Additional 10% will be added to tariffs on sorghum, soybeans, pork, beef, aquatic products, fruits, vegetables, and dairy products. Well, the country's Commerce Ministry also announced that it will file a lawsuit at the World Trade Organization, or WTO, over the additional 10% tariffs the U.S. has imposed on China. Additionally, China has added 15 U.S. companies to its export control list, and this comes as China's political two-session season kicks off, and the country's top legislature, the National People's Congress, or NPC, held a press conference today. And to a question about the China-U.S. relations, the NPC spokesperson asserted that mutual benefits or win-win cooperation remained at the core of the relationship between the two countries. While he added that bilateral trade has increased over 200 times over the past 46 years of diplomatic ties, benefiting not only the two countries, but also contributing to global economic growth.
And it was a flat end to the markets today, with Nifty barely holding its ground over 22,000, and the benchmark also recorded losses for 10 days straight, which is its longest falling streak in 29 years. Auto emerged as the top sectoral laggard, but the media index ended over 2% in trade. My colleague Anushi now joining in with a roundup of all the action on Dalal Street today. Anushi, over to you.
Right. So now if we see Nifty 50 has clocked in its 10th session, wherein it is ended the session with losses. It's in red again. Now this is the longest daily losing run that we've seen in the last 29 years. Nifty, in fact, it fell for 10 sessions last in Jan 1996 is what we are seeing. In terms of where the sectoral action is and where the stock specific action was, Bajaj Auto and Hero MotoCorp, the top laggards in trade today. In fact, Bajaj Auto has ended in red for 7th consecutive session, while Hero MotoCorp, it's been 6 sessions now that it's ended in red. If you look at Nifty Auto, that it had hit a 52-week low today. And as mentioned, that top sectoral losers, Bajaj Auto and Hero Motor, were the contributors to this. Nifty IT was another pack wherein we had seen pressure in trade today. If you see yesterday, it had ended in green, but it again reversed those gains of yesterday and ended in red, which was again, if you see what had happened, it had lost its 7-day losing streak yesterday, but now again the index is back in red. Now coming to on the positive side, we have Nifty Media and Nifty PSU Bank, which emerged as the top sectoral gainers. In fact, Nifty Media had snapped its 3-day losing streak, ending the day with some gains, while Nifty PSU Bank snapped its 6-day losing day streak and ended with gains again. In terms of where the broader market action was, broader markets have held strength, outperforming the benchmark indices, wherein we'd seen some pressure. Nifty Midcap 150 had ended in green for the 2nd consecutive session, and in fact it recovered about 2% from the day's low as well. Some of the top Midcap 150 gainers include NLC India and Bharat Dynamics. In Nifty Small Cap 250, it snapped its 6-day losing streak and ended the day with gains, recovering about 3% from day's low. Small Cap 250 gainers include India Cements as well as something like a Concord Biotech. I also want to talk about some of the market cap movement which have taken place. Now, large cap stocks have gained around 4,058 crore in market cap today, while small cap stocks have gained around 43,000 crore in market cap today. And the major the top contributors in this include Concord Biotech and Jyoti CNC. So this is the overall market action that we are seeing in trade today.
Anushi, thank you so much for bringing us those updates, and some more information coming in. Reliance Industries has received a demand notice of 24,522 crore rupees from the Ministry of Petroleum and Natural Gas. Now, this follows a recent Delhi High Court ruling against Reliance and its partners over gas extraction in a deep water field off the eastern coast. Mihika joins in with more details on this.
So Reliance has received a $2.81 billion demand from the Ministry of Petroleum and Natural Gas. Now this demand notice is following a recent division bench ruling of the Delhi High Court, and this is regarding a dispute that started long back in 2014 between RIL and ONGC. These both companies had adjacent blocks, and ONGC claimed that Reliance migrated gas from ONGC's blocks and hence Reliance was liable to pay. Now when you look at the timeline, 2014, the dispute began when the government demanded $1.55 billion from RIL. In 2016, the government sent a notice to RIL and its partners British Petroleum and NECO. In 2018, an international arbitration tribunal ruled in favor of RIL. But in 2023, a single judge of the Delhi High Court dismissed the government's appeal. And now in 2025, the division bench of the Delhi High Court has overturned the single judge's ruling, requiring RIL and its partners to pay $1.55 billion. And yesterday, Reliance has received a demand of $2.81 billion from the government, and the higher amount that has been demanded could be because of interest and penalties. Now, if liable to pay, then the $2.18 billion, which is roughly around 24,550 crores, translates to 31% of the last 12-month profitability that Reliance has seen. But Reliance has clarified, they say that the provisional demand is unsustainable. They're taking steps to challenge the judgment and do not expect any liability on this account. Separately, as per Bloomberg, RIL has also been penalized by the government after failing to set up a battery cell plant. Reliance New Energy Limited, which is a wholly owned subsidiary of RIL, was fined 125 crores back in 2022, and Reliance New Energy had won a bid for the battery cell manufacturing under the PLI schemes.
Thanks, Mihika, for those updates. Now, the Prime Minister has highlighted that shifts in the global economy and trade could be an opportunity for Indian companies to increase investments and capitalize on the world's demand for alternative supply chain hubs. During an online webinar themed MSME as an engine of growth, the Prime Minister also emphasized to business leaders that the world requires a reliable partner capable of producing high-quality products and ensuring consistent supply.
दुनिया को आज ऐसे भरोसेमंद पार्टनर की जरूरत है जहां से हाई क्वालिटी प्रोडक्ट्स निकले और सप्लाई रिलायबल हो। हमारा देश ये करने में सक्षम है। आप सब सामर्थ्यवान है। ये हमारे लिए बहुत बड़ा मौका है, बहुत बड़ी अपॉर्चुनिटी है। मैं चाहता हूं विश्व की इन अपेक्षाओं को हमारी इंडस्ट्री एक स्पेक्टेटर की तरह न देखे। हम दर्शक बनकर के नहीं रह सकते हैं। आपको इसमें अपनी भूमिका तलाशनी होगी, अपने लिए अवसरों को आगे बढ़ाकर तराशना होगा। पुराने समय की तुलना में आज ये कहीं आसान है। आज इन अवसरों के लिए देश के पास फ्रेंडली नीतियां हैं। आज सरकार इंडस्ट्री के साथ कंधे से कंधा मिलाकर खड़ी है।
And there's relief for former SEBI Chief Madhvi Puri Buch and 3 whole-time members of SEBI as the Bombay High Court issued a stay on the FIR ordered by the Anti-Corruption Bureau. This FIR was based on allegations of irregularities in the case of listing of a firm called Cal's Refinery way back in '94. Earlier, the former SEBI chief and the others had challenged the order in the High Court, seeking that the case actually be quashed. My colleague Charu Singh has all of the details.
The single-judge bench of the Bombay High Court has just stayed the order of the Special Corruption Court of Mumbai that had ordered for an FIR to be registered against the former chairperson of Securities and Exchange Board of India, 3 WTMs, that is the whole-time members who are currently serving in the market regulator SEBI, as well as 2 BSE officials. Now, the court also orally observed that this was some sort of a mechanical order passed by the special court's judge without really going into the intricacies of the matter. The parties were represented in the following orders. The Solicitor General Tushar Mehta represented the serving WTMs, whereas Madhvi Puri Buch was represented by another senior advocate, and the petitioner Sapan Srivastava was representing himself in the court. The court gave him 4 weeks to give a reply to the arguments made by Buch, the WTMs and the BSE officials, and the matter is going to be taken up next after the completion of 4 weeks. The petitioner also alleged several irregularities during the listing of Cal's Refinery by the SEBI officials as well as the BSE officials. However, they have alleged in the Bombay High Court that this is a case of time pass and frivolous applications and petitions being filed by the petitioner several times in an ordinary course of nature without any specifics being given.
And in continuation of its Hum Karke Dikhate Hai stories, the Adani Group has announced the launch of its latest film, Journey of Dreams, which highlights the transformative power of Adani Ports. This narrative-driven film pays tribute to the indomitable spirit of Hum Karke Dikhate Hai of today's India and Indians, showcasing unwavering determination. A statement from the group said that the film emphasizes how Adani Ports enables businesses, both large and small, to thrive by providing seamless connectivity and world-class facilities.
जहाज में बड़ी बड़ी चीजें जाते हैं ना पापा?
बड़े बड़े सपने भी जाते हैं।
ये क्या लोकल चीजें देख रहे हो? तुम्हारे लिए मैं अच्छे वाला लेके देती हूँ, हाँ? इंपोर्टेड वाला। चलो, आजा।
So, this is the shop I was telling you about.
Namaste. I love those. हाँ मैं पैक कर देता।
पूरा सुन तो लो भाई।
I need 10,000.
10,000 पीस अमेरिका भिजवाने। हो जाएगा ना?
हो जाएगा।
आपके बड़े-बड़े सपने जा रहे हैं।
हमसे देश विदेश में व्यापार नहीं बढ़ाते हैं, सपनों को किनारे तक पहुंचाते हैं। अदानी हम करके दिखाते हैं।
And President Donald Trump has paused military aid to Ukraine only days after the public clash with Ukrainian President Volodymyr Zelensky. The White House has issued a statement clarifying that the pause is to ensure a peaceful resolution. Tensions between Zelensky and Trump escalated due to differing opinions. Now, Trump, who has prioritized a quick resolution, criticized Zelensky's remark that ending Russia's war was still very, very far away. Meanwhile, Japan has deployed more than 2,000 firefighters to battle the country's biggest forest fire in 3 decades. At least one person has died in the blaze, which has torched more than 5,200 acres around the northern Japanese city of Ofunato. Around 2,000 people have already left the area to stay with friends or relatives, and more than 1,200 have been evacuated to shelters as per officials. More than 80 buildings are estimated to have been damaged so far, although Fire and Disaster Management Agency has noted that details are still being assessed. And it's 4 wickets down as the champion teams meet again today in a knockout match as India plays Australia in the ICC Champions semi-final. Last time the two big teams faced each other was at an ICC event at the World Cup final in 2023, where Australia defeated the men in blue, winning the World Cup. Relief for Indian fans as Travis Head's boundary-hitting streak is finally broken by Varun Chakravarti's spinning ball, which was caught by Shubman Gill. And that's all the time we've had on this edition of Profit 360. Stay tuned to NDTV Profit for more news and updates.
Very, very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.